Welcome. My name is Mark Hayfley. I'm the Chief Investment Officer of UBS Wealth Management. We at UBS, together with the University of Geneva, have created this massive open online course in investment management to help you learn some of the most important concepts in economics and finance, both from a theoretical and a practical point of view. This MOOC includes 4 modules. In Understanding Financial Markets, we look at some of the most important markets that people can invest in and break down their key drivers and attributes. In Meeting Investors' Goals, we look at the importance of a sound analysis of investor objectives and risk tolerances so that you can set a sound investment policy. Then we move to Portfolio and Risk Management, where we describe how investors can bring together their knowledge of asset classes and analysis of their goals into building the right portfolios for them. Finally, in securing investment returns for the long run, we look at some of the ways investors can monitor performance and make sure that their portfolio is staying on track. I hope you find this series useful, and I hope it helps you become a better investor, advisor, or observer of financial markets.
Hi everyone, welcome to the University of Geneva. Welcome to this course devoted to investment management. I'm very proud that our Finance Institute has been chosen to propose to the world community of students these courses on finance and investment management. It's a very important course for our university because it's a tribute to the quality of our teaching programs and also the excellence of research which is done in our university. It's also an explanation why our university is always ranked among the top 1% of the best universities in the world. In terms of finance, our Finance Institute has developed new field of research in terms of neurofinance, in terms of sustainable finance, and this is a kind of development that we want also to increase in the future and propose to the whole community of students this new way of thinking finance, this new approach of finance, and we strongly believe that this is a contribution, very important contribution to the understanding of finance for the whole community. The 4 MOOCs plus the capstone project will be based on the recent development in theory, but also it will be applied to the real world, and it's really for us a bridge between theory and application. And this is also a reason why we have decided to develop these MOOCs in relation with a corporate partner, which is very important for the University of Geneva, always trying to be in relation with the society as a whole. And this is something also which is one of the strategic goals of our university. Oh, by the way, you will see that investment management can be also very fun. And we very much looking forward to welcome you at the University of Geneva, maybe to have a PhD program or trying to follow other kind of programs that are proposed also in our Finance Institute. Thank you very much.
So welcome to this online specialization in investment management that we have designed for you. I would like, as the director of the Geneva Finance Research Institute, tell you what GFRI stands for, who we are, what we do, and what makes our team a little bit special for this course. So the GFRI is an interdisciplinary research institute located at the University of Geneva. We're based at the interface of 3 faculties: the Geneva School of Economics and Management, the Faculty of Law, and the Faculty of Psychology. And we specialize in 2 areas, the first one being portfolio management due to the private banking expertise in Geneva, the second one being finance and society due to all the lessons learned after the subprime crisis and whether we can answer if finance adds value to society. So let me perhaps tell you or convince you why your faculty is a bit special. First of all, the breadth and diversity of its knowledge in very complementary fields or subfields in finance. Secondly, we have many faculty members that specialize in novel areas such as sustainable finance, such as experimental finance or neurofinance. We also publish in top A-rated publication in finance, and we try to compete at the international level in terms of publications. But we also have a practical side. We interact with the industries through workshops, seminars, conferences, and some of us have experiences with regulatory bodies. Finally, I think diversity is the key. We are diverse in terms of our educational backgrounds, our cultural backgrounds, in terms of gender, nationalities, and I hope this melting pot works together to deliver a good course for you. So let me present the team. The team, it's 9 professors and 1 project coordinator. Let me start with Tony Barada. Tony Barada is a specialist in theoretical asset pricing. He can derive very complicated mathematical formulas, but at the same time, he has a great sense of intuition, and he can convince you and he can convince me that we understand finance and that we're finance specialists. Ines Shayeb, she's our international finance specialist. She deals with international asset pricing and can tell you whether you should invest abroad, in China, in Mexico, in Brazil, or whether this is just a fad. Michel Girardin, he is the project leader for this mock that we have developed for you. He is a banker. He has 20 years of experience. He's also a macroeconomist, and in this perspective, he can tell you whether Mrs. Yellen is going to raise the interest rates in future, whether you can make money out of it. But of course, as every macroeconomist, you should attach a certain probability to his forecast. Now let me turn to Martin Hösli. Martin Hösli is a real estate specialist. He can tell you perhaps or forecast the next housing bubble in Switzerland or perhaps in China, and you should listen to his advice if you're a house or a homeowner. Philip Kruger, he is specializing in one of our novel areas, which is sustainable finance. And he really can disentangle the real value added for long-term investors of sustainable investment criteria from this simply being a marketing tool for investors that banks may want to use. And Kerstin Pershoff, who's an associate professor in neurofinance in our institute, she does something very interesting. She would put traders, students, or CEOs in an MRI and would see whether when you make financial decisions, there's the risk-return patterns that activate in your brain regions and whether you think like Markowitz thinks about portfolio selection. My colleague Olivier Scaillet is a financial econometrician. He's also a theorist, but he can also handle very practical problems, and one that he's very keen on is to say whether an active manager is relying on luck or whether he's really delivering genuine true performance with his skills. Philippe Valta, he's our corporate finance specialist, and he can tell you whether corporate decision-making can enhance or destroy value for the shareholders and for yourself. Jonas de Moret is our project coordinator. He recently graduated from our Wealth Management Master Program at the University of Geneva. He's very interested in portfolio management, and he's the one who keeps us organized, focused, and makes this whole package work together efficiently and hopefully for the benefit of all you participants. Myself, I don't want to say too much. I'm interested in experimental finance, asset pricing, and corporate governance. Recently, I've been doing research on whether and how people trade honesty for higher compensation or benefit. So for instance, if a CEO cheats, he can have a higher salary. He knows that. Will he cheat? As Mark Twain said, honesty is the best policy when there's money in it. But I also know that as humans, we are all prone to temptations. So that's the team. And as you can see, some of our members have an SFI allocation next to their affiliation. SFI stands for the Swiss Finance Institute, which is a public-private partnership that has been founded a few years ago by the Swiss banks, and which works in close cooperation with 6 universities and the Geneva University. The Swiss Finance Institute specializes in research, doctoral education, knowledge transfer activities in finance. And its research, it's really cutting edge. We are first in Europe and 15th in terms of ranking, in terms of our publications in international finance journals. So SFI, given that it has a strong priority on investment management, very much welcomes the participation of its GFRI faculty within this online investment management course. So a final word, we at GFRI very much hope that by enrolling and keeping focused in this online course in investment management, you will be able to grasp some of the cutting-edge research in finance that is useful for making investment decisions on the one side, that you will be able to learn applied concepts. Whether investment management is an art or a science, I would say it's a combination of both. I think what's important is that when you get out of this course, that you have completed it successfully, you have the toolkit that allows you to stay confident and serene in your investment decision, despite market turmoils and crises that will be always around in the future. So stay cool, enjoy the show, and I hope you'll enjoy following this online investment management course.
Hi there. You may be thinking, why am I choosing this course for? Well, it's called Understanding Financial Markets. So at the end of the course, you'll be able to know everything, well, almost everything about financial markets, and you'll be able to explain to your family and friends what the finance section of your newspaper is all about. In which case you might be confronted to their doubting that finance is actually something highly interesting to them. And they may argue, hey, I think this is a bit dry and boring. Well, I'm going to show you it's not, so please follow me. Hey you, are you interested about financial markets? Would you like to understand everything about it? Well, just follow me. And actually, you know why? You know what? Yes. There's lots of animals, there's lots of companions we can talk about when we look at the financial markets. Well, the most common example we know is bulls and bears. If you like the market, if you think it's going up, you're bullish. Why? Well, because bulls, you know, when they walk into the arena, they look upwards, they're proud, okay? So bullish meaning going up. If you're bearish, you know, bears, they walk like this and they look at their feet. So if you're bearish, it means that you see the market going down, okay? But there are other examples, less known. You will see what we mean when we talk about central banks, and we can say that they can lead the donkey to the fountain, but they cannot force it to drink. Actually, this is the French expression, but in English we actually say you can lead a horse to the river, but you cannot force it to drink. We see what we mean by that. But we also talk about cats and dogs. You will see what we mean when an investment is not performing very well. We're talking about a dog. Or indeed it has a sort of bounce and then dies out again. We don't talk about dead cat bounce. What else do we have in terms of animals, menagerie, when we talk about finance? Well, we actually have doves and hawks. This is when we talk about central bankers. And some of them belong to the category of doves, and some others belong to the category of hawks, and we see what that means. But last but not least, we have a very interesting example of animals and the menagerie in the world of finance, and this is swans. You know that swans normally are white, but there can be some black swan. In fact, you know what? I think I saw one. Where is he? Somewhere around here I saw him. There he is. There he is. You see? That's a black swan. Okay, so a black swan in finance is actually something you don't want to have, because it's a very unlikely event, but if it happens, it has very nasty consequences. So we'll talk about black swan when we talk about gold, for instance, and the cases of hyperinflation, you know, something which has a very low probability of happening, but if it does happen, then it has very, very ugly consequences. So, just to show you with a few examples of these animals that finance can actually be very lively and fun, and you'll be able to tell some nice and funny stories to your friends and family. Hi everyone. Well, if learning is about avoiding making mistakes, let me illustrate with this short video a few common mistakes I've encountered in this world of finance. So these mistakes include adding percentages, and you will see what I mean in a minute, or not treating the currency as a separate asset class, so not taking it as a separate decision. And finally, and more importantly, last but not least, the fact that we make very often a confusion between low and cheap and high and expensive. Okay, let me start with the first mistake. And this I will put in the form of a quiz. And the quiz is as follows. Let's assume that in year one, you lose 50% on your investment. And in year two, you make plus 50% on the same investment. Now, quiz to you. At the end of year two, are you back to square one? Are you on the same foot, on the same level in terms of your capital? So I give you 30 seconds to think about this. So in the same spirits, let's assume that you have the following path of returns year after year. So year one, you lose 10%. Ooh, year two, even worse, you lose 45%. Year three, you gain 20, and year four, you gain 35. Now, question to you, same spirit, same kind of reasoning as if you've answered correctly the quiz, the previous quiz, you should also be correctly answering this one. Year five, what is the needed return for you to get back to the same level, I insist here in terms of level, of your investment as when you started, so prior to year one? So you see that adding 10, minus 45, plus 20, plus 35 is 0. So there's a first temptation to say, hey, we're back to square one, you know, adding all these percentages makes 0, so I'm back to my initial investment. So I just would like you to check if this is correct. Okay, so you get the answer to quiz number 2 if you have correctly answered quiz number 1. And the idea here is very simple. If you lose 50%, assume you have $1,000 which you invest in a given stock, okay? And you lose 50%. So your investment goes from 1,000 to 500. Then to get back from 500 to 1,000, you don't have to, unfortunately, increase by 50%, but by 100. So minus 50 plus 50 is not 0. It's actually much less than that. But minus 50 plus 100 brings you back to your initial investment. So beware, you don't add percentages. Percentages are not apples which you can add. They're different animals. Okay. Mistake number 2, I've called that mind the currency gap. Okay. And I will illustrate this with a couple of charts on Japan. Why Japan? Because in Japan there's a frequent call which is made. It has been and still is a country which relies extensively on its exports. So a frequent call that we can find buying Japanese equities is to buy them when we expect the yen to weaken, because if the yen weakens, it will cheapen the exports, so the country will be able to export more, and hence companies which are export-oriented will benefit on the stock market. Okay. So let's assume that you're in early January 2013, and you expect the yen to weaken. So you're on the lookout for a company which relies heavily on its exports, and you find these. Okay, Japanese automakers, the obvious call. Okay, so first decision you have to make is which you could put a basket and choose the 6 if you don't know which one to choose. Or alternatively, you can have a look at these different brands and maybe, well, there's one actually where there's no name. You have the sign, you know the sign, right? That red kind of triangle. Oh, it's Mitsubishi. Oh, you think, oh, wow, interesting. The company has gone through some problems, defect. They had to bring back their cars for checking, and all that. But that's the past. We are January 2013, and so you want to bet on this firm. Okay, so you buy the stock. You go and Google and you find out Yahoo Finance, and you find that you should buy this company, Mitsubishi Corp. Okay, so you buy it, and this is your return. Up until May 2013, you make just under 20%. Okay, so you're a happy man or a happy woman. So you're a happy investor. Right, but that was a mistake actually. Mistake number 1 here, you picked the wrong stock. You can see this on this chart. Actually, you should have picked Mitsubishi Motors, not Mitsubishi Corp. For Mitsubishi Corp is a conglomerate. It's an industrial conglomerate, which is actually virtually everything, including finance, energy, food, you name it, they're in. But not automotive. It's a separate company. And you see that actually Mitsubishi Motor, well, in over just 5 months, you would have doubled your investment. You would have from 100, you see that chart here, the red line, it's rebased, both lines are rebased to 100. The red line goes to 200 by May 2013. Okay, bad luck. So you made just under 20%. And, well, if you had picked the right stock, you would have doubled your money. Okay. But still, I mean, you're a happy investor, right? Because if you go up until, say, you've made a decision to go up until the end of 2013, and we see that at the end of December, you basically have the same kind of return, just under 20%. You're happy? Well, actually, there's one thing which you need to know here is that you bought the stock and the stock is labeled in yen, but say you're a European investor, right? Or your currency of reference is the euro. Either you're French, you're Italian, German, whatever. Okay, so you bought the stock in yen and you're counting it in your account in euros. So what you need to know is that the yen will move against the euro, and that was precisely your bet, right? The bet was that the yen would weaken, and if it weakens against the dollar, against the euro. So, quiz to you here. Look at this chart. This is the evolution of the yen versus the euro of the year 2013. Now, question to you, has it weakened or not? This is a quiz to you. So, now you know that this is yen per euro. So if the number increases, it actually means that you need more yen to purchase 1 euro. So initially, In January 2013, you needed 150 yen to buy 1 euro, and at the end of the year, you need just over 140 yens to buy 1 euro. So the yen has weakened. So this is why actually the call for buying export-driven companies was a good one. But in the end, the picture is not so rosy. Why? Because if you look at the chart, you see Mitsubishi Corp, rebased to 100, has increased to just under 20% on the left-hand scale. We see the yen has weakened. So basically, the line you want to look at is the red line, because it depicts the performance of Mitsubishi Corp in euros. And that's on the left-hand scale. And you see it's gone from 100 to 95. So actually what you've made just under 20% on the stock, but you've lost more than that on the currency. So in the end, you lost, basically. You made a loss. So the correct decision is to buy the stock and hedge the currency. And we'll see that when we'll talk about currencies. You need to treat them as a separate asset class. Oh, by the way, in the end, it made no difference if you'd bought Mitsubishi Corp or if you'd bought the right stock, Mitsubishi Motors. As you can see from this slide, you see that the latter, Mitsubishi Motors, went for a staggering rally up until May, and then the stock collapsed. Why did it collapse? Well, it goes back to all the problems they had with the cars. They had to repair them, take them away from the market and mend the cars. And basically in 2013, following all these technical problems, they took the decision to withdraw from the US market, and the stock was heavily penalized on the stock market. So in the next video, we'll see another frequent mistake which is made in financial markets. Hi again. Here I want to show you with this short video another common mistake which is made in financial markets. It's the confusion between low and cheap and high and expensive. Let me illustrate this with the following chart. The blue line on this chart is the world index for equities. It's called the MSCI World Equity Index. You see that it has been rising from a base. It's rebased to 100 on January 2004. And you see that it's been rising steadily up until summer of 2007, on the whole by 60%. Okay, now take a look at the red line. The red line is depicted on the right-hand scale. And basically, this line is telling you a very important concept on the stock market, i.e. to measure how expensive it is. And basically, it's the ratio of the index divided by the earnings of the company which form the index. So it's what we call a price-earnings multiple. So with this ratio, we are measuring whether the stock market is expensive or not. The higher the ratio, the more expensive the stock market. Why? Because you're paying a higher multiple of the underlying earnings of the company. So, for instance, you see January 2004, the red line stands, look on the right-hand scales, at roughly 17 times. We say you pay 17 times earnings, the stock market, okay? See, the stock market has been rising up until 2006, summer before there's a slight correction. And you see that the red line has actually been falling. So the stock market here was more expensive before it rallied than after it rallied. After it increased by just under 40%, the stock market after this rise is actually cheaper than before it rose. This is something to know, and it's something that people are not aware. Normally, they say, okay, if the stock market has risen by 40%, it should be more expensive, right?
Well, not necessarily, and this just brings this point home. Now, see even further after the mid-2006, it had a correction, then it resumed the rally, and it went up to 60%. Just before we know what happened then, and we'll see that with the following chart, there was a severe crisis. But you see that the ratio of price to earnings, the PE multiple, is actually lower even at the peak of the market in 2007. It stands at just 14 times. So a stock market can be cheaper at the peak than at the bottom. Or if you prefer, a stock market can be more expensive in a bottom than at a peak. So to get the full picture, you cannot just look at the price index and how it moves, and the higher it goes, the more expensive it becomes. You need to put that in perspective. So this is a quiz to you now. Why is the stock market cheaper after a 60% rise? Increases by 60%, and we say it is cheaper. Why? So the answer is, why is it cheaper, the stock market, after it rose by 60%? Well, simply because earnings rose even more. So if they rose by even more than 60%, the ratio P divided by E, the ratio of price divided by earnings, has actually fallen. This is why a stock market can be cheaper after increasing by 60%. Okay, so but we have to know that if valuation does not give you the full picture, indeed, if we look at what happened next, you see that the stock market actually crashed and went from 160 here, rebased to 100 in January 2004. It went to just 70. This is just in a matter of 2 years. This is the Great Recession. This is the subprime crisis, and actually, it illustrates the fact that the stock market did not come down because it was too expensive, as we just saw previously, but because there was a problem of excessive leverage. People wanted to take too much benefit of this rally, so they increased leverage, and there was a problem in the real estate, as we find out later on with the subprime crisis. So indeed, valuation does not say everything. A stock market can adjust abruptly, as it did here, even if it's cheap. Okay? Fine. Now, in conclusion of these two videos, the mistakes, some common mistakes which you will not make following this course, is adding percentages. And you will probably be very careful when you want to select a company, if you want to select a company you want to invest in. And you're going to also be careful about treating the currency decisions separately. And finally, and last but not least, this is very important, just realize that a stock market or an individual security can increase and can actually become cheaper as it increases. Or conversely, it can fall and it can become more expensive as it falls. If earnings drop by more than the stock drops, then the stock actually becomes more expensive at the bottom. Hi everyone, investment management in a nutshell. That's the purpose of this video. I often get asked whether investment management is an art or a science. Difficult question, to which I generally answer it's a combination of both. And you will see throughout this course that there's a number of tools you can use to assess whether markets are fairly valued, undervalued, whether there are some interesting assets you should invest in. But it's not an exact science. It's also a question of feeling. And when we talk about feeling, we talk about emotion. And that's the interesting thing we have now. We study so-called behavioral finance, i.e. the integration of emotion into a more broader rational thinking. So by the end of this video, you will know what question you should ask yourself if you want to be the investor, or your customer if you want to be in the asset management industry and you are advising clients as to their wealth management. And you will also know about which type of risks you should focus on, because investment management is a lot about knowing the underlying risks of the instruments you're using in your asset allocation. Talking about asset allocation, the key here, and I will give you some elements on this issue, is to differentiate what we call strategic from tactical asset allocation. And you will see in this video what is the difference between the two concepts. So investment management is about knowing your needs, your constraint, your risk tolerance, or that of your customer if you're advising that customer, understanding how each asset class, and we'll talk about that in details, we'll talk about equities, we'll talk about bonds, about cash, about hedge funds, commodities, real estate, how each of these asset class works, and the risks which are inherent in these asset classes. And last but not least, you have to decide whether you want to be an active, what we call an active investor. And by that we mean someone who believes that you can actually beat the market, you can actually do better than the average investor or the market. Or if you want to be a so-called passive investor, i.e. here you're not aiming at beating the market, but you are aiming just at replicating the market. Obviously, the latter option is cheaper than the previous one. We'll see that throughout this course that investment management is about managing risk. And that's indeed the key to successful investment management. There are various types of risks. Country risk, a country can be subject to a political problem at some point, and so the authorities, the government decides to shut the borders, and also there's some restriction on capital movements, so the money you've invested actually cannot be exported out of the country, so that's what we call the country risk. Very often, and indeed in January of this year, we've seen a lot of turmoil emanating from China, a lot of questions whether the economic slowdown there will be soft or hard. And there's some also policy errors possibly which have been made in China with the renminbi, with the yuan. The devaluation is hurting investors' confidence. So there's a lot of turmoil, and it's affecting also markets in developed countries, and that is the market risk. Currency risk also attached to that. Well, there's the currency always, for instance, we'll talk about Japan. We'll see that a call often is to go in Japanese equities if we talk about the stock market, but at the same time hedge against the currency risk, because the policies that favor the stock market actually impact negatively the currency. So you should treat them separately, and you can be positive on the stock market but negative on the currency because there's a currency risk. Liquidity risk, if you're investing in what we call small caps, i.e. firms which have a small capitalization on the stock market, well, the problem with these is that their liquidity is less. And when everyone is rushing for the exit, sometimes everyone wants to sell and nobody wants to buy. So these stocks get hurt really badly when there's what we call a bear market. And you will see that what we mean by a bear market. There's also the inflation risk. We'll see that in details when we talk about bonds. Clearly, if you're investing in a bond, you'll get your capital maybe in 10 years' time. Maybe you will demand a higher interest rates because over the period there may be some inflation down the road which will impact negatively your capital when you get it back. There's also what we call a shortfall risk. That is the risk that your capital undershoots your target. You have some needs. Maybe you're a retired person and you have some income needs that's important for you, and If you're below that, well, it hurts your annual income, and that can be a problem. The key here to manage all these risks is diversification. Clearly, that's a rule that comes regularly. If you put all the eggs in the same basket, at some point you get a problem, okay? So we'll see that investment management is a two-step approach. On the one hand, you have your objective, you as an investor, or your client's objective, if again you're advising a client on his wealth management. And that, the profile, you know, the investment horizon, the risk tolerance, whether you're shooting for income or for growth, all that defines your profile, and that goes into what we call your strategic asset allocation. The outcome will be maybe that you need, over an horizon of 5 to 10 years, the optimal asset allocation is 10% cash, 40% fixed income, and 50% equities. Once you've defined this strategic asset allocation, then you move on to the tactical asset allocation. And here, it's basically something that you will adjust. We talk about underweighting or overweighting the US market, the Japanese market, emerging market debt, so the various components which enter the asset class, and you do this by looking at the macro picture, by looking at valuation and things like that. And the two combine, the strategic and the tactical asset allocation, form what we call portfolio construction. So investment management is a lot about knowing yourself, if you're the investor again, or knowing your customer. What kind of investor are you? Are you looking for income? Are you looking for growth? Do you want to be implicated in the investment process, or do you rather give that to the specialist that works and does the wealth management for you? And again, you have these two things that you should differentiate. You should shoot for a strategic asset allocation for the long run, but then adjust this asset allocation on a tactical basis, depending on what you view, the macro picture, some technical analysis possibly also that you can be used as a complementary tool, market volatility, market events, and valuation. Do you believe that the US market is too expensive, or the European one? Things like that that help you adjust the markets and your bets on a tactical basis. Hi again. Well, when talking about knowing yourself or your customer, that reminds me of when I was first interviewed to work in a bank, in a Swiss bank. I was asked by the human resource director whether I was a hunter or a farmer. And I thought, well, what kind of question is this? I thought this was strange, and I asked him what he meant by that. And he told me, well, a hunter, and you see here a picture, is someone who's quite extrovert. You know, he spends his time outside the bank. He doesn't spend much of his time inside the bank, but his main duty is to go out and get customers, find out customers, which he then brings into the bank and gives, in brackets, to the farmer. And what is the farmer? The farmer is a specialist. He works mostly within the bank, and he's mostly sitting at his office and managing the portfolio. So when we talk about, in French we say un gérant, a manager, a portfolio manager, we have to differentiate whether this person is actually looking after customers or whether he's actually managing the portfolio. Two different concepts. So knowing whether you are a hunter or a farmer also applies to when you have to take the decision of whether you want to be the person who actually manages his own portfolio and spends most of his time behind the screens and checking whether markets are going in the right way and there's no problem and you have to actively manage the portfolio, or if you want to spend more time outside doing other things than being directly involved in managing the portfolio. So investment management is a lot about knowing also yourself and what you want to do with your wealth or that of your customer. Here I give you just some key takeaways when you invest with bonds, and we will come back in details when we look at the various courses on bonds. The first of the key takeaway is that you should be cautious about benchmarking, what we call benchmarking in bonds, in the bond market. What do we mean by that? Well, basically, there's a problem if you look at indices. In these indices, we find countries. And the problem is that the more a country has problem with its debt, the public debt increases, then the weight will increase in the benchmark. I give you one example. If Greece has a problem and its debt rises relative to GDP, then there will be more, the weight of Greece in the benchmark will increase. So if you follow the benchmark, you will allocate more money to Greece. So if you are benchmarking in the bond market, then it means that you allocate your investment increasingly to the countries who have debt problems. So that is an issue that you should be aware of. Linked to that is the fact that you should always consider what is the quality of the borrower you're lending money to. For instance, if you don't believe that Greece is capable of giving back the money you're lending them when you purchase a bond, then be cautious. We'll also see in details that there's a simple way to assess whether bonds are interesting or not, and that's to look at the initial yield. When the initial yield is low, then we will see that it's a very good indicator that the bond is expensive. And if that yield is prone to rise, then it will hurt your investment in bonds. So the lower the initial yield, the poorer the return down the road when investing in bonds. And finally, we'll see when we talk about the link between the financial markets and the macroeconomy, we'll see that the best time to buy bonds is when you're expecting a slowdown in economic activity. So much for bonds. Now, some key takeaways before we look at the conclusions in terms of when you're investing in equities. And again, we'll come back in more details when we discuss about the various equity market. Again, here too, we should be aware, you should be cautious about benchmarking also in the equity market. There's a link here when you have to decide, and we'll see that in the next slide, whether you want to be an active or a passive investor. A passive investor, again, replicates an index. An active investor actually tries to beat that index, the benchmark. The problem here with benchmarking is that sometimes people are buying the same kind of stocks. These stocks make them more expensive, the action of that everyone, what we call herd behavior, everyone buying the same stocks. So the valuation of this stock rises, and at some point it becomes too expensive. But given that it's in an index, people keep on buying those stocks, and so these stocks become increasingly overvalued and at some point a risk. I remember, for instance, at the peak of what we call the tech bubble in the 90s, the largest stock in the European index was the company Nokia, the Finnish company, the telecom company Nokia. It was the number one. So everyone was buying that stock, even though it was trading at huge multiples of its earnings, more than 100 times earnings. We'll see what that means when we talk about valuation. And so it was incredibly overvalued, but it was the largest stock, so everyone benchmarking was buying the stock. So be careful when you're following that kind of approach, because you might end up chasing some really overvalued companies. We'll see also when we talk about the link, again here, between the economy and the equity market, that what often people think that you should go, for instance, in emerging markets where growth is actually stronger, that's not necessarily the case. Strong growth does not necessarily bring high returns on the stock market, and we'll see why. What else? That's something also very important. That is, you find in nice little prints everywhere when you're buying a fund from a bank, investment fund, or from an asset manager. It says it's compulsory, it's mandatory. They have to mention that. Past performance does not reflect future performance. It's not indicative of future returns. And this is a tendency that I found very, very, very often. Sometimes we look at an investment fund, or a share, and we see that it's been rising phenomenally. And so we have a tendency to buy that because it's been performing very well. But again, past performance is not indicative of future performance, and the future can be sometimes very different from the past. And indeed, if you are if you don't believe in efficient market and you don't believe that the best way is just to be a passive investor, that's an if, it's a debate actually, we'll have more on that, then you should look for the truly active manager. Because we'll see that sometimes we get what we call some managers that actually are close to the benchmark and but ask for actively managed fees, so higher fees than if it was just a passive replication of the benchmark. Okay, so in conclusion, successful investment management is about knowing how each instrument works when we talk about asset allocation. So each bucket in the asset allocation, whether equities, whether bonds, whether cash, etc., you need to know what are the main characteristics, how they work, what is the liquidity, what are the risks implicit in each of these buckets of the asset allocation. But I would say even before going into the details of asset allocation, whether tactical or strategic, the first decision that you have to make is whether you want to be part and parcel of the investment process, of the investment management process, or if you want to delegate that decision to somebody else and just monitor the result. But even if you delegate that decision, you want to know whether you are actually believing in active management, whether you want to actually select some funds which will try to beat the market, maybe because you're scared that at some point this benchmarking leads you to invest in overvalued companies, or whether you're shooting for a more, I would say, traditional approach of being a passive investor because you want to pay less fees, because obviously active management is more expensive than passive management. The key in all this is risk. Knowing about the risk tolerance, how much you're ready to lose on a given investment or on your portfolio, and the various risks. We saw here a few examples, market, currencies, and so forth, and how you can hedge against those risks.
So welcome to this video on the role of financial markets. I think we will try to explain together what is a financial market, what makes it special, what are the main players in these markets, what are their characteristics, how they have evolved over time. And then in a second stage, we'll turn to a more theoretical function of these markets, namely what functions do they fulfill in the economy, and to some challenges faced by their future developments. So let's look at the first picture. You see a financial market on the left side. That's the traditional definition. It's a physical place where you can trade instruments. Basically, you can buy and sell stocks, bonds, convertible bonds. And this is the way the New York Stock Exchange used to function, the London Stock Exchange, the Swiss markets. However, this picture doesn't correspond to the current reality, where most of the trading is done virtually and is computerized, but still fulfills the role of exchanging securities between buyers and sellers. So precisely, let us look at who are the main market participants. We have four main participants. First of all, a firm. Think about Alibaba Group, who wants to levy some funds to develop some new online payment facility. It will need to raise a lot of capital and will proceed with an initial public offering where investors will bring their savings to the Alibaba Group. The second type of participants are, of course, the investors. So it can be Mr. or Mrs. Smith, it can be a pension fund, it can be a government. These are the people who allocate their savings to productive investment opportunities, but who can also sell their shares between themselves, and that's what's going to occur, as we will see, on the secondary market. The third actor or participant is perhaps less obvious. It's the government. Why does the government have a place? The government has a place to ensure market integrity, to protect the investors, and to make sure that prices correctly reflect the fair value of securities and protect investors against abuse. And finally, we have on the right lower corner of the picture the financial intermediaries. That means all the chain of brokers, market makers, banks, and institutions that make the interface between investors or between the investors and the firms. So this structure has not very much changed over the centuries. We still have these four actors being active to different degrees. Now, one important characteristic of these markets is that we have a primary market and a secondary market. So the primary market is really where the transfer of resources to productive investment opportunities occur. Now think about the IPO that Facebook launched in 2012. It's the first time it went to the market and collected a large pool of money from investors. Of course, once it has launched the IPO, securities of Facebook were traded, and they can trade any day. It could be in March 2015, it could be in December 2015, or in January 2016. The idea of the secondary market is to allow investors to trade among themselves, to buy and sell securities, mainly for liquidity reasons and for portfolio reallocations. So what about the size of financial markets? I'm going to talk here about global equity markets, and one way to do that is to look at what is called the global equity value or the market capitalization. And you can see that it started in the early 90s at 10 trillion US dollars. It peaked before 2000 pretty smoothly, and then we had a bust with the dot-com bubble exploding. Again, a steady growth until 2007, and again, a decline of about 45% due to the subprime crisis, and a slight recovery. And we can see that the markets are worth together today roughly 40 trillion US dollars, which is quite a sizable fraction of the economy. So what does this value of 40 trillion US dollars mean in terms of global equity value? Is it a large or a small number? One way of measuring the degree of financiarization of a country or of a worldwide economy is to look at the ratio of the global equity value to the gross domestic product. And if you see on average, this ratio has been quite steady, around 20% until up to 2002, 2003. It has peaked to 50% before the subprime crisis and is now again trending down to about a level of 30%. But of course, there's great dispersity across countries. Some countries which are highly developed with their financial markets have ratios of equity value to GDP of about 120%, like the US. Some would have much lower. Take the example of India. The number today would be closer to 70% for India. So I think at this point we've seen several characteristics that characterize the financial markets, their developments, their growth, the degree of financiarization of an economy. So in the next video, we will focus on a more academic question, which is the question of the functions that financial markets perform and what is their value added for the economy. And that's the points we will address from now on. Okay, so welcome back to this video on the role of financial markets. We're now capturing the second part of this course, which focuses on the key function of the financial system. For this purpose, we're going to look at the definitions that are provided by Merton and Boddy in their book called The Global Financial System. And I think they give a so-called functional perspective of the role of financial markets, which basically says that even though the structures, the institutions have changed, the functions performed by markets have stayed the same over time and will remain the same. The core function being the fact that a financial market serves to transfer resources, namely savings from investors, to firms, corporations that need to make investments. But besides that, there are four other functions, functional functions, that we will now address one by one and try to illustrate as simply as possible. So the first function is the pooling of resources and subdivision of shares. What do I mean by that? If Alibaba Group makes an IPO, it needs to raise a lot of money. So you need to pool money from a lot of shareholders, little investors, institutional investors to be able to raise such amounts in terms of billions of dollars of market capitalizations. At the same time, investors would like to invest in small amount of shares of Alibaba to stay diversified. So you need this subdivision of the shares to make the investors happy and well diversified. Now, the second purpose of or function of financial markets is to transfer resources across time and across space. So across space, it's easy. I can be a Swiss investor investing in China, so that's across space. Across time is easy as well. I can invest now to buy the next iPhone Plus to my daughter in 1 year because she wants an iPhone 6 Plus. I can also invest now for my retirement age, and the idea is to generate returns from my investments in the financial markets through these productive returns. But of course, this happens also with uncertainty. When you invest in financial markets, there's going to be risks. So the next issue that we are faced with and the next function that financial markets will provide is to help us manage risks. So one way of managing risks is, as they say, don't put all your eggs in the same basket, but diversify. So you need a diversified portfolio. The second way to manage risks, as we will see, is to use derivative products that allow you to insure your portfolio against a drop, for instance, in the S&P 500. The third way of managing risks is through securitization, another function that financial markets may perform. And the last point, which is important, is that markets provide information. Every time that you trade, that the buyer and the seller meet, there's going to be a transaction price. That price informs you on the value of a firm, first a stock, but if you multiply by the number of shares, it gives you, hopefully, the fair fundamental value of a corporation, and you could be able then to say whether this corporation, in your opinion, given your beliefs, is overvalued or undervalued. So information for the investors, but also information for the firms, because through this price, the firm can infer what its cost of capital will be in the future. So what are well-functioning financial markets? There's a lot of desirable criteria that financial markets should have. They should be transparent. they should be fair, they should avoid insider trading, and they should prevent market abuse. So let me talk about all these criteria one after the other. First of all, transparency. It's very important that all participants at any given point in time have all the relevant information on the prices, the volume traded, the bid-ask spreads, the order book, in order to assess the aggregate risks in the economy when they trade. Trading technology, this is a big issue on which I'm going to talk about in the next slide as well. We have people who trade with older technology, we have high-frequency traders who trade with modern, very speedy technology. There might be risks of front-running. So the high-frequency trader may front-run the retail investor, and this is unfair, right? So we want to avoid this type of front-running behavior. Insider trading has existed ever since companies were quoted on exchanges. Basically, a CEO, a board of director may have privileged information, and he's not supposed to trade on this privileged information to make money before the public and the broader shareholders can make money from public information. And finally, market abuse. We've seen many scandals, the fixing of the LIBOR, the fixing of foreign exchange rates. Every time institutions, banks collude to fix a price, it distorts the pricing discovery mechanism for investors and for companies. So clearly, this has to be avoided. But suppose all of this was resolved. There was no market abuse, no fixing, transparency, access to the same technology. Would this solve all the problems? Well, if you look at the pictures I've shown before, there's two big elephants in the room, in the sense that you've seen the dot-com bubble burst in 2001. You've seen the 2007-2009 financial crisis. And these were two big, very volatile events since 2000, which cannot be rationally explained unless you're willing to assume that there were bubbles. In other words, that markets, in one case the tech market, in the other case the housing market, was overvalued. So sometimes market values do not reflect the fundamental values of an economy, and that's something we would like to prevent. So what are the future challenges? In some sense, they're not only future, they are also old challenges for market participants. The first one is we would like markets to be efficient. That means that at any given point in time, the price reflects instantaneously the true fair value of the corporation. Obviously, when there's a bubble, this is not the case. How do we prevent that? Well, you could say markets can self-regulate, and a lot of people believe that through market discipline, you will be able to enforce efficient markets. Other people, especially since the financial crisis, are more skeptical. They believe in more regulation because there's been a big market failure during the 2007-2009 subprime crisis, and we had a lot of other scandals since then that have actually questioned the ability of markets to self-regulate. Another interesting question, I think, for financial markets, if you talk about markets for apples or oranges, if you talk about markets for commodities, there hasn't been much innovation. If you think about financial markets, there's been two types of innovation. Product innovation, think about derivatives. You had plain vanilla derivatives, exotic derivatives, OTC, CDO squared, securitized securities. And there's been also innovation in terms of the trading mechanisms and the computerized trading facilities that are used these days. So the question is innovation always good? Can it solve some of these problems? Can it make market more efficient? Some people claim yes, some people say no. I think it is too early to conclude, but these are some of the challenges that hopefully you will get a better insight into by following this online course. So thank you for staying with me until now, and I hope you'll enjoy the rest of this course.
Hi everybody, my name is Olivier.
Hi, I'm Ines.
Okay, so what we will do today is we will look at a sequence of 6 videos, and we will focus on some basic concepts in finance. So why is it useful to look at these basic concepts? Because this will allow you to make good investment. And when you have made good investment, you will have in fact a high reward, and with that high reward you can invest in something else, like for example goodies like for example these gold shoes, and they are really solid gold shoes. Or we are in Switzerland, you can in fact buy also a Swiss watch. So this is what we will do today. So the first concept that I will look at is a return. So what is a return? The return is simply the relative increase or decrease in a stock price. So for example, if you go from 100 to 101, it means that you will have a return equal to 1%.
Now that you learned how to compute a return, let's see how we can make an investment decision between 2 stocks. So we have here 2 stocks, stock A and stock B, and 3 monthly returns. And stock A is giving me a return of 13% the last month, while stock B is giving me only 2%. So let's take a poll and see which stock will you go for.
Okay, so probably most of you have chosen stock A instead of stock B, because most of the people just focus on the last performance. And here indeed the last performance was 30%. A lot of people just concentrate on that. But if you look at the average, so typically here it will be the sum of the 3 returns divided by 3, the average return is higher for stock B than stock A. So what you should have done is to look at the past and not just focus on the last performance. And here in fact the past tells you that you should choose stock B. So what are the learning outcomes of today? So first of all, we saw what is a return, and this is a key concept in finance. And then we saw as well that we should look at the past and not just focus on the last performance. So hi again, so welcome back to this second session on basic concept in finance. So what we'll try to do now is to illustrate on real data what we saw in the first session. And Ines will talk about the differences between emerging markets and developed countries, because she's really a specialist in emerging markets. So Ines, you have the floor.
Thank you, Olivier. So we learned with Olivier's presentation that you should not be focusing on the last observation. You'll be missing a lot of information that you can summarize with the mean, with the average. So let's look at some real data. Our first example is France. If you look at the last return in the French stock market, it is about 12%. That's quite high. While in Bulgaria, an emerging market, you would have achieved a negative return.
So what you are telling me, Ines, is that in fact I should buy France instead of Bulgaria?
Wait, Olivier, but what you told us is that we should look at the average, because the average return will summarize all this data better than just looking at the last observation. That could be just an outlier, so maybe something wrong was happening that month in Bulgaria. If we look at the average return, at least for the last 4 months, so that's gonna be a higher average return in Bulgaria. So if we rely just on this data, it seems that Bulgaria is a better investment than France. Let's look at another example. Germany. Germany last month had a low return, while Czech Republic had a high return. So again, I might be tempted to go and invest in Czech Republic just based on this last month return. But actually the average return in Germany, as you can see, is higher. And our last example is that of Spain and Ukraine. So if we look at the last month return in Spain, that's quite negative, a bad return of negative 5%, while in Ukraine, that was a high last month return. But again, we should be looking at this average return that is influenced by all these 4 months. And we see that we have a higher average return in Spain compared to Ukraine. So as you see, the average return in Spain was higher than in Ukraine. And based on this data, Spain would have been a better investment. So what can you tell us, Olivier, to summarize?
Okay, so let me summarize what Ines told us. And it was, in fact, an illustration on real data on what I told you during the first session, so that you shouldn't just focus on the latest return, but you should really look at the average on the long period. Otherwise, you will probably do a very bad investment, and this is what you don't want to.
The other thing also, Olivier, that we noted by looking at this data is that there is a lot of variability. So we should not be looking just at the average return, especially with emerging markets. And that's what you're going to tell us in the next video,
Exactly.
Right?
So this is indeed correct. So what we will do in the third session, that you will learn in a few minutes, that we should also look at the risk, and this will be the third topic. Welcome again. So let us start with the new notion, the new basic concept in finance. I will talk a little bit about risk. But first of all, Ines will talk a little bit about, again, a poll.
So now we have 2 stocks. One is giving me different returns at different each month. And one is giving me the same return, 5% every month. So in terms of average, as you can see from the table, both have the same average return. Which one I should go for? So let's take the poll.
Okay, so in fact, this was really an easy one. So most of you have indeed seen that you have a constant return. So this can be associated to a risk-free investment. And most of you has indeed picked the right choice, which was here, stock B. Okay, so the first poll was in fact quite an easy one. So let us look now at something a little bit more difficult, and Ines will introduce again a poll.
So now we have 2 risky stocks. The first stock, stock A, has a return on 1 month of 10%, but the previous month was at 7%, and the next month was at 13%. Stock B had a middle return of 10%. The previous month was at 9%, and the next month was at 11%. So both looks risky because the returns are not constant, are changing. Which one you would go for?
So as I told you, this was in fact a little bit more difficult than the previous poll. And we can see that indeed the results are quite mixed, but the good answer is, of course, stock B again. So why is it stock B? It's simply because we see that the returns are more close to the central value for stock B than stock A. So this is in fact an indication of variability. So how do we talk about variability in finance? We talk about volatility. And this is a concept that you will see in fact later on in the MOOC with more explanation about how we measure risk, how we should do investment based on that.
Okay, so now Olivier told us that we should go for the higher average return, that we dislike higher risk. Is there a way that we can make a decision?
Yeah, in fact, there is a good way indeed. So what we should do is to look at the trade-off between reward and risk. And so what is the easiest way to do is just to take the ratio. So you take the reward divided by the volatility, divided by the risk. And what you will pick, of course, is the highest ratio. So this is very easy to implement. So what are the learning outcomes from this third session? So we saw that we should, of course, look at reward, but we should also look at risk. And there is a trade-off between reward and risk. And this is the learning outcome of this third session. So welcome again. So what we'll do now is, as in the second session of those basic concepts in finance, we look at real data, because it's good, of course, to look at illustrative example just for pedagogical purposes, but it's even more important to look at real data. So let us be a little bit more wild and let us go to the USA and Brazil.
Yeah, so what we learned from a previous presentation of Olivier is that we should not only look at higher average return, but we should also consider how spread out the data are. Tell us something about the risk of the investment. So now if we look at the US, the average return over the last 40 months was about 1%, but it was 3 times higher in Brazil at 3%. If we look at the risk now, you see that US had a volatility or a risk of only 2%. And Brazil was 6 times riskier at 12%. So if now I look at these numbers, I have a higher return in Brazil, but also higher risk, and actually more risk than return. So let's look at how I make this trade-off between risk and return. So if I take the ratio of return to risk, I see that I end up with a higher return-risk ratio, which is about 50% in US compared to only 25% in Brazil.
So thank you very much, Ines, for this first example. So now let us look at the second example, and we will look at Canada and India.
So another case of developed versus emerging. So Canada now has a return, an average return again over last 40 months, about 2%. Slightly higher actually in India. In India, the average return was 3%. And based on this data, it turns out that in terms of risk, the two markets have the same risk, about 7%. But if I look at the return risk ratio, which is obvious here because I have higher return, slightly higher return in India, it turns out that India, based on this return risk ratio and this data, is a better investment.
Okay, so thank you very much for this very interesting second example. So now we'll look at the third example, and we'll go to South Korea and Egypt.
So now we have one of the largest emerging markets, South Korea, and one that is still emerging, Egypt, and we want to see how the returns and risk compare in these two markets. So we see that the average return over the last 40 months was about 1% in South Korea. It was twice as high in Egypt, so it was at 2%. While the risk, it was at 5% in South Korea, and again, it was twice in Egypt. So we have twice as much as a return as in South Korea, but also twice the risk of South Korea. So in terms of return risk ratio, we end up with the same number. So for South Korea, that's 1 divided by 5, that's the 20%. And for Egypt, that's 2 divided by 10, again, 20%. So you have the same return risk ratio. Which one you should go for? Here, we're considering this return risk ratio, but actually, we are different. So some investors would put more weight into higher return, some others would put more weight into lower risk. So it really depends on your preferences. And the way we capture this in economics is this concept of utility. Okay? So the other thing also we should watch is that we're only looking at the mean and the volatility. But it's also important to look at other characteristics of the data. And that's what we're going to learn next with Olivier.
Yes, indeed. So this is what we will see in the next video. So just to summarize what we saw in this fourth session, it's that, in fact, it's very easy. You have very easy tool to use in order to look at reward and risk, because you just need to compute an average and a volatility. And then by looking at the ratio, it means that you can select a good investment. So welcome to this fifth session on basic concept in finance. So what we learned previously, we learned about risk, we learned about reward, and now we'll see in fact a third notion, which is the full distribution. Okay, so if you remember the mean, we just look at what is coming in average. When you look at the volatility, you measure in fact the scale, so how broad are your return, how broad are your data. So now I will introduce a notion of the histogram. So how do we build an histogram? In fact, it's very, very easy. So the first step that you do is you look at the horizontal line, you chop it in intervals, and then what you will do is simply count the number of observations, the number of returns which fall in each of those intervals. And then you divide by the total number of observations that you have. When you do that, you will get a number, and that number has a very simple interpretation, which is a frequency or a probability. So when you read on the vertical axis, when you read the number, it will be a percentage, and that percentage corresponds to a probability, to a given amount of chances. So this is in fact the notion of an histogram. So how can we use that histogram? So it's very simple again to use, because what we can do is just look at the tails. Okay, so we'll have the good tail, which will be the right one, where we will have a lot of positive return, and we'll also have the left tail, which is the bad one, because we'll have negative returns. And so the histogram allows you to gauge, so what is the probability of having extreme events, either good ones or bad ones. And of course, the one that we want to avoid are the bad ones, because in finance they correspond to crashes. So the second use of the histogram is also a way, and a visual way, just to look at how the distribution is skewed. So do I have more probabilities in the right tail, or do I have more probabilities in the left tail, or do I have a symmetric picture? So this is the notion of skewness. So let me summarize what are the learning outcomes of today. We have just learned that we have a very simple tool which is called a histogram that is very easy to build. You just count the number of points which fall in an interval, and you divide by the total number of observations. This will give you the interpretation of a frequency or probability, and then by looking at the full picture, you can have an idea about fat tails. So do I have higher probability in the tails, or do I have skewness? So do I have an asymmetry between positive return and negative returns? So welcome back for this sixth session on basic concepts in finance. So as in session 2 and session 4, now what we'll do is look at real data to see what is going on when we look at real figures. So we learned that we should look at reward. We learned that we should look at risk. So now what we will do is to extend that and look at the full picture, the full distribution. And Ines will introduce an example based on Belgium and Russia, and she will take you to a new poll.
So our poll is now simple, that you understand this trade-off between return and risk. And what you have here is that the average return on the Belgian index was at 2%, for a risk of 8%. For Russia, the average return is about 4%, but for a risk of 10%. So which one is a better investment? You probably see that, based on what you learned, that the higher return to risk ratio for Russia would tell you that that's maybe a better investment. But let's look at the histogram of the distribution of returns for these two countries. Let's start with Belgium. If you look at Belgium, so what we did is what Olivier told us. We have 5 years of monthly observation, so that's about 60 data. We distributed this data into 5 equal intervals, each of 5% width. And we see that there is a higher probability for having a return between 0 and 5%. But look at what's going on in the left tail. There is some probability of bad return. It can go as bad as negative 15% for Belgium. How about Russia? If I look at Russia, actually, look at the scale now is a bit different. So now the width is about 10% of each interval. So you see that for Russia, we have more of this returns that is skewed to the left. So we have more of this negative skewness. And what is even more important is that we have a fat tail, a higher probability of negative outcome, of a big loss. And that it can go as bad as negative 40%. So we have some probability of having a negative return between negative 20 and negative 40%.
So thank you very much, Ines, for this very interesting analysis about Belgium versus Russia. So now let us investigate a second example, and that second example will be about Japan and South Africa.
So again, we're comparing a developed market and an emerging market, and this time we're looking at the histogram of Japan. And you see a higher probability of having a return between 0 and 5% by looking at the histogram of Japan. But again, at least some probability of a negative, quite negative return that goes up to negative 15%. So we have, again, this mean that is pushed to the left, this left-skewed distribution. Let's look at South Africa. What we see here is this higher probability of this negative return for South Africa, and this is the fat tail. So what we learned across this real data is that average return, risk, the tail are different when we look at emerging market versus developed markets. What we learn in the upcoming videos is that investing in emerging markets is quite challenging, and we want to learn more about these challenges and the benefits that we can get from investing into emerging markets. And now we let Olivier summarize the learning outcome of this video.
So thank you very much, Ines. So indeed, I will summarize very briefly what we have learned in this video. So we learn, as Ines showed you, we learn about the average, so the reward. We learn about the variability, which is associated to risk. And we learn as well about fat tailness and the fact that indeed you can have a high probability to have extreme events, especially negative events, which are called in finance crashes. And of course, as an investor, what you would like to do is really to avoid to suffer a crash. Otherwise, you will never see those gold shoes again.
And the Swiss watch.
And the Swiss watch.
Hello, my name is Simon Smiles. I'm UBS's Chief Investment Officer for our ultra high net worth business. Today, I wanted to talk briefly about what clients ideally want from investment managers and what indeed we can actually provide them. Clients ideally want us to make money without short-term drawdowns while getting every investment call right. Unfortunately, achieving even 2 of these 3 expectations is near on impossible. But what we can do is to set up an investment process which gives us the best possible shot of making money with an acceptable amount of risk and getting more of our investment calls right than we get wrong. The first step is to set up a robust internal process. At UBS, we've spent a lot of time developing cutting-edge quantitative models that set the basis for our analysis of whether to be risk on or risk off in our tactical asset allocation. We then have analysts covering every asset class in every major geography and every major time zone who give us bottom-up granular input. And then we have strategists and asset allocators who marry those top-down views and our quant inputs with the bottom-up feedback to come up with our internal investment views. The second step is to build a rigorous external vetting process. At UBS, every month we hold our investor forum. And at the investor forum, we get the world's leading investors to come in and debate markets. We don't impose our views though. Instead, we provide a forum for great investment minds, some of the best in the world, to debate the key issues facing markets. What we hear doesn't necessarily change our investment views every month, but at least once a quarter, we will do something we previously hadn't planned to do, or we won't do something we had originally planned to. and every month it provides us with nuances and new views with respect to both the upside and downside risks to our assumptions and each of our investment positions. In addition, we try and utilize our clients to challenge our macroeconomic assumptions. At UBS, our Industry Leaders Network has over 65 of the world's largest private entrepreneurs, and it's growing. Around half of these entrepreneurs run global businesses, with the rest spread between Asian-focused businesses, European-focused businesses, US-focused businesses, and businesses focused on the emerging markets. Around half of the participants in the consumer space, with the rest spread between materials, industrials, and tech. And every month, we talk to them about how their businesses are progressing and how they see the world. It gives you fascinating on-the-ground input from China, peripheral Europe, and the US. And you see in real time how business activity is evolving. It allows us to challenge our underlying assumptions. And the third key to building an investment process, which gives us the best possible shot of making money with an acceptable amount of risk, is to focus on the advantages private investors enjoy over their professional counterparts. One of those advantages is the ability to deal with illiquidity. Private investors typically don't have the same liquidity needs as professional investors, who must guard against fund outflows that are not in their control. A second advantage is that private investors can also typically take a much longer term view than professional investors, who typically face daily mark-to-markets and career risk if they underperform for even a short period of time. And a third advantage that individual investors enjoy over professional investors is that professional investors are usually tracking benchmarks like US or European equity indices, while private investors are inherently benchmark agnostic. As a result of these advantages, two areas in particular that we focus on to try and find value-enhancing investments for private investors are longer-term themes, which play structural trends beyond most professional investors' time horizons, and are often played via direct investment or private equity, so private investors can in addition enjoy additional illiquidity premiums. And a second area we focus on is trying to take the opposite side of crowded professional investor trades that cause dislocations. One example is protection on US equities. It's structurally overpriced as it's used by professional investors as the default market to buy insurance in. Private investors can take advantage of this and sell the overpriced insurance, using the premium to buy multiple units of insurance on other, less mainstream equity markets, such as Korea's KOSPI 2. In sum, while clients ideally want us to make money without short-term drawdowns while getting every investment call right, achieving at least two of these three expectations is near on impossible. But by setting up a robust internal investment process with rigorous external vetting that also focuses on the inherent advantages private investors have over their professional counterparts, gives you the best possible shot of making money with an acceptable amount of risk and getting more of your investment calls right than wrong. Thank you very much.
Hi there. So in this module, what you will learn is the major asset classes. We'll start with fixed income. It includes also money market. Then we'll move to equities. We'll also look at currencies and how they should be treated, whether it's a separate asset class or not. By now, you should have a little hint of what to answer to this question. And we'll get some notions here of the risk that is associated to returns. So risk-adjusted returns, we will get the first notion. Also in this module, we will find out how to evaluate a company and how we can make recommendations, buy, hold, sell on specific securities. Generally, we talk here about stocks. I'd like to give you an example of risk, and this comes in the form of a quiz. Do you believe that money market instruments, i.e. cash, we often say cash is king, and that people rush for cash when there is a turbulence on the stock market. So do you believe that cash is totally devoid of risk, is risk-free? This is a quiz to you. Think about this for a minute. Do you think that a fiduciary deposit, a money market instrument, has no risk at all? Okay, so To illustrate the fact that money market instruments can be risky, let me give you this example, which I personally experienced while I was head of research in a private bank here in Geneva. This goes back to January 95. At that time, we found out that a trader based in Asia actually made some very risky bets on the stock market. What he did was the following. He was actually a specialist in derivatives, in option trading. And he took a bet. We call this a short straddle. So without going into the technical details on how this works, basically he was selling insurance and he was betting that the Japanese stock market and the stock market in Singapore would not move by very much over the next couple of days. And he did that with a lot of leverage, so borrowing a lot of money. Fine, he was betting on that. So he was betting on stability. But what happened, and that's a black swan, actually. It's a very unlikely event, as we've seen in the videos, remember, with these animals and the black swans. Well, this is a black swan that happened, the earthquake in Kobe. And this is January 95. So when the earthquake happened, the stock market just tumbled. And this trader had immense problems. And what he did is tried to recoup his losses by taking even more risk, okay? And ultimately, the bank he was working for, a UK bank, actually went belly up, and the company had to be sold for just a symbolic £1. Okay, so you're going to say, well, what's the link between this trader losing his shirt and making the bank he's working for go belly up, go bankrupt, a bank going bankrupt, that can happen, and the fact that money market instruments can be risky? Well, at that time, January 95, I was working for this private bank here in Geneva, and we got a call a few days after we find out that the bank has gone bankrupt from this customer saying, actually, you know what? I have a fiduciary deposit which is in the name of this bank, and it was quite a large sum. I remember, just under 1 million Swiss franc. And so this client calls and say, what is now the problem? Is there a problem with my deposit? Can I get the money back? And basically, we had to inform this investor that the piece of paper it had with the name of the bank on it and saying, here is 1 million Swiss franc deposit in this fiduciary account, in this money market instrument, was worth zilch, was worth zero, because the bank had gone bankrupt. So this investor found out that money market instrument can be risky if they are issued by a firm, a company that goes bankrupt. So this is what we call credit risk. So we find out here in this module that this is the kind of risk you can be exposed to even when you buy bonds, that bonds, even government bonds, can default. Corporate firms can default, banks can default, but also government. And so your piece of paper, be it just a bond or a money market instrument, can become worthless.
Hi everyone, my name is Philipp Walter and I'm an assistant professor of finance. So in this session we're going to talk about how much a company is worth on the stock market. There are two main objectives of this session. First, I would like to talk about how we can value simple investment projects using the net present value rule. In the second step, I would like to go further and try to understand how we can value shareholders' equity. But let's first start with project valuation. Have you ever thought about how financial managers decide in which projects to invest or not? Or maybe you yourself were in a situation in which you had to decide whether or not to invest in a project. Well, the most common rule that people are using is the so-called net present value rule. If you have projects, they typically generate benefits and costs. And what this decision rule does, it simply compares the present values of the benefits and costs. And the benefits and costs are typically positive or negative cash flows. So what we need to do is we need to compute the present value of these positive and negative cash flows. We need to sum those present values, and then we have the so-called net present value of an investment project. And then the net present value rule simply states that we should invest in projects that have a positive net present value, and we should not invest in projects that have a negative net present value. Now let's look at two simple examples that help us illustrate this concept. So suppose that we have the following investment project with the cash flow characteristics outlined on this slide. So first we have a cash outflow of 150. That could correspond to the initial investment. And then we have some future cash inflows. So we have a cash inflow of 20, 50, 70, and 70. Now in order to make those cash inflows and outflows comparable, we need to compare them in similar quantities, in cash values today. So what we need to do is we need to discount the future cash flows to the present. If we assume that the correct discount rate is 10% in this case, what is going to be the net present value of this project? Well, let's compute it. We don't need to do anything with the 150 because the cash outflow of 150 is in cash today. So we just need to discount the future cash inflows. And when we do this, we get a net present value which is positive in this case. And that means that this project creates value for the firm, and hence we should invest in this project. Now let's look at a second simple example. In this case, the cash flow pattern is slightly different. We have a cash inflow at time 0 and the first cash outflow occurs at time 1. But in this case, we can proceed with the exact same technique as we just did. We just need to compute the present value of all those cash inflows and outflows. We take the sum of those present values, and then we have the net present value. If we again assume a correct discount rate of 10%, the net present value in this case is going to be negative. This means that this project would destroy value for the firm, and hence we should not invest in this project. So what have we learned in this session? Well, we have learned that if we need to make investment decisions, a simple rule to use is the net present value rule, which simply states that we should invest in projects with a positive NPV and not invest in projects with a negative NPV. Hi again. So now that we know how we can value simple investment projects using the net present value rule, let's go one step further and let's try to understand how we can value shareholders' equity. Now, why should we be interested in this type of question? Well, suppose you would like to buy or sell equity of a firm that is not publicly traded. Well, in this case, you have to come up with a valuation of shareholders' equity, at what price you would like to buy or sell this equity. So the goal of this session is to try and understand how we can achieve this objective. Now, in practice, there are two main methods used to value shareholders' equity. On the one hand, that's the discounted cash flow valuation method. On the other hand, that's the valuation based on comparable firms. Let's first talk about the discounted cash flow method. So how does this method work? So you can think of a firm having productive assets that generate future cash flows for this firm. Now, similar to a net present value analysis, we need to compute the present value of those future cash flows. Once we compute all the present values of the future cash flows that the firm generates, and we sum those present values, we get the firm value or enterprise value. If we're then interested in the market value of equity, we need to subtract the firm's debt, and we have the market value of equity. Now let's be a bit more specific about those different steps. So what type of cash flows do we need? Well, we need the so-called free cash flows. These are the cash flows that are available to all investors of the firm, both debt and equity holders. And what we need to do is we need to forecast those free cash flows over an explicit forecast horizon of n years. Now in practice, this is going to be mostly between 4 and 7 years, depending on the industry. Well, and what happens beyond the explicit forecast horizon? Because we know that firms there exist for a longer time than just for 5 years. Well, for horizons that are further in the future, we need to make simplifying assumptions because these cash flows are very difficult to estimate. And the typical assumption that we would make is that these future cash flows that are further away in the future, they are growing at a constant rate. Let's call it the rate G. And once we make this assumption, we can then compute a terminal value with a simple formula. So we call the Vn the terminal value of those free cash flows that occur beyond the explicit forecast horizon. And what we do is we take the last forecasted free cash flow, we gross it up by one period using this constant growth rate, and then we divide it by the difference between the cost of capital and the growth rate. Now, what type of discount rate do we need in this type of analysis? Well, we need the so-called weighted average cost of capital, which represents the average cost of capital to all investors in the firm, both equity and debt holders. It also represents the expected returns of investors that are investing in the firm's securities. Once we have those ingredients, we can then easily compute the value of the firm, or more specifically, the price of one share. What we do is we can simply compute the present value of those free cash flows by discounting those cash flows and also discounting the terminal value, and that will give us the firm value or enterprise value. Now, once we have the enterprise value, we again have to subtract the value of debt, divide by the number of shares outstanding, and then we get the price of one share. Now let's be more specific. Let's look at an example. So we have a firm that generates free cash flows of 100, 110, 120, 127, and 134 in the coming years. Then beyond this explicit forecast horizon, cash flows will grow at 4%. The weighted average cost of capital is 12%. The firm has $500 million in debt outstanding and 100 million shares. So what is going to be the price of one share in this example? Well, let's implement this discounted cash flow method. What we do is we take those future cash flows, future free cash flows, and we discount those free cash flows at 12%, which I do in this slide. And note that the last term, which is the term 1742, that is going to be the terminal value at that year, so in year 2020. So we have to discount that terminal value as well. So if you do this computation, we get a value of approximately $1.4 billion. Now, how do we get the value of one share? Well, we subtract the value of debt, which in this case is $500 million. We divide by 100 million shares, and we get the price of one share, which is approximately $9. So we have just implemented a very simple discounted cash flow analysis. Now let's look at a second way we can value shareholders' equity. And this is the so-called valuation by multiples, or based on multiples. So the idea of this approach is that assets that generate identical cash flows, they must have the same price. So what we do is we infer the price of the company that we're interested in based on the price or based on the value of comparable firms that we observe in the market. So we can basically proceed in 3 steps. First, we need to find a set of comparable firms. we need to compute a ratio of market value to earnings, and then we can infer the value of the firm we're interested in. Let's look at two specific examples. Suppose that we want to value a privately held company, A.com. So the firm has earnings of 10 million US dollars, and we know that comparable e-commerce firms, they have a price earnings ratio of 20. Now, what is going to be the value of equity of A.com? Well, we just take the firm's earnings, which is 10 million, we multiply it times the price earnings ratio, and we get 200 million. So the firm's equity is going to be 200 million. Let's look at a second example. Now, we have again a privately held firm, B Incorporated. So this firm has an EBITDA of 30.7 million. It has 5.4 million shares outstanding and debt of 125 million. Now, comparable firms in the same industry, they have an enterprise value to EBITDA ratio of 7.4. So what is going to be the price of one share for B Incorporated? Well, what we can do is we can, using the multiple of 7.4, we can compute the enterprise value of B Incorporated. So we multiply 7.4 times the EBITDA of 30.7. This will give us the enterprise value. We subtract the value of debt. We divide by the number of shares outstanding, and we get a price which is going to be $18.92 in this example. So again, we have very easily computed the value of one share based on this multiple approach. So there are other multiples that people are using. The most commonly used multiples are the price earnings ratio, then the enterprise to EBITDA multiple, enterprise value to EBIT multiple, enterprise value to sales, etc. Depending on the industries, people have come up with many more multiples. Now, how do we choose a good multiple? Well, we should typically take multiples that are operating in the same industry in order to make sure that they have a similar operating risk, and we should also try to take firms that are in the similar stage of development, meaning that they have a same expected growth rate. In addition, if we want to use the price earnings ratio, we should also make sure that the firms have a similar financial risk. So what have we learned in this session? Well, we have learned how we can value shareholders' equity with two different methods. With the discounted cash flow method, in which we have to forecast free cash flow, discount those, and we have used the multiples method, which is a very easy way to value one share of a company.
Hi, my name is Mike Ryan, and I'm the Chief Investment Strategist for UBS Wealth Management Americas. Thank you for joining me. Now, in the time we have together today, I'd like to share with you my thoughts on a subject that both interests and confuses a great many people, the stock market. Now, understanding the stock market and how it works is important, even for those individuals who are not active investors. Because a well-functioning stock market is an absolutely essential element in the forming and funding of new businesses, the efficient allocation of capital, the creation of employment opportunities, and ultimately, the long-term accumulation of wealth for society. But before we go into any detail about the stock market, let's first clarify a few points and define a few concepts to make our discussion more meaningful and more informative. First of all, there is no single stock market, but in fact, many different markets around the world with disparate rules, regulations, features, and functions. What they each have in common, however, is that they allow businesses to gain access to private capital financing through public markets. Secondly, instead of thinking in terms of a stock market, it's really more appropriate to understand that what we are really talking about here is a market of stocks. While this is admittedly something of a cliche, it also has the advantage of being an appropriate one. Because while there are many factors that drive the pricing of financial assets collectively, there are other features that will ultimately lead to distinctly different performance within each market. Lastly, there is a great deal of jargon and market speak used by financial market participants that can make things even more confusing when trying to understand the stock market. So I'm going to try to avoid much of the jargon here. But when you do encounter an unfamiliar term, phrase, or an acronym, don't be shy about asking what it means. So let's get started with what we need to know in order to better understand markets. First of all, there are a great many variables that ultimately influence directional moves in the pricing performance of markets overall. So many, in fact, that it's almost impossible to list here. However, there are 4 broad categories that many of these variables and catalysts fall into that I would like to briefly highlight for you. The first is macroeconomic conditions. It's often said that the stock market appears divorced from the realities of the real economy, but nothing could be further from the truth. In fact, employment growth, business investment spending, and inflation all have a critical and primary impact upon market performance. The second is policy choices and decisions. In the aftermath of the global financial crisis, it became increasingly obvious that policymakers can at times play an essential and even dominant role in market outcomes. These policy choices include monetary policy, what actions central banks are taking, and fiscal policy, what are elected officials doing with your money. The third is valuation. Knowing how fast an economy is growing and which policy choices are being made are important market determinants. But understanding how much of that growth and which of those policy moves has already been discounted to market pricing is perhaps even more important. It is therefore essential to also have developed a framework and tools that can be helpful for valuing equity markets. Lastly, there are also technical factors that must be considered as well. Too often, fundamentals, policy choices, and even valuation can be trumped in the very short term by technical forces. These might include flows in and out of mutual funds, positioning within speculative accounts, and even changes in rules and regulations. Just to wrap things up, let me go back for a moment to a concept I touched on briefly at the beginning of our discussion, that is a market of stocks. Because while all of the factors that I've already discussed will influence overall markets, there are other variables that will lead to differences of performance for individual companies. Once again, these are too many to list. But fortunately, we can also place these into 3 broad categories. Think of them as who, what, and how. First, who are the managers and stewards of the business? And do they have the ability, willingness, and skill to make the decisions required for the company to thrive? Second, what is their competitive advantage or differentiated product that sets them apart from their competitors? Third, how will they shepherd the resources of the firm to ensure that their company continues to innovate, grow, and prosper in a competitive business environment? Well, that about wraps up our discussion. Well, we've only begun to scratch the surface of what is required to evaluate equity markets. We hope you find these first steps to be helpful building blocks as you build a foundation for thoughtful market analysis. Once again, thank you for joining me.
Hello, my name is Themis Themistoglou's and I'm the head of the European Investment Office here at UBS. Today I would like to take you through how we approach investing in equities. If you look at equities, the source of returns tends to come from 2 places. It's the share price performance and also any dividend that the company might pay. However, if you look at the volatility of this asset class, it tends to be much bigger than any dividend paid, and as a result, the share price appreciation tends to be the main driver for the returns you get out of this asset class. So the first step in analyzing equities is to try and establish what is fair value. And theory would tell you that fair value is the discounted cash flow of any future cash flows the company generates over its life, discounted to today. To put it in other words, is to adjust for the time value of money. So how do you forecast cash flows for a company? The starting point is to try and understand how the sales and costs and ultimately profits and cash flow would develop over a long period of time. To understand the sales development, you need to understand what drives the company's sales of the key products. But to make it easy, let's take 2 concrete examples. Let's take 2 large Swiss companies, Nestle and Syngenta. Nestle, if you think about their key products, these include coffee, chocolate, baby food, dog food, ice cream, some very, very interesting products. And what defines the demand for these products, for starters, is how wealthy the consumer feels. If you're wealthy and you feel well off, you tend to spend more money on these products. You buy more ice cream, more chocolate, more coffee. But the other key driver is consumer tastes. If you look at what's happened over the last 50 years, people drink a lot more coffee, they eat a lot more chocolate. And that's important in understanding where the future might lie. And also, you need to understand what costs are doing, what labor costs are doing, what the cost of raw materials like cocoa for coffee are also developing to be able to estimate the profits. For Syngenta, the situation is completely different because what they produced is used on crops. And what drives demand for those products are things like what's happening to the price of crops. If the price of wheat, of corn, of maize is very high, the farmer would be a lot more inclined to spend money to protect those crops. And also, there are other things like the weather that can have an influence. So for every company, there are unique drivers that drive the future sales, costs, and cash flows. Once you establish that, then you need to understand how these companies sit within the competitive environment, because consumers have a choice. They can buy a Nestle chocolate or they can buy a Lindt chocolate. So if one company does a better job in marketing these products, they would do much better in selling their products, capture market share, take a bigger bite of the pie. So that's important. And the last factor I wanted to highlight here is assessing the quality of management. This is absolutely crucial because these are the teams that are going to drive the future of the company through the decisions they're making. It's a very difficult factor to assess, but it's absolutely crucial for the future of the company. So once you've done all of that, we take these inputs to put them into a model which generates forecasts for sales and cash flow for the company, and ultimately that using the discounted cash flow analysis will give us fair value for the company. But you have to understand discounted cash flow makes a lot of assumptions over many years. So that people find very cumbersome, and it's also prone to mistakes. So they tend to take shortcuts, they tend to take simpler valuation methodologies like price to earnings, cash flow yield, dividend yield to get an answer to what the fair value is. So you establish the fair value, but reality is companies don't often trade at fair value in the short term. So there are other factors that can drive the performance in the short term, like alternative investment opportunities. If you can get 5% by putting your money in the bank, why should you take a risk invest in equities? Or let's put it another way. If you are going to invest in equities, you want a much better price. So you pay a lower price so you can have higher returns if you go to invest in equities. So that would drive the short-term performance. Other things like behavior biases can also have an impact. So taking the two together, you need to establish the fair value of the company. You need to understand what might happen in the short term before you invest and decide also on the timing of that investment. But ultimately, understanding the fundamentals, translating that into a fair value, and understanding the short-term dynamics is what really we take into account when we invest in equities. Thank you.
Hi everyone. Today we're going to have a look at fixed income securities, or what we call government bonds. There are also other types of bonds, but today we're going to concentrate on bonds which are issued by the government. And in this first film we're going to have a look at how they work first, what they are, and why they are attractive. On this first image you see a picture that we have of a government bond which was issued during the Second World War. Around the 1944 or something. So you see here already the main idea of this government bond is a piece of paper issued by the government, and the idea is that they get some money in exchange for this piece of paper, and basically it's debt issued by the government to pay for its expenses. So, but we're going to come back on the details of how it works. What you will be learning from this video, the outcomes, is you'll be able to explain what a government, or also what we call a sovereign bond is, or public bond. You will know the benefits of investing in such government bonds, and in another video the disadvantages of doing so. So you will also find out what are the main things you should look at when you want to analyze a bond, what we call the coupon, the capital, the principal, the maturity, yield to maturity. And you'll be able to grasp there's a subtle difference, and we'll illustrate this in a lively way, between maturity and duration. And last but not least, and this is a common mistake which is done very often, not just by my students, but also people I talk to when I talk about finance, is there's a lot of difficulty in understanding why the price of a bond moves in the opposite way as the yield. You'll understand what I mean when we come to the point. Okay, what are bonds? Where do they come from? They come from very ancient times, actually. The first bonds were issued by the Greeks. Yes, it seems like Greece was involved in as so far as the public finances goes, in debt for many, many, many years. We're talking about the times prior to Jesus Christ. A government faces expenditures, and these expenditures need to be financed by taxes, okay? So if these taxes fall short of their expenses, then this goes into a deficit, right? And a deficit in 1 year, if next year we have another deficit, then the two deficits combine and make a debt. So the debt is just an accumulation of deficits. And basically, you cannot accumulate this debt for infinity. At some point, you need to finance. And this is where the government issues this piece of paper and basically comes to you as an investor and gives you one piece of paper in exchange for your money. So basically, to finance the debt, the government will issue bonds to many lenders. And a government bond is just a debt security which is issued by the government to support its spending. Most of the times it is issued in the country's own currency. So we have, for instance, US Treasury bonds, and they're typically issued in US dollar. Importantly, you're lending money to a government, and okay, what do you get in exchange for that? We'll see what the financial merits that there are in doing so. But basically, you're giving this money to somebody, and in exchange, he's just giving his faith that he will be able to pay back the money you lend to him. So that's the general idea of a government bond, and it's known typically, the idea is that it's secure. It's not a risky type of investment because government normally do not default. So they're always able to pay back their debt. So when you talk about the benefits of investing in a bond, you as an investor, what you get is a predetermined, so you know in advance when you invest in the bond what you're going to get in terms of revenues. So you get all the stream of the different revenues that you will get from investing in a bond, including the refunding of your capital at the end, at the maturity of when the bond matures or when we reach maturity. So as an investor, when the bond reaches maturity, you get your capital, which we also call the principal, back. This is the main merit of investing in a bond. Unlike equities typically, or normally, you can lose all your investment, right? You buy a share of a US company or a European or in emerging markets. It may go up, but it may also go down. We see this in different in other courses. Here with the bond, the idea is that you get your money back when the bond matures. Other benefits attached to these investments is the fact that, as I said, they're low risk. Indeed, we will see that they are just a bit more risky than money market investment. And why is this? The probability that the government, which has issued this debt, is unable to refund, to repay the money that he has received from you is typically low. So that's why we talk about this as a main benefit in investing in government bonds. So you see this on the scale, right? We know in the finance there's this idea that there's no such thing as a free lunch. Indeed, we could even find people at some point wearing these T-shirts, and it had this acronym TANSF, T-A-N-S-F, oh my God. There ain't no such thing as a free lunch, right? TANSF. And what's the idea here? Is basically, if you want to get more return, you will need to take more risk. That's the main idea of there's no a free lunch in finance. So you see this on the scale low risk, low reward, high risk, high reward. So you see this on the scale, you see the cash, low risk, but also low reward. And then you see immediately after the cash, you see the government bonds. Government bonds are slightly more risky than cash, but still the risk is low. And the reward correspondingly low as well, a bit higher than cash normally, but not as high normally as some equities investment, which we see on the right of the scale, which typically are more risky, but also should yield more reward in compensation for this risk. Hi again. So in this video now we're going to have a look at the main concepts which you need to master when you invest in government bonds. They are the concept of coupon, the concept of principal, maturity, duration, yield, and yield to maturity. But let's start with coupon and principal. And I'm going to do this with this tablet here. Okay, so assume that we have these two axes. Here is time, okay, measured in years. And let's assume that you're investing in a government which has a length, a maturity of 5 years, okay? So this is year 1, year 2, year 3, 4, and 5, okay? Well, this is, on this scale, the dollar, this is a US Treasury, so a government issued by the US government. And the idea is that it gives you, as we just said, a predefined stream of revenue. So each year you're going to get a coupon, which we show in this bar. Assume that this is, I don't know, $100, okay? So basically you get $100 each year, and say you've invested $1,000 in this bond, okay? So in year 5 you get your $1,000 back, plus obviously also the extra coupon of 100. Okay, so you see coupon 1, coupon 2, 3, 4, 5, and your principal back. Let's illustrate this in a more practical way, actually. Okay, so what I'm going to do is show you with this thing here. And you, yes, you, camera woman, please come over here. Hello, what's your name?
Noemi.
Hi,
Hi.
Michelle. Nice to meet you. Okay, so Noemi, you've invested in this very successful company, which is called Coursera. You've heard of them?
A little bit.
A little bit, right? Very successful. So you've decided to put your money here in this company, and actually you've made quite a high return. So you've won all this liquidity, right? So this is your capital or principal, as we saw. And now you say, okay, I made a lot of money investing in the share, in the equity market, but now I would like to take a bit less risk. So you don't want to take such a risky investment as investing in equities, and you'd rather go for a government bond. So you want to take all your money here, this capital, and you want to invest in a government bond. So what we're going to see now is the key concept of duration and the difference between duration, this is duration, and we'll see how it works, and maturity. But before we do that, we have to remember this is your capital, this is what you get back, and when you invest in the treasury, as we saw from the previous slide, you're going to make a coupon, right? So year 1, you make $100. Year 2, let's see if we're more or less, whoops, yes, year 3, and year 4. Okay, normally there should be year 5, there should be a glass which we put on top here, but it's already quite tricky to put all this in balance. So we're going to try. Yes, Noemi, please. The idea is that we put this in equilibrium. And as you can see, obviously, the equilibrium point is somewhere around here. I'll hold this and let's see if you can find the, yes?
Almost. Looks like it.
It looks like it. We don't breathe, and you see where this duration is. It's not in the middle. It's not 2.5, somewhere there in the middle. It's not here. It's somewhere around 4. So the key difference between the maturity of a bond, which is 5, is this duration. That's where all the cash flows, the income you get each year in liquidity, and the principal you get at the end of when the bond matures is here. It's 4, okay? So when I first knew about bonds, I thought the duration was some kind of, I don't know, average maturity, maybe 2.5. It's not. Well, let's see, Noemi, what works, what happens. Can you hold there? So you can already imagine what is going to happen now if you let that up. Well, this is what happens when you make a confusion between duration and maturity. Maybe you have to transform yourself into a central bank, and that needs to go and save investor from a liquidity crisis in the bond market.
Well, that was pretty convincing. Thank you,
Thank
Professor.
you, Noemi. Thank you. So we saw in a very lively way what duration is and how you may not confuse it with maturity. Let's have a look in this third videos on the merits in investing in government bonds on other key concepts. The first of these is the yield to maturity. Now, how is it defined? The yield to maturity is the return you get on a bond if you hold it until maturity and the coupons are paid as agreed. So I give you one example here. Suppose that you pay today $95 for a bond, a short-term bond, which will mature in 1 year and will be refunded at par, as we say, or a face value of 100. And in the meantime, you get a coupon of $5. So in 1 year's time, you will get $100 back as a principal. You remember that big bottle on the rule. $100 back plus the coupon of $5. So the question to you now is, what is the yield to maturity of this bond? So now we've just seen how to compute the yield to maturity of this bond. It's basically all the returns you make on the bonds, i.e. coupon plus principal. In this instance, it's 105, divided by the price you paid for this bond, 95, and you see that it gives you a return, a yield to maturity of 10.53%. Okay, so now we're going to see another key aspect, and indeed one, when I talk about it, and it raises many eyebrows, not just within my students, but also people I talk to, family and friends, that have difficulty in grasping why the price of a bond is inversely related to the yield. For the misconception is here quite simple to explain. People think that when your yield increases, then you're better off, right? It's better for you if you own a bond that suddenly yields 2% and in 1 year's time possibly yields 3 or 4%. So you say, I'm better off. Why should the price of the bond decrease when the yield increases? Well, we can see the relationship on this chart. The red line depicts the 10-year bond index. It's a price index of the bond of 10 years treasuries in the US, starting in 1990. You see that it rises, it goes from 105 to roughly 150 at the end of the period. And you can see that it correlates very strongly with the blue line, and the blue line is depicted on the right-hand scale inverted. So an actually increase of the blue line on the chart is actually a fall in the yield. You see that it starts at roughly 8% and it ends at roughly 2.5%, which is more or less the bond yield today in the US. Okay, so there's this inverse relationship between the yield of a bond and the price of that same bond. Well, let's think of this for a minute. I mean, shouldn't it be the opposite? Shouldn't it be that when the yield rises, the value of my bond increases? Well, this is going to be a quiz. The next quiz for you is to find out what is the rationale for thinking that when the yield of a bond rises, the price of that bond falls. Now, before we go into the formula which gives you the exact definition and explains you why when the yield to maturity rises, the price decreases, I want to explain that with you in words. Suppose that I own a bond which yields 2%. Okay? It's a bond issued by the US Treasury and it yields 2%. Okay? Now, I bought it 2 years ago, and just maybe in 2 months' time, the US Treasury issue a new set of bonds. But in the meantime, the deficit has risen, so investors are kind of a bit wary of buying treasuries because they think maybe the government will have difficulty in paying back the bonds it issue, and we'll see in the next video that this is one of the risks, the default risk that you may encounter when you invest in bonds. Okay, so the government comes with a set of new bonds, and to make it attractive to these reluctant investors, they have to raise the yield. They have to offer more yield. So say the new bond comes with a yield to maturity of 3%. Now there's this new bond at 3%, and I still own mine at 2%. And say I don't want to hold it until maturity because I need the cash to buy a new car or a house. Okay, so I want to sell my bonds. I have, say, $100,000 put into this bond yielding 2%. And I come to you and I say, hey, would you buy my bond? And you're given this choice of saying 3% if I buy a new bond, 2% if I buy it from Michel. Certainly you will tell me, hey, man, you can keep your bond. I don't find it very interesting. I prefer to buy the new one at 3%. To which I will answer, wait a minute, if I give you a discount on the price of the bond, and you pay it less than you would pay the bond which is yielding 3%, would you buy it from me? And you might say, yes, well, what kind of discount will you offer? Well, I will offer you exact discount on the price of a bond so that it yields 3%. So the yield to maturity would be equated between the two bonds, and on the old bond it would be equated because you reduce the price. Okay? So now you know in words why there's this inverse relationship between yield and price, and this we show with this formula here, and this formula is familiar, should be familiar to you by now. It's the net present value, and we've seen in the video that it can be used to evaluate a company, the value of a company. But we can also use it to evaluate the price of a bond, and indeed you see this formula here where the bond price is some kind of net present value of the future cash flow, the future coupon, and the principal which you get at the end. And the discounting factor, the opposite of the compounding factor, the discounting factor is precisely this yield to maturity. It's at the denominator of the formula, so quite mechanically, if it rises, the price of your bond or the value of your bond decreases. Indeed, we have one graphical example here. We see that when YTM, the yield to maturity, goes from YTM 0 to YTM 1, the price of your bond falls from P0 to P1, and you see that exactly with the formula attached to this chart. Now, in conclusion, we see that bonds are traditionally considered as a safe investment. Why? Because they secure a given stream of income, and you get your principal normally in the end. We'll see that in the next video there might actually be some risks, and that is not always guaranteed. Look at Greece, for instance. They serve government and firms. In this instance, we talk about corporate bonds who need to finance their activities, so to cover basically for their expenditures, which may exceed the tax incomes they receive from the population. And we saw now, very importantly, that in this video, that the yield to maturity and prices of bonds are inversely related. And finally, and we'll see more of this when we'll talk about risks in the next video, and also in another video which analyzes the impact of interest rates on equity and bond portfolio, that the maturity of a bond is important, but the duration is key. Hi again. So we just saw in a previous video that government bonds have many merits. After this video, you will be able to identify the main risks which there are in investing in bonds. And we will also give you some highlights as to how to hedge against this risk, but this will come in the later part of these courses. There are 5 main risks in investing with government bonds. The first is economical risk. The second is political risk. Then there is interest rate risk, and we will make a link here with the previous video. You remember the rule and the glasses and how they fell apart. So we'll see how duration comes into play when we talk about interest rate risk. Then there's inflation risk. And last but not least, we're going to talk about currency risk. So let's start with economical risk. We said that governments are safe in that normally they do not default. They're always able to pay back the debt that they've issued in the form of government bonds. But in some cases, actually, they do default. And there's been many historical examples of these defaults. Told you that government bonds first came into existence in Greece. Greece has been a country which has defaulted on its debt, including very recently. Other examples include Latin American countries who regularly, like countries like Argentina, who have regularly defaulted on their debts. So, in principle, we may say that governments, when they face difficulties, i.e. they cannot finance all their expenditures, they can actually raise taxes to collect more money, more revenues to finance their expenditures. The problem is that if they do that, investors will demand a higher interest rate. They will see that the government has difficulties, and so the next time they come and they issue a bond, investor will be reluctant to invest in this bond, so the government will have to come with higher interest rates. So basically, when we talk about economic risk, we're talking about the probability that the government will default. This probability is low, but it's not zero. So indeed, there is that risk. Then there is the political risk. It's related, but a bit different than the previous one, economical risk. Here, the government will also kind of default, will not pay back its debt, but here it's a political decision. So in the first example, economical risk, the government is unable to pay back the debt. Here, it is able, but it is unwilling. So we have a historical example of this, for instance, Russia at the beginning of last century. And also in 1998, we had the so-called Russian crisis. And here it's a combination of economical and political risk, in that the government devalued the currency, the ruble, it faces economic difficulty. So they said basically, let's devalue the currency in an effort to boost exports and revive growth in the economy. And also they defaulted on the debt. So here we do have also this risk that basically you don't get your money back because the government refuses to give your money back. Okay. The third risk that we're going to have a look at is interest rate risk. basically we saw that there is this inverse relationship between the interest rate, the yield to maturity, and the price of a bond. We gave you the example, and let's have a look at it again. If you hold a bond and it's yielding 10%, and then suddenly a new bond comes into existence at 12%, we saw in the previous video how this will depress the price of the bond yielding 10%, basically so that the yield match between the old bond and the new bond. So basically, when interest rates go up, the price of the bond comes down. And now we can make the link with the famous concept of duration, which we saw. You remember this number of year which equilibrates all the cash flow, all the revenues you get year after year investing in bonds, and the principal, you know, the big bottle at the end. Duration is the kind of point where all the cash flows and the principal are in balance. It's also a key concept because it measures the sensitivity of the bond to movements in interest rates. And this can be seen in the following formula. So we can see from this formula, and we're going to illustrate with this formula how the interest rate risk is captured by duration. So we see here that the percent changes in the price of an asset, such as a bond, is actually equal to minus D, and D stands for duration, times, and you see this formula in brackets, delta R, and delta R is the change in interest rates divided by 1 plus R, and that's where we're standing in terms of interest rates. So this may look a bit complicated, apologies for this, but you will see how it's very clear with a numerical example. So let's assume that D, the duration, is 6.55, okay? And let's assume further that we have a coupon rate of 10% and the price of bond is at par at 100. Now, let's assume that the interest rate, the yield, which is 10%, goes from 10 to 12%. So how will this affect the bond price? Well, we have the formula here, so we substitute in there D for 6.55. Then the changes in interest rates, it goes from 10 to 12%, so it's an increase by 2%, 2 percentage points. So it's actually 0.02. And it's divided by the initial level of the interest rates, so that's 10%. So it's 1 plus 0.1, 1.1. And all this boils down, translated into percentage, so you multiply by 100 to get percentage changes, and you see that it's minus 11.91. So actually, it's a huge increase. Can you believe it? I mean, interest rate goes from 10 to 12%, but the price of your investment, how much your bond is worth, it actually drops by almost 12%. Duration is a key metric because here it measures the sensitivity of your bond to changes in interest rates. We took the example here of 6.55, but let's assume that the bond duration was not 6.55, but say 10, we would have had a bigger drop in the bond price. So duration is actually a key metric where you have to hedge against and manage the interest rate risk of your bond or a bond portfolio. Okay, so this was the third risk. We saw economical, political risk, interest rate risk. Now let's talk about inflation risk. We have here this nice picture of your wallet being squeezed. Being squeezed by what? By purchasing power being lowered by the fact that when you get your money back from the government, you get your capital, your principal back. If there's been lots of inflation in between, then your money is worth less. So to illustrate this, let's assume that you bought a bond and it gives you a coupon of $100 each year over 10 years. And then suddenly, after 3 years, we get an unexpected price jump, unexpected increase in inflation, right? Okay. So if a new bond comes into existence, it will reflect these conditions of higher inflation. But you holding this old bond does not reflect this higher inflation. So interest rates will have to go up to compensate for this higher inflation rate. And so the value of your bond will go down because the investors in the new bond, when they will look at you and say, hey, but your $100 as coupon is worth less because of inflation. And so the price of your bond will fall. In other words, other investor will only accept to buy the bond if you give them a discount. So it's basically the same kind of impact as when interest rates go up. Here it's inflation, which goes up and decreases the real value of your bond. Okay, now let's have a look at the last but not least risk. This is currency risk. We said when we first talked about government bonds that these are issued by governments and traditionally, typically, they're issued in domestic currency. But obviously, these bonds are accessible to foreign investors. So if I'm a Swiss investor or a French investor and I buy and my base currency is euro or Swiss franc and I buy a US dollar bond, and if the dollar goes down versus the euro or the Swiss franc, then when I get my money back, my principal, I may have gained this regular stream of income year after year, but when I get my money back and the dollar has fallen in between, then I can make a loss. And this could be quite substantial because currencies can be actually quite volatile. So for the moment, we'll just identify these risks. We identified 5 of them, but it will be at a later stage that we will show you how we can hedge against these risks. So stay tuned.
Hi, I'm Tom Swacker. I'm leading the Credit Research Department at the Chief Investment Office of UBS. In this session, we're going to talk about investing in bonds. Global debt markets are actually about 3 times as large as the global stock market. That gives investors plenty of choice. The largest part of the debt market is in the form of bonds issued by governments and companies. There are various kinds of bond structures and bond types, and there's virtually no year without an innovation in this market. The vast majority of bonds, however, has a fairly simple structure. It has a fixed term until you get the principal back, and it has a fixed interest payment, which we call a coupon, that you receive periodically. Bonds are usually issued and redeemed at 100% of their face value. In this case, the yield is the same as the coupon. But the fair yield for a bond can change during its life, and so does its price. The yield should basically compensate you for 2 things. A loss of purchasing power, as you lend your money out for quite a while, and the risk that you don't get it back. The expected loss of purchasing power of money, that's a key driver of what we call risk-free interest rates. Usually, we look at a reference issuer for what is called the risk-free rate. So like US Treasuries for the dollar market, or German bonds for the euros. The key risk that a bond investor needs to consider is that the issuer, whether a company or a government, will be unable or unwilling to pay its debt. The most common reference point for this risk are credit ratings, as they are provided by agencies like Standard & Poor's, Moody's, or Fitch. Of course, unexpected developments can always turn what we thought was a good credit into a bad one. But at least historical evidence suggests that issuers with high credit ratings have defaulted on their debt in much less cases than lower rated ones. The difficult part now is judging the appropriate additional reward that an investor should demand for investing into a higher risk issuer. This compensation varies, and it is often driven by similar factors that also move the stock market. A positive outlook for the economy usually results in lower bond risk premiums. Other drivers can have opposite effects on stocks and bonds. For example, M&A transactions
or share repurchases. They're often good for the stock, but they're bad for the bonds. So if we put pieces together again, the risk-free interest rate plus the risk premium, that's the yield of a bond. Now let's get back to what is the worst case for you as a bondholder, and that's a default by the issuer. It would then stop paying interest, and it either tries to negotiate some partial debt forgiveness with its bondholders, or it goes into liquidation. For governments, liquidation is clearly no option, so they will always negotiate with bondholders, which can go on for several years, like examples of Argentina, which show it defaulted in 2004 and it still has pending lawsuits with its bondholders. On average, investors only recover about 30% of the nominal value if a company defaults, and they may need to wait years to receive payments in case of liquidation. For Lehman Brothers, which was the big headline default of the financial crisis in 2008, liquidation is still ongoing today. When investing in lower quality credit, you need to be very careful, not only when selecting the issuer, but even more when finding the right instrument. Companies often issue different types of bonds, and in some cases, reading the bond prospectus is really the only way to find out about instrument-specific risks and special features. Trading bonds is also quite different from trading stocks. Bonds are often not traded on exchanges, but between broker-dealers, which makes it harder for a private investor to observe a price level at which a bond can effectively be bought or sold. Many institutional investors buy bonds at the time when they're issued, and they keep them until their final maturity date. So there can be almost no secondary market transactions in some of the bonds, which obviously makes it very difficult to liquidate a position ahead of its redemption. So as a consequence, if you are holding a lower quality bond, it is even more risky if this bond is also illiquid. Bond markets may not always be perfectly efficient, but my number one investment advice for you is to be most suspicious when a bond's yield looks excessively attractive. There's almost always a good reason for this. You can earn an extra yield if you pick the right bonds, but you're clearly not paid for being a hero in bond markets.
How much cash do you hold in your portfolio? Hello, my name is Dirk Effenberger. I'm heading the cross-regional investment office at the Chief Investment Office of UBS Wealth Management. Getting back to our question, actually private investors hold a significant amount of cash. According to OECD statistics, and you see this in the chart, private households in the US allocate around 23% of their financial assets to cash and related instruments. This share is even higher in other regions, for example in Europe, reaching around 40% in Germany and more than 40% in Spain. So obviously cash plays a very important role in private investors' asset allocation. That is why I would like to tackle 3 questions with you. First of all, how do we define cash? What is cash? Secondly, what are the reasons for holding cash? And thirdly, is cash really safe? Or, to put it into a more common language, is cash always king? Let's get started with the first question. What is cash all about? So cash is much more than just pocket money like notes and coins. It also comprises investments which are typically characterized by a number of factors. First of all, high degree of liquidity, which means daily availability of your capital. Secondly, low risk, which usually means low volatility or capital protection at maturity. And a third factor, which is important in defining cash investments, is that there's a maturity of up to 12 months of the underlying asset. So these characteristics apply to pocket money, but also to saving accounts, fixed-term deposits, money market funds, and many more cash investment solutions. Typically, cash is a low-yielding, low-risk investment compared to equities and bonds, and you see this on figure 2. You see here that since 1997, cash has generated the lowest return, but also shown the lowest volatility of the selected asset classes, equities and credit in particular. In general, cash return is determined by money market interest rates and hence by central bank policy. Consequently, the return on cash right now in most developed markets it's close to zero. And this leads me to the next question: why should I actually hold cash if the return is close to zero? First of all, there's consumption cash, so you want to pay your bills. Secondly, there's so-called iron reserve. This is held to cover unforeseen and unexpected expenditures due to illness or an accident, for example. The iron reserve can remain untouched for years because an adverse event never occurs, but it allows the investors to sleep well. The iron reserve can actually be regarded as a type of insurance substitute. The third reason why private households hold cash is for asset portfolio purposes. For example, if the investor expects lower prices going forward, then the investor prefers to hold money to purchase financial assets at a later date and at a lower price. In this sense, there's clearly a tactical argument for holding cash in a portfolio. However, holding cash because of a negative view on other asset classes is not straightforward, since it contains timing risk, because you don't know when other asset classes outperform, and potentially high opportunity cost should other asset classes perform better than you expect and better than cash. And this is something other asset classes usually do in the long run. Overall, it becomes very clear that there is no specific cash portion which is optimal for all investors at the same time. However, taking all the above into account, many private investors tend to hold more cash than they actually need. And admittedly, this is probably true for my own portfolio. Thus, many investors tend to hold so-called excess liquidity, which for portfolio reasons might be better invested somewhere else. In fact, and this is an important point, I think, holding too much cash can be risky for private investors. And to answer our third question from the beginning, no, cash is not king at every point in time. There are a number of reasons for this. First of all, opportunity costs. Holding cash comes at a price. Cash acts as a drag on long-term portfolio returns. For example, we estimate that over the next 5 to 7 years, cash will return only around 0.5% in the Eurozone and literally nothing in Switzerland. Secondly, portfolio risk. It can be shown that adding too much cash to your portfolio can increase portfolio risk and lead to higher losses during times of stress, which is pretty counterintuitive. Historically, bonds and equities diversify one another better than cash. A third reason, inflation, and that's very important. Let's assume you have been holding 1 unit of pocket money since 1995. Taking into account the accumulated inflation since then, in real terms, you would have lost 10% of your capital in Switzerland, 25% of your capital in Germany, and 1/3 of your capital in the US and the UK. For emerging markets, the loss in real value of your pocket money would be even higher. This ultimately means that inflation eats into the real value of your cash and that in real terms you actually lose capital over time. To sum up, cash is more than just coins and notes. It also includes money market related instruments. Secondly, there are concrete reasons for holding cash. And when trying to assess your individual optimal level of cash holding, you should have a good understanding of your personal consumption needs and your iron reserve requirements. Finally, be aware of portfolio considerations. Last but not least, no, cash is not safe at every point in time due to a potentially high opportunity cost, potentially due to portfolio considerations, and due to inflation, which reduces the real value of your accumulated capital. As a result, holding too much cash can actually hinder achieving your financial goals. Thank you for watching and enjoy the rest of the program.
Hi everyone. Today we're going to talk about currencies and we'll see that they represent a key asset class. So in this video, we will see 4 things. We will see what an asset class is, how we can define it, the different ways of quoting exchange rate, how they may impact your investment decisions, and why they should be treated separately. When we talk about an asset class, can we define it more precisely? Well, there are no exact definitions, but maybe the best definition we can think of is that they represent a group of securities that has similar characteristics, i.e. they tend to move together. So when we talk about asset classes, normally we think of cash, we think of bonds, which we have seen in a couple of previous videos, and equity markets as well. Whether currencies do represent an asset class per se remains an open question. I personally believe that currencies are a separate asset class. They should be treated separately, and I'll show you why in a minute. But more importantly, and first and foremost, we need to know that currencies do represent the largest financial market in the world. Indeed, for one very simple reason, every other market is labeled in a currency, so it's no wonder that currencies do represent the largest financial market in the world. You can see here some figures. These are daily figures, daily volume on the Forex market, the foreign exchange market. It's a survey conducted every 3 years by the Bank for International Settlements. And you see the figures here. These are $1 trillion. So every day you see $5.3 trillion, so 5,000, 3,000 billion dollars are treated on the currency market. And you see that this number has been increasing steadily over the years. When we deal with these big numbers, it's always interesting to put them in perspective, either to a GDP figure, a gross domestic product, or international trade. So here what we've done is we show you how these figures compare to GDP. And when I first looked at this chart, I thought, you see these lines in the bottom, the rock bottom. Actually, the blue and the green line, United States and Japan, they kind of mingle together. It's hard to differentiate both, but you see that they are very, very low, close to 0, close to 10. So I thought, well, 10% of GDP for the volume in the US dollar and the yen respectively, respective to their GDP, that's not very, very high, right? But then I realized that these were not percentages, they were times. So here we're dealing with a country which has daily volumes in the foreign exchange market which represent 14 times the size of the economy. So that's a lot. And you can see that even for smaller countries like Switzerland, this is more than 100 times. So the daily volume treated on the Swiss francs are more than 100 times the size of the Swiss economy. The number is 250 times for Hong Kong, and the record is for Singapore with more than 300 times. In terms of volumes, it's the dollar which dominates the scene. It represents 87% of the volume treated on the Forex market. Then the second currencies is the euro with 33% and the Japanese yen with 23%. What we don't see in this chart, but what I can tell you is that emerging market currencies do represent a minor, still low part of the daily volumes in the Forex market, but this is growing very fast. So stay tuned to watch how these currencies will become increasingly important in the Forex market. When we talk about currencies, we need to know that there are 2 ways of quoting them. There's the direct way and the direct quote, and there's the indirect quote. So the direct quote is the number of units of domestic currencies which are needed to buy or to exchange, either buy or sell, a unit of foreign currency. So, for an example, if we think of a Swiss-based, an investor who has a Swiss franc as a reference currency, he needs to consider whether he wants to buy some dollars. He will have to spend 0.99 today, that's the current exchange rate, Swiss franc to purchase $1 US. Or the same can be said about the euro. He needs 1.08 Swiss franc to purchase 1 unit of foreign currency, the euro in this instance. So this is the norm in every country, this direct quote, except, and you see the countries here, the UK, Australia, New Zealand, Canada, and the Eurozone. In these countries, we talk about indirect quotes. So here it's the number of units of foreign currencies corresponding to 1 unit of domestic currency. So with my €1, how much can I purchase of, say, US dollar or Canadian dollar or what have you? So here you see some example. €1 is 109 US dollar currently. 1 Australian dollar is worth 0.71 US dollar. Okay, so now we're going to illustrate the impact a currency may have on a financial market. And here I take the example of the US equity market. We see this blue line, it's the index called the S&P 500, which represents the 500 largest companies quoted on the US equity market. And the red line below is the same index, but expressed in Swiss franc. The first one is expressed in US dollar, the second one in Swiss franc. And that reminds me actually of a story that happened to me a couple of years ago. I was head of research in a private bank here in Geneva. And this portfolio manager comes to me and he says, Michel, you're always showing these charts saying that the US equity market is expensive, the valuation is stretched, and we'll see what that means in videos down the road. And also, okay, basically you say, well, the index is at its peak, so maybe we should be a bit cautious. Then he said, hey, look at this chart. I'm investing, from my point of view, it's in Swiss franc. When I buy the US equity market and I make some gain or losses, I translate them in Swiss francs. So for me, as a Swiss franc-based investor, it's the US equity market expressed in Swiss franc which matters. And on this chart, the US equity market was way above, and the US equity market expressed in Swiss franc was way at the bottom. So you tell me, it's not expensive, once you express it in Swiss franc. But I told this portfolio managers that he was confusing two things. The market, for one, and the currency in which it is expressed for two. And basically, you see the reason why it looked apparently so cheap when you expressed the market in Swiss franc is because the dollar had collapsed in the meantime. We see this is on this very long-term chart. You see that up until 1973, currencies were fixed. And the parity, this comes after the agreement which was made post-World War II, the so-called Bretton Woods Agreement, whereby they fixed the parities between currencies, and the parity of the Swiss franc was roughly 4.3 to the dollar. This is way more than the one we currently have today. And you see that the line has been trending down over the years. So it's not surprising that when you express a market in a currency which has been appreciating over all these years, like the Swiss franc, then the line may look correspondingly cheap, but it's not. So with this example, I really want to make a case here that currencies should be treated separately, that's for sure, and they are actually a separate asset class because they can move independently from other markets. The best example I can give you here is the example of Japan. Currently, what we have in Japan is, and we'll see that when we talk about central banks, we have a central bank which is conducting a very accommodative policy, very low interest rates and program, which we will see what that means of quantitative easing. So they're injecting a lot of liquidity in the market. This has two impacts. It has the impact of propping up the equity market, so giving some support for the equity market to go up. But at the same time, also it puts some pressure on the currency. We have the same example actually even in the Eurozone with the European Central Bank conducting exactly the same policy. So rather a positive for the equity market and rather a negative for the currency. So what you should do as an investor, if you're buying the Japanese market and you're based, say, in US dollars, then you should buy, you should get exposure to the Japanese equity market, but you should hedge. And we will see how we do this when we talk about ways of ensuring that your portfolio is not affected by currency moves. Basically, you should hedge for the risk that the yen will fall against the dollar. So you should treat both decisions separately: buy the market, but hedge the currency in which it is labeled. Okay, so in conclusion, we saw that the Forex market is actually it's actually the largest financial market in the world, with daily volumes which are in excess of $5,000 billion per day. We also saw that there are two ways of quoting exchange rate. There's the direct quote way, which is the most commonly used. It's so much units of domestic currencies to purchase or sell a unit of foreign currencies. But then there's also the indirect quote, which is used in Canada, in Eurozone, in Australia, and New Zealand. And also we saw, more importantly, that gains that you make in financial markets, we took the example of the US equity market, can be erased if the currency in which they are labeled falls versus your reference currencies. And hence, it's very important that you should consider currencies as a separate asset class. So in this video, we're going to have a look at how we may define the real value of a currency and assert whether it's over or undervalued. And we will see there's actually only one way to do so. Indeed, when I first started my career as an economist, I started in a private bank here in Switzerland, and I was a currency economist. And I realized how difficult it was to come with conclusions whether a currency should go up or down based on economic fundamentals, because of this lack of measures, of yardsticks, where you can say, if you compare a currency to that level, then you can say a currency is under or overvalued. So by the end of this video, you will be able to explain the only yardstick which we know, and it's called purchasing power parity, and we will see how you may define that. And you'll see that there are two ways of defining purchasing power parity: the absolute way, the relative way. And we will see how there is a major problem when constructing an estimation based on PPP. And we will see also another funny example of a measure relating to purchasing power parity, which is called the Big Mac parity. Okay, so defining purchasing power parity, basically the idea is quite simple here. The idea is that if you have a currency and you're going to abroad, say you're going to the United States, say you're based in India and you're going to the United States, and say the cost of living is higher in the US than in India, then the idea of purchasing power parity is that you need a stronger currency, i.e. a stronger rupee versus the US dollar, to compensate for the fact that prices are higher in the US. And if that condition is fulfilled, then we say that PPP, or purchasing parity, holds. So in this example, we can say that PPP is an estimation of a theoretical exchange rate. It's actually not an observed exchange rate, but it's very commonly used. So let's see this with one example. Let's take a representative basket of goods in the US, which costs $100 US. And let's assume that in Switzerland, the same basket of goods costs 110 Swiss franc. So if PPP holds, then the dollar should be worth 1.1 Swiss franc. And if that condition holds, then you would be indifferent to buy the basket of goods in the US or in Switzerland. You would have the same purchasing power. But if the exchange rate is not 1 1.1 Swiss franc per US dollar, but say parity, 1 US dollar equals 1 Swiss franc, then the Swiss franc would be overvalued by 10% because the basket is actually cheaper in the US than in Switzerland. It would cost $100 in the US and it would cost $110 in Switzerland. So we're going to have an illustration of what PPP, how PPP can be measured, and I'm sure you've heard of this example. It's the example of, are they ready? Oh, yes they are. The example of the Big Mac parity. So take a look. We have here a very practical example how we can define PPP. Basically, the idea is to compare the price of a Big Mac. Okay, so here we don't have Big Mac, we just have simple hamburgers, but you'll see why in a minute. But let's assume these are Big Macs. Okay, this is the Big Mac which was bought in New York early this morning. It cost $4.79 to buy this. Let's assume it's a Big Mac again. Okay. Now, this is the same, and it was bought in Beijing also early this morning, and it cost 17 yuan. Okay. This was bought here just next door in Switzerland, and it cost 6 francs 50. And last but not least, this was bought in Bombay. But you see, it's somewhat different from the others. It's not exactly the same. And for one main reason, actually, in India, you don't find Big Macs made of beef, but of other meat like lamb or chicken. Okay. So what's the idea now here? The idea is to compare the price of the Big Macs in the various countries and derive from it the true value of the currency. So we know that $4.79, and let's compare that to Switzerland, 6 francs 50, okay? So let's assume that we could buy this $479 with the current value of the Swiss franc, which is roughly 0.99 Swiss franc per dollar. So, which means that we paid this Big Mac in the US something like 4.7 Swiss franc. Okay, so there would be a very easy way to make a lot of money is actually to purchase a lot of these Big Macs in New York, bring them back very quickly here to Switzerland, and sell them, say, for 5 francs 50, as opposed to 6.50 in the shop, in the McDonald's. So we could sell them cheaper and still make 1 franc gain per Big Mac we sell. Okay, so to avoid this arbitrage that we buy these hamburgers in the US and sell them here and make a profit, an easy profit, basically these profits are cancelled if the currencies are at their PPP rate, measured by the comparison between the price in the US and the price in Switzerland. And we see basically if we divide 650 by 479, we get 136. And 136 Swiss franc per dollar is the correct estimation of where the Swiss franc should be according to the Big Mac theory. And now comparing this 136 versus the current exchange rate, here we take 0.95, we see that the Swiss franc is overvalued by more than 42%. And on the same yardstick, using the same kind of calculation, we can see that the Chinese yuan or renminbi is undervalued vis-a-vis the dollar by also 42%, some 42%, and the India rupee is actually even more undervalued by more than 60% versus the US dollar. With this example, we just find out that the rupee is actually massively undervalued vis-a-vis the dollar at more than 60%. We saw the Big Mac parity as an example of absolute purchasing power parity. And now we're going to have a look at the concept which is related of relative purchasing power parity. Here we're not comparing the price of one good or a basket of goods, but we're actually comparing the price evolution of a basket of goods, and this is the inflation rate. So let's take one example. Let's assume that we have we're comparing the Eurozone and Switzerland. And let's assume that we have 11% inflation in the Eurozone and 1% inflation in Switzerland. And let us assume that we're starting in January 2000, which is when the euro came into existence. At that time, the currency of euro for Swiss francs was 160. So you had to pay 160 Swiss franc to purchase 1 unit of euro. So according to the theory of PPP, given that the inflation rate is higher in the Eurozone than in Switzerland, basically you need an appreciating Swiss franc to compensate for these higher prices when you go into the Eurozone. So you see here the formula, and you see that according to this inflation differential, the Swiss franc should be roughly 10% higher 1 year after the euro comes into existence. So the parity should be 145.58. And you see the formula here, how we get to this thing. Basically, we multiply by the inflation differentials between Switzerland and the Eurozone. And let's assume that a year after, in 2001, we have the same inflation, we have still an inflation differential, but lower. We have that the Eurozone inflation drops to 2% and inflation in Switzerland remains at 1%, then we still need an appreciating Swiss franc to compensate for the higher prices in the Eurozone, but only by roughly 1%. And you see here the formula again, but with 2% inflation in the Eurozone, and we get to 145.15. So this theory is that basically the currencies where inflation is high should be depreciating versus the currencies of countries where inflation is low. Because, again, you need a stronger currency to compensate for higher prices. So here is the formula. And you see that the PPP rate, which again, and it's very important to know, it's the only yardstick that we can think of to measure whether a currency is over or undervalued. So you see here how we can compute it. We basically take a currency exchange rate. In the previous example, it was 160. And we multiply it by P over P star. P is the domestic inflation rate, and P star is the foreign inflation rate. But now there's a problem here, and the problem is this with the E. The first observation, 160. You see that in the previous example we said, okay, 160 we start, and then we have, because of the inflation differential, roughly 10% appreciation of the Swiss franc, so we get to, what was it, 145.58. But now we need to think of a major problem that we have with estimating PPP, and that relates to the E, the first observation, or what we call the anchoring point. In the previous chart, we saw that it was 160, i.e. the first quotation of the euro versus the Swiss franc when the euro came into existence in January 2000, 160, okay. And then from this point, we anchor the inflation differentials. For instance, after 1 year, we saw that it was 145.58 because of the inflation differential. Okay. The problem is, who says that 160 was the correct PPP in January 2000? There's no theory which tells us that. And basically, I can show you a chart, and this is the problem illustrated here in the following chart. We see the evolution, and that's the red curve here, of the Swiss franc versus the euro. Now, let's assume that we choose January 08 as the anchoring point. At that time, you see that the Swiss franc was very weak versus the euro. The euro was strong. It was 165. This is the strongest the euro has been in its history versus the Swiss franc. So if we choose that as the base period, the anchoring point, you see we get this green dotted line here. And what this green dotted line is telling us is that today, according to this line, the euro should be worth 155 versus the Swiss franc. Okay, that's extremely high for the euro versus the Swiss franc. On the other hand, if we choose August 2011 as the base period, you know, the anchoring point, this E in the previous formula I showed you, then you see we get a completely different message, because the black line here ends up, the last observation, at parity. So the message here is to say, if we choose that August 2011 as the anchoring point, then we would say that the Swiss franc is correctly valued versus the euro today, because the current parity is 108 and the PPP is suggesting 1. Okay, but so you see here there's a major problem here. It's the a prioriness of the anchoring point, the first observation on which we hook the inflation differentials. Okay, so the way to solve this problem is through a technique which we call the regression. This is a bit technical. We will put in a glossary the details for those of you who are interested on how we can solve the problem of the a prioriness of the first period. Actually, a proxy way to solve this problem is to take some kind of average of all the exchange rate which are observed. So here in this instance, it would be from January 2000 to today, December 2015. You take some kind of average, and that becomes your anchoring point. So, but the academic way to solve this problem is through what we call a regression technique, and this is with constrained parameters on elasticity of 1. Okay, I won't give you the full details. On the inflation differentials, you can find the details in the glossary. And once we do that, we get this blue line, which we call here true PPP rate. And here we can say that the Swiss franc is overvalued. We had already this message when we looked at the Big Mac parity. We have the confirmation here when we look at the broader set of goods, not just the Big Mac. And we see that it should be roughly worth 128 Swiss franc per euro. So, in conclusion, we saw that with this video that the only way to measure the correct value, the theoretical value of a currency, is the so-called PPP. And there are two ways to measure that. One is the absolute version of PPP, purchasing power parity, and we saw that with the example of the Big Mac. And then there's the relative purchasing power parity, which is used when we take not just one good, the Big Mac, but a basket of goods, and we compare their price evolution in history. We also saw that there's a major problem when measuring PPP, the relative PPP, and that's the anchoring point. And we find out the solution to this problem. It's with this regression technique. Again, it's not part of the course, it's in your recommended readings. But for those of you who are interested, this is how we get to this true value of what the Swiss franc should be versus the euro, and that value is 129. Now, if we compare 129, the theoretical value of where the Swiss franc should be versus the euro, to 108, which is the value of the Swiss franc versus the euro today, then we have an overvaluation of 17% of the Swiss franc versus the euro. Now, this overvaluation of the Swiss franc vis-à-vis the dollar this time, remember, was really, really high at 42%. Again, when we look at the Big Mac parities, we find that the Swiss franc is the most overvalued currency in the world. So the burger, are they still there? Are they still around? Oh, yes, they are. Yes, well, talking about the Swiss franc, 42% overvaluation means that this burger here must be really good, because it's the most expensive one in the world. So let me see if that's correct. Quite tasty.
Hello, I'm Brian Nick, a strategist in our Chief Investment Office at UBS Wealth Management Americas. Today I would like to talk to you about a concept I work with every day, risk-adjusted return. If you've watched my colleagues in prior videos, you're familiar with a few different definitions of risk. To recap quickly, The most common measure of risk in investing is standard deviation. Standard deviation defines a range of returns within which investors can expect about 2/3 of observed returns to fall. We say asset classes are riskier when they have higher standard deviations, and we expect those asset classes to deliver higher returns on average than others that may have little to no market risk. That brings us to the concept of risk-adjusted return, which allows us to compare apples to oranges in a sense. By adjusting either historical or expected return on an asset class for a degree of risk, we can compare, for instance, U.S. Treasuries to U.S. equities when deciding how to invest. If we were to invest solely based on maximizing return, we would probably prefer U.S. equities almost all the time. But if our goal was to minimize risk, U.S. Treasuries seem the more prudent choice. Risk-adjusted return allows us to combine these concepts, and there are many ways to measure it. Today I'll summarize just one example, the Sharpe ratio. The Sharpe ratio measures units of expected excess return per unit of volatility. Excess return is simply the return we've received or expect to receive over and above the risk-free rate. These days, in most parts of the world, this calculation is quite easy because risk-free rates are close to zero. A high Sharpe ratio indicates a higher risk-adjusted return, while a low Sharpe ratio indicates a low risk-adjusted return. I'll demonstrate how the calculation works by using the two asset classes I mentioned earlier. Let's say that U.S. Treasuries have given us a return of 3% with a volatility of 5%, while the risk-free rate was 1%. That would make the Sharpe ratio 0.4, 2% divided by 5%. Now let's say that U.S. equities returned 14% with a volatility of 10%, similar to their return in 2014. That would give us a Sharpe ratio of 1.3, 13% divided by 10%. 1.3 beats 0.4. In this example, equities have delivered a far superior risk-adjusted return. If only that were always the case, our job would be easy. So why does risk-adjusted return matter? Why wouldn't an investor prefer a return-maximizing portfolio with 100% in risky assets? After all, over time, that strategy has performed very well. The problem with this, as most of us know, is that very volatile investment strategies are often difficult for investors to stick with when times get tough. So including other asset classes with positive Sharpe ratios but lower expected returns is optimal for nearly all investors. By doing this, we sacrifice higher returns for higher risk-adjusted returns and, in all likelihood, increase the probability we stick to our investment plans and meet our financial goals. Risk-adjusted return is particularly important for investors whose portfolio returns make up a large portion of their total income, such as those in or near retirement. These investors are subject to what we call sequence risk. Because they must withdraw from their portfolios over time, they care very much about the sequence of the returns they receive on their investments. Significant losses in the first few years of retirement can make it difficult for investors to meet their financial goals. For example, those who retired in 2007 and began withdrawing from their portfolios could have found their invested assets cut in half after just 1 year, but their cash flow needs unchanged. Depending on how much they withdraw each year, this could have been a significant obstacle to sustaining their standard of living throughout retirement. Designing a portfolio with risk-adjusted return in mind may sacrifice some upside in order to avoid the kind of volatility or drawdowns that can knock investors off course. I hope you found this video helpful. Investors who internalize the concept of risk-adjusted return are well on their way to understanding how to build an asset allocation, benefit from diversification within and across asset classes, and give themselves a smoother investing ride than they would otherwise have had. Thank you again for watching.
Hi there. So in this third module, we're going to have a look at other financial markets. After the main categories, fixed income, money markets, and equities, we'll look at some alternative asset classes or alternative markets. We'll talk about emerging markets, we'll talk about gold, and we'll talk about alternative assets. In these, definitions vary, but generally people include hedge funds, they include private equities, and sometimes real estate. Some pension funds include real estate in alternative assets. What do we mean by alternative? Well, there's a big debate going on here, and we'll talk about that, whether we should consider these, for instance, hedge funds as a separate asset class, like currencies. So we will see what happens when you include poorly correlated or better even uncorrelated assets in a traditional portfolio, you improve diversification. We'll see that when we talk about real estate and hedge funds.
Hello, this is me again, Ines, and today we're going to talk about emerging markets, equities, and bonds. After this video, you should be able to describe the relative capitalization of emerging market equity, understand the market development of emerging markets, define investability and measure the investable weight factor, describe the risk and return characteristics of emerging market equity, and understand the other risk considerations and investment barriers that you should be aware of when thinking of investing into emerging markets. So let's start with the size of emerging markets. In terms of market capitalization, emerging market equity represent about a quarter of the total world market cap. So if it's optimal, and we'll see when it is optimal to do so, if it's optimal for you to hold the world market, you should be investing a quarter of your portfolio should be allocated to emerging markets. So that's a large size, a large investment opportunity. Now, we know that emerging markets have high growth, high GDP growth, but their market cap is still only a small fraction of their GDP. And this market cap to GDP is usually used as an indicator of market development. So as you see here in this graph, we're showing this market cap to GDP ratio for some developed markets, these are the green bars, and some emerging markets, these are the blue bars. And as you can see here, the market cap to GDP ratio, for example, for the Switzerland exceeds 150%, while for a market such as Mexico is barely 30%. What makes or what could increase this market cap to GDP? So remember, the market capitalization is what? Is the price of a stock times the number of shares. And then at the market level, we're just aggregating this market cap of each stock. So to increase this market cap, we need more listed stocks or higher price, or both. So privatization, for example, is a way to increase this market cap. And emerging markets embarked into privatization during the 90s, and they continue to do so. Now, not all of this market cap is investable. So what's this investability? So the investable weight factor is defined as 1 minus the sum of the percent held by strategic holders. So let's take an example. If we assume that we have 1 million shares of a stock, call it A, where 200,000 means 20% are held by a family owner, another 10% held by the local government, and another 10% held by another publicly traded company, call it B. So the investable weight factor is what? Is 1 minus the sum of the 0.2 plus 0.1 plus 0.1, so that's 1 minus 0.4, that's a 0.6 investable weight factor that we also call a free float. Now, investability should also take into account foreign ownership limits. And emerging markets have embarked into financial liberalization and many reforms that help to open their market to foreigners. If we compare investability in 1992 and 2008, for example, we see that for many emerging markets, investability has increased. For example, for Mexico, only 10% of the market was investable, meaning legally, practically available to foreign investors. Now, more than 80% of the market is open to foreign investors. Why we care about liberalization? It's important because it has an impact on valuation of emerging market equity. And as we talk more about how to price securities, we'll understand better what happens, but actually what happens is that the price of emerging market equity increase following liberalization and the increase in investability. Now, when we say that these markets are legally practically open, does not mean that foreign investors are coming and investing. It could be that they are not, they are shying from these markets because of implicit barriers. We have explicit barriers and implicit barriers. And when we talk about explicit barriers, these are withholding taxes, the fact that you cannot, for example, repatriate your capital, or foreign exchange controls. So all these are explicit barriers. Now, implicit barriers take the form of lack of familiarity. You don't know the language. You cannot read, say, Chinese, so you cannot read the financial statements of Chinese companies. Or you feel that these markets are quite opaque, are not transparent. You're concerned about governance issues at the state level and at the corporate level. At the state level, you fear expropriation by the state, for example. At the corporate level, you fear that the manager is trying to extract private benefits of control. So these are the implicit barriers that could push investors away from investing into these markets. There's another issue here is what we call the home bias, the fact that investors prefer to invest at home, so they overweight their local stocks and underweight the foreign stocks. And this is quite a general phenomenon. It's not only particular to when we talk about investing into emerging markets. Let's now see the return and risk characteristics of emerging markets. And actually, we have seen some of these numbers, if you recall, when we talked about basic finance video. We saw that emerging markets offer higher average returns compared to developed markets, as you can see it here as well in these tables, but also they have higher volatility. And in terms of reward to risk ratio, they can offer higher reward to risk ratio compared to some developed markets. So as you see here, some of the emerging markets offer higher reward to risk ratio. But remember, we should not only be looking at the average return and volatility, we should also consider what happens in the tail of the distribution of the returns. Why this high average return for emerging markets? This is because of higher risk. So what type of risk we're talking about? Here, we're talking about, for example, political risk, or in general, country risk that encompasses political risk and economic risk. And you have seen that with Michelle. So political risk is associated with a willingness for the country to pay, and economic risk and financial risk are associated with the ability to pay. So as a foreign investor, you would want to go and invest in more stable countries. Many services provide us with this risk ratings. For example, the Political Risk Services International Country Risk Guide, plotted here, show us that Switzerland is a safer country. So here, higher rating means higher political stability, lower political risk, compared, say, to India. What other risk considerations? There is also macroeconomic risk, the risk of uncertainty in GDP growth, in inflation, liquidity risk. This is quite important for emerging markets. Emerging markets are less liquid than developed market equity. High transaction costs, high price impact. If you try to trade a large block, prices could move against you. And there's also this currency risk. Well, currency risk is an issue whenever you try to invest abroad because you care about your local currency returns, and these are equal to the return that you can achieve in the foreign investment plus the change in exchange rate. So part of the volatility of your returns are due to currency risk. And currency risk is particularly important for emerging markets because of the volatility of their currencies, but actually it's still the case that a lot of the volatility is due to equity returns. So currency risk, especially over the long term, is not important for equity. So to summarize what we learned in this video, and what you should be able to do after this video is to describe the relative capitalization of emerging markets and their degree of market development, define investability and measure the investable weight factor, understand the investment barriers, explicit and implicit barriers, describe the return and risk characteristics of emerging market equity, and understand other challenges and risks when investing into emerging markets. Hello, this is me again, Ines, and we continue talking about emerging markets, but now we're going to talk about bonds. After this video, you should be able to describe the relative size of emerging market bonds and distinguish between local currency denominated and dollar denominated bonds, describe the returns and risk of emerging market sovereign bonds and how they compare to emerging market equity, compute a yield spread given the yield for two securities, and describe the factors that determine the sovereign yield spread. If we look here at the relative contribution of the bonds, so we distinguish between the government bonds, and these are issued either in local currency or in dollars, and the corporate bonds. And we see that the government bonds represent more about 3/4 of the total market cap of emerging market bonds. What's interesting here also to see is that a larger fraction is due to local currency bond. So historically, and following the debt crisis of many Latin American countries, these countries were issuing bonds in hard currency, in currency of highly stable governments such as dollars, the pound, the yen, the Swiss franc. And this is actually the bonds that attracted foreign investors. But this creates a currency mismatch for the emerging market government. And now they embarked into developing their local currency bonds. And this local currency bond represents now about 53% of the total capitalization of the emerging market bonds. How about the return and risk characteristics of these sovereign bonds? Now, when I say sovereign bonds, it means bonds issued by the sovereign, or equally I could say government bonds. So you see here that emerging market bonds, sovereign bonds, have higher return compared, for example, to the Treasury. It's not shown in this table, but these are higher returns, but also higher volatility. And what's also interesting to see here is that if we compare to equity, the emerging market sovereign bonds have lower volatility. Another interesting thing we should look at is the yield spread. And it's defined as the difference between the yield on a sovereign bond, let's say, issued by an emerging market such as Brazil, in dollars for some maturity, and this bond issued by the US Treasury for the same maturity. So the two bonds have the same maturity, the same denomination, both are in dollars, but one is issued by the Brazilian government and the other one is issued by the US Treasury. The US Treasury is safer, so the difference between the two yields measure the yield spread. Let's take an example. The Brazilian 10-year dollar-denominated bond has a yield of 7%. The US Treasury with the same maturity 10 years offer a 2% yield. So here we have a yield spread of 7 minus 2, about 5% or 500 basis points. So let's try to understand this, what determines this yield spread. So what are the risks when investing in sovereign bonds, and specifically emerging market sovereign bonds? So the first is interest rate risk, typically measured by duration. There is also the country and credit risk. It used to be quite high, especially actually for dollar-denominated bonds. And now that emerging markets managed to stabilize their inflation, to stabilize their government and their political risk in general, they are able of issuing bonds with higher credit rating. Then we have currency risk. So the currency risk is not an issue for dollar-denominated bonds, but is definitely an issue for local currency bonds. And unlike for equity, currency risk is quite significant for bonds. So you are a Swiss investor and you invest in the Brazilian sovereign bond issued in Brazilian real. So you care about returns in Swiss franc. So the Swiss franc return on this Brazilian sovereign bond is the Brazilian return plus the change in exchange rate, franc versus Brazilian real. And a large part of the volatility in your return is going to be due to the change in exchange rate of the real versus the Swiss franc. The other risk is liquidity risk. Sovereign bonds have higher transaction costs, high bid-ask spread, and higher price impact compared to bonds issued by developed market governments. So what determines yield spread is essentially country and credit risk and liquidity risk. And liquidity risk can be quite significant, especially during crisis periods, as the one we witnessed during the credit crunch of 2008. So to summarize, after this video, you should be able to relative size of the bond market, distinguish between local currency denominated and dollar denominated bonds, understand the risk and return characteristics of the sovereign bonds, measure the yield spread given the yield for two securities, and describe the factors that determine the yield spread.
Hi everyone. Today we're going to have a look at the gold market. With this video, you will find out that gold has been around for many years, indeed more than 6,000 years. It has been used as a means of exchange, as an investment, as backing to the monetary system within the gold standard. And we will see in a second video that it can serve even today as a hedge to many things like a falling US dollar, rising inflation, collapsing stock market, or political tensions. Some hard facts about the gold market. Indeed, it's been one of the oldest ways to store wealth, and it can be traced in Egypt to at least 1400 BC. Some estimates put it even more, going back to 3000 BC. It was used as a means of exchange. We mint gold coins, and it was also used obviously for jewelry purposes and as a store of value, as an investment, but more importantly, and this was in the last century, as a backing to a fiat currency system, i.e. Under the gold standard, a central bank would only be allowed to increase the money supply in accordance to the stock of gold it owned. Some historians, like Barry Eichengreen, argue that this was one of the reasons why we had the Great Depression in the US, i.e. it was the inability of the US central bank to conduct a sufficiently easy monetary policy, expansionary monetary policy after the stock market crash of 1929, because it was linked to the stock of gold it owned, and so it could not increase enough money supply. In 1971, Nixon abandoned the fixed convertibility of the US dollar to gold, because basically there was a need to increase quite substantially the amount of dollars in circulation to cover for military expenses and a ballooning current account deficit. Recently, a couple of years ago, I was in Erbil in Kurdistan in Iraq at a conference. And I found out there the story of the Swiss Iraqi dinar. Now, let me tell you, this is quite a funny story. I put it to some people at the Swiss National Bank, and they didn't know about it. Indeed, the Swiss Iraqi dinar was the currency in circulation in Iraq prior to the Gulf War of 1990. And when the war started, then it was abandoned, and they went to a straight Iraqi dinar. But the Swiss Iraqi dinar coexisted. And indeed, it was more stable than the official currency. And why was that? Because people thought it was backed by gold owned in Switzerland. And this was total illusion. It was just a rumor. And indeed, when people found out that it was not proven by hard facts, the Swiss Iraqi dinar collapsed like the official currency, and it disappeared from circulation. So there is this idea today, and you find still quite a lot of pundits of gold that argue that we should go back to some kind of system backed by gold. For that would constrain those central banks to create money just in a limited and controlled manner and stop going into an easy printing mode to pay for public deficits. So whether we should go back or not to the gold standard is a separate issue, but surely the question remains open of whether we should anchor the international monetary system to a stable variable like gold in order to limit the supply and prevent monetary excesses. Let's start now with the first hedge that gold provides, and this is the hedge against the falling dollar. Now, why is this? First, before we move into this, let's do a little quiz here. You see from this chart that we have two lines which are plotted. The red line is actually on the right-hand scale, and it starts at $35. And it ends at just about $1,000 today. Now you see, wow, well, this is kind of odd, isn't it? Well, actually, you can see that this is a logarithm scale. So you see the distance between 0 and 100 is the same as between 100 and 1,000. This allows us to show a key variable which has increased, like gold, quite substantially over the years. So question to you is, what was the return of gold between 1971 and today on an annualized basis? So now that you find out how much gold has delivered over all these years, and you've seen that it's quite a decent return, we can see from this chart that it's actually the movements of gold are inversely related to the movements of the dollar. We see this when we look at these two lines, and you know me by now, you know that I make use sometimes of these funny scales. For instance, here we see the green line, which is the US dollar as measured against the basket of currencies of the trading partners of the United States of America. We see, for instance, that between 1980 and 1985, the line falls, but it's actually a rise in the US dollar against all these currencies because the left-hand scale is inverted. So there is this idea that gold and dollars and the US dollar are inversely related. The correlation is significantly negative. And the reason for that is that gold is mostly denominated in US dollar. So the reasoning is that when the US dollar falls, the attractiveness of gold for non-US dollar based investor increases. And so they purchase more gold when there is a fall in the dollar. Especially so that they are in the need for a new safe haven, because maybe there are some political tension, and we'll see one example in the next video. So now that we've seen that gold has been used for many years as a store of value, as a backing to the fiat monetary system, we'll see in this second video that it can also serve as a hedge against various types of events like political tension, inflation, or collapsing stock markets. The first of these is political tension. So what we see on this chart is the price evolution of gold between 1978 and 1981. You may remember that during this period, exactly between November 79 and January 81, for 444 days, there was the so-called Iran hostage crisis. During this period, you can see that the gold price rose quite substantially and went from 400 and more than doubled to 800. So there's always this idea that when there is political tension or fear of war, investors look for safe investment, and they find the answer more often than not in gold. Okay, so now let's have a look at another key hedge which is provided by gold, and that's the hedge against inflation. You can see from this chart that we have two lines here. The red one is the price of gold, but here it's not in level or in logarithm terms, it's in percentage terms relative to the prior year. And in blue, that's the price of gold also in percentage term year on year. And you see that the correlation between both lines is actually quite high, it's 0.65. And you can see, for instance, that in the 70s we have these peaks of inflation rising at double-digit numbers, and it correlates pretty well with also peaks in the gold price. Now, what is the rationale for the hedge of gold against inflation? Well, academic research shows that the reason for this hedge is that investors basically look for a stable, again, currency when central banks embark on excessive money printing, which leads to inflation down the road. So expected inflation increases. And when there is this increase in inflation, people look for a currency which supply cannot be increased very easily, like printing money. And this is the reason why, and it's proven by empirical evidence, that when there is fear that there's going to be inflation down the road, people look for a stable anchor, and they found it in gold. So now that we've seen that gold can provide a hedge against inflation, let's look at some other types of hedges which can be provided by gold. But first, a question to you, and that's a quiz. For you, what is the cost of owning gold? Let's pause for this for a minute and think about this. If you buy gold, is there a cost when you do so? Now that you know that the cost of gold is an opportunity cost, it's basically the return you would yield if you put money in your bank, and ideally measured in real terms. So the nominal interest rates which you gain on your deposit subtracted by the inflation rate. Let's see if there is a link between this cost of owning gold and gold itself. And this relation we put here, and you see the red line is gold, again here in levels, on the right-hand scale and in logarithm terms. And we put the real federal funds rate, which is as you know, the benchmark which is used by the US Central Bank, the key interest rates it uses short-term interest rates in real terms. And here, yet again, a subtlety, the scale is inverted. The left-hand scale is inverted. So the drop in the blue line, like it happened in 1980, is actually an increase in the real Fed funds rate. Okay, and as you can see, there's actually a pretty good correlation here too between the cost of owning gold and the performance of gold. For instance, you see here during the 70s, the real federal funds rate oscillated quite a bit, but by and large it was largely negative, an average of possibly minus 2%. So indeed here you can say that there was no cost of owning gold. Actually you were even paid in a way to own gold, because if you leave your money at the bank, at the end of the year, if you deduct inflation, and since inflation, as we've seen in the previous slide, was very high during this period, the nominal return you made on money was a bit below inflation. So in real terms, you actually lost purchasing power. So in this kind of environment, obviously it makes sense to own gold. And you can see that it went from a staggering increase. It increased by the official rate under the gold standard of $35 to a staggering $800 during the Iran hostage crisis. Then throughout the 80s, and I would say up until the beginning of 2000, the real federal funds rate oscillated also quite a bit, but stayed mostly in positive territory, indeed quite substantially so in the most part of the 80s, when it averaged 5%, which is quite high. So obviously when you make 5% with no risk or very little risk, only leaving your money at the bank, 5% in real terms, you don't have many incentive to buy gold, whose price can fluctuate quite a bit. And then back to 2004, I would say then the real interest rate went negative again, fluctuated also quite a bit, but stayed there, and obviously stayed in negative territory as central banks embarked in easy monetary policy. So in this kind of environment, it's again attractive to own gold. And just very recently, we see that gold has abated quite a bit. The price has fallen. It almost reached a peak of 2,000, and now it's back to 1,000. And one of the reasons is that there is this expectation that the US central bank will embark on more tightenings of the interest rates, as it did just a couple of weeks ago. Hey, you know what? When you talk about gold, we just have to mention catch-up. And to be more specific, catch-up inflation. Now, let me illustrate this. Now, you remember the Big Mac? The Big Mac we showed, and there were 3 actually when we talked about currencies. I'm sure you've been through this experience before. It's quite a difficult experience, but I'll show you what do I mean. You have this, ketchup, and you want to add a bit more on this Big Mac because you think it's a bit dry. So you start taking the bottle and you start shaking it, and you keep on shaking it, and you keep on shaking it, and nothing happens. And there you go. So this is the story of catch-up inflation, and we'll see what we mean by that. Actually, it's a story of central banks when they print money. This is the catch-up inflation. This is it. So now that you have a sense of what catch-up inflation is, we'll see how you can hedge against this type of very nasty event. But before we have a look at this kind of hedge, let's see what gold can provide you as an insurance against some type of nasty events. And one of the examples here is the stock market. Indeed, we can see from this chart that gold can hedge you against adverse movements in the equity market. What you see from this chart is in red the evolution of the price of gold in US dollar and in percentage term year over year. And we have the same percentage term year over year for the blue line, but that's the world index as captured by the MSCI. Again, now you know me a bit. I use this funny scale. The right-hand scale is inverted, so a fall in the red line is actually an increase of the value of gold. And we can see that we have two of these periods when the stock market went through a severe crisis. We can see that, for instance, when the stock market tumbled by 20% at the beginning of the year 2000, the gold price rose by an equivalent percentage of 20%. And also during the so-called Great Recession, when the stock market collapsed by more than 30%, the price of gold rose by the same percentage. So there is indeed this good correlation, by and large, between the evolution of gold and that of the stock market. But I would say if there is one reason to own gold, is the insurance against this. Now, what is this? This is a black swan. You remember the introductory video we did at the park, and when we saw that black swan? Well, the black swan idea in finance is one of a very unlikely event, but if it happens, it has very, very nasty consequences. This is, for instance, the Fukushima in Japan, the nuclear plant which burst and leads the country into a severe recession. So black swans should not be underestimated because they are very unlikely, and more often than not, people stop there and they say, oh, it's very unlikely, therefore I should not bother too much about it. But no, that's wrong, because you should combine the probability, but also the damage it leads to. The two combined makes you that you should consider black swans. A very unlikely event, but very nasty consequences. Now, let's have a look at another example than Fukushima as the black swan. And one of these examples is the so-called catch-up inflation. Now, you saw in the introductory video what it means, why we use this idea, and you can Google catch-up inflation, you will see what it actually means. Well, what does it mean? Well, catch-up inflation comes when central banks print money. We know that indeed, there's always a link between money creation and inflation. Normally, this link is stable. Central banks can embark on excessive money printing, for instance, if they have to finance public deficits. They embark into this quantitative easing, this unconventional policies, and money supplies goes through a staggering increase. So if you print too much money, at some point, maybe there is a risk that people lose faith in this paper currency, and they say it's not worth even the ink which is used to print those currency. So what happens then is that people, when they get their wage, they start rushing to the shops and buying goods because they fear that maybe at the end of the month the price will have risen. And so what we get is a so-called increase of the velocity of circulation of money. The money is given as a wage, and people spend it at an increasing pace. And this increasing pace of spending the money, of circulating the money, leads to a spiraling inflation. Inflation starts increasing and increasing and increasing, and it ends up in hyperinflation. So catch-up inflation is precisely that. At the beginning, you print money, you shake the bottle, and nothing happens. But you keep on shaking it, and suddenly, splash, inflation is there. And once it's there, it's kind of self-feeding. Inflation today leads to more inflation tomorrow. So this is the kind of very nasty event, a black swan, meaning something very unlikely but very nasty consequences. So by now you know what is the main reason, and this is why we call the set of 3 videos gold the ultimate currency. If this very unlikely event happens, there is a rationale to think that gold would be used again as an anchor to the international monetary system and would be considered as a stable currency. So, in conclusion, we've seen with this set of 3 videos that gold has served many purposes in finance, but basically as a means of exchange throughout history, going back to 3000 BC. But it can also serve as a hedge against many things, against a collapsing dollar, against political tension, against rising inflation, against stock market crashes, and last but not least, against so-called black swans, very unlikely event, but if they do materialize, hey, watch out. This is a very, very bad thing that can happen to you.
By the end of these 2 videos devoted to real estate, you will know the main features of real estate investments, the size of real estate markets, the main types of real estate investments, who the main players are in real estate markets. You'll know the differences between direct and indirect investments, and you'll understand some of the financial benefits associated with investing in real estate. Real estate has some unique features that it is important to understand when considering real estate investments. Well, first of all, real estate is quite a broad category as it encompasses both housing and commercial real estate. Real estate assets are heterogeneous in the sense that there are two assets are always going to have some differences in characteristics, differences in size, age, condition of the building, location, etc. The value of assets is rather high, and as a consequence, you need large amounts of money in order to invest in real estate, except for securitized investments, and we'll come back to that in a moment. Location is very important. It's one of the most important drivers of real estate returns. And as a consequence, local knowledge is important. You cannot invest in real estate if you don't know the local market. Most assets are not very liquid, meaning that it takes time to sell an asset, and markets are usually not that transparent, i.e. it's difficult to gain access to transaction prices and to the characteristics of the assets that have been sold. Given the infrequent trading of real estate, value is often quite difficult to measure, and cycles are quite pronounced on real estate markets. And to illustrate the cyclicality of real estate, let's consider this graph, which pertains to commercial real estate markets in the US. And if we look at the green line, which are office markets in the central business district areas of the major cities in the US, well, you see that to begin with, over the first 7 or 8 years, the markets went up by roughly 100%. And then during a roughly 2-year period, the market went down by 50%. And now, since 2010, the index has gone up by roughly 200%. So real estate markets are cyclical. The size of the market is worldwide is estimated at $34 trillion US dollars, and that's only commercial real estate, i.e. housing is not included in that figure. And if we compare the figure with the figures for stocks and bonds, you get the relative weights of the 3 asset classes on the graph. So you can see that real estate is about 20% of the combined value of the 3 asset classes. And if we were to consider housing as well as commercial real estate, the figure would be in excess of one third. So more than 1/3 of the value of the assets would be in real estate assets. Now to the main types of investments. Well, first of all, we have housing, and housing includes both houses and so-called condominiums. Then we have multifamily residential, i.e. apartments, and then a number of other commercial real estate categories, the main ones being offices, retail, hotels, industrial, etc. And in etc. you have vacant land. Who are the main players on real estate markets? Well, on housing markets, it's mostly private investors, households buying their house or their condominium. On commercial real estate markets, you've got a number of important players, including institutional investors, pension funds and insurance companies, and sovereign wealth funds, the importance of which has grown quite a bit over the past 10 years. Then you've got a number of funds which invest in real estate, got real estate companies, and you've got the corporations which need properties in order to undertake their activities. So this concludes this first video on real estate. In this video, we'll try and understand the differences between direct and indirect investments, and we'll discuss some of the financial characteristics associated with investing in real estate. So what's the difference between a direct and an indirect investment in real estate? Well, a direct investment in real estate is when you purchase a property. Whereas an indirect investment is when you buy a share or a stock of a fund or of a company which holds real estate assets. And within the indirect category, you've got so-called non-listed funds and you've got real estate securities. Non-listed funds are indirect vehicles, the shares of which do not trade on a stock exchange, whereas securitized investments is when shares of companies are traded on a stock exchange. And often we refer to non-listed funds as being private real estate and as real estate securities being public real estate. What are some of the pros and cons of going direct versus going indirect on real estate markets? Well, if you go direct, you're going to have full control over the assets. You can select the assets, you can select your tenants, you can set the level of rents, and you'll get the full diversification benefits stemming from the fact that real estate returns are lowly correlated with the returns on stocks and bonds. Some of the cons of going direct is the fact that, well, assets are not very liquid, and hence it takes time to sell an asset if you want to exit the market. And another disadvantage is the fact that you need large amounts of money in order to go direct. If you go through the non-listed fund route, well, you also get the portfolio diversification benefits. You can enter the market with a much lower amount of money. However, you still have, in most cases, the illiquidity of the investment. And this is just the opposite for securitized investments. Given that they trade on a stock exchange, they're going to be much more liquid. And, well, you can also enter the market with a limited amount of money. But there is a major drawback associated with going through real estate securities, is the fact that real estate security returns are usually highly correlated with stock market returns, and hence you do not get the full diversification benefits. Now to some financial characteristics, and we're going to focus first on the return and risk of real estate and compare those features with the return and risk features of stocks and bonds. And to do so, I'm going to use some data for the United States for the time period from 1990 to 2015. And the figures we have here are annualized figures, and we see that the average annual return for real estate was 9% with a volatility of 11.5%, and that the return and risk features are in between the return and risk features of stocks and bonds. And you can also see that on the Sharpe ratio, which gives you the excess return per unit of risk. And the Sharpe ratio for real estate, again, is in between the Sharpe ratio for stocks and bonds. And another interesting feature which emerges from this table on the last row is the fact that the correlation of real estate returns with the returns on stocks and bonds is very low, at roughly 0, and hence that diversification benefits should exist when including real estate in a portfolio. And that's something we can see quite clearly on this graph on the left-hand side of the chart. So what do we have? Well, we've got the return volatility space, and we've got the three asset classes: bonds, real estate, and stocks. And real estate is indeed in between bonds and stocks in terms of return and risk. And then we've got a line in blue, the so-called efficient frontier, which contains all of the optimal combinations of the three asset classes. And the concept of efficient frontier is something you'll look into in more detail further on in this specialization. And well, how can you see that real estate provides diversification benefits? Well, for a given volatility, you can increase the portfolio return when adding real estate to your portfolio, or for a given return, you can lower the risk of your portfolio when considering real estate. And on the right-hand side of the slide, you've got the relative weight of the three asset classes for various portfolios on the efficient frontier. So completely on the left of the graph, you've got the allocation to the three asset classes in the portfolio with the lowest return and the lowest risk. And you can see that, well, you should hold approximately 10 or 15% in stocks, about 10% in real estate, and about 70 to 80% in bonds. And as you move towards the right and towards the upper end of the efficient frontier, the allocation to real estate, the area in green, well, it increases up to a certain point. The allocation to stocks also increases, whereas the allocation to bonds decreases. And well, you get to roughly 3/4 of the frontier, and then the allocation to bonds disappears. You're left with stocks and real estate. And as you move towards the portfolio with the highest return and the highest risk, well, the share of stocks increases, and you're left completely at the upper end of the frontier with a 100% allocation to stocks. And there are two other financial benefits associated with investing in real estate that I wanted to mention. The first one is the fact that given that real estate markets are fairly local, international diversification is very beneficial. So you should not only invest across cities, but also invest across countries or continents. And another important feature of real estate is the fact that real estate usually provides a hedge against inflation. So when inflation goes up, then real estate returns should be going up as well. Well, largely because rents can usually be adjusted when inflation is soaring.
Hi there. So in this set of 3 videos, we're going to talk about hedge funds, how we can define them, who created the first hedge fund, where they come from, You'll see that this goes back to 1949. And we'll also have a look at the two main tools that the first guy who created the hedge fund used, and the tools are still very much in use today. And we're talking here about leverage and short selling. So at the end of the set of these 3 videos, you'll be able to better understand what a hedge fund is and understand also how he delivers these very good returns, at least that's the idea, using both leverage and short selling. Defining hedge funds is best done if you look at their objective. And indeed, it's quite a challenging objective, but a very powerful one. Basically, hedge funds are striving to deliver positive returns irrespective of market conditions. And we'll see how they can achieve this very ambitious objective. The other characteristics of hedge funds is that they can use leverage and short selling. And we'll define in a moment what these two key concepts are. The second characteristic is that they don't need to be permanently invested. This is indeed a major difference with traditional fund managers. Normally, they have to remain fully invested in their asset class. Hedge fund managers, they may exit this asset class if they think it's no longer attractive. And the third characteristic is that remuneration of the hedge fund manager is a combination of management fee and performance fee. There's this rule, what we call 2 and 20. So generally, hedge fund managers will collect 2% on the assets which they manage, and they will also collect 20% on the performance they deliver. And the fourth characteristic of hedge fund manager is the so-called eat your own cooking rule. And what do we mean by that? Well, what do we mean by that? Let's pause here for a while and see what would be your idea of eating your own cooking. Or, as we also say, put your money where your mouth is. Well, the idea here is quite simple. When we select a hedge fund manager, we basically ask him one question, is how much of your personal wealth do you invest in the fund which you propose to me as a client? Because we want to make sure that the hedge fund manager will not do something silly with our money. And the best way to be sure about that is that he is also a partner. He's managing the fund also for his own interest. So this is the best assurance that we can have that he will not do something silly with our money. Okay, so how did hedge fund come into existence? Well, it was this man, Alfred Winslow Jones, who you see here on the picture, who invented, without knowing it, the first hedge fund. This was in 1949. Basically, he was interviewing money managers on Wall Street, doing an article for Fortune magazine. He was not very impressed with what he saw and heard from these money managers. And what he came up with, he said, maybe I can be just as good as these people I'm interviewing. And basically, he came back from all these interviews with two main ideas. One was he may not have much to say about where the market would be going the next day or in 3 weeks' time or in 3 months' time. So not very good at market timing. But he claimed he could be just as good as all these money managers he interviewed at identifying undervalued securities and, more importantly, overvalued securities as well. And he could make profits on both sides. So buying undervalued securities and going short, and we'll see how you can do this in the overvalued securities. And what he did, this Alfred Winslow Jones, he basically gathered money from family and friends, and his own money, obviously. You remember the rule, eat your own cooking. So he collected altogether $100,000, and he started investing So by this rule, investing in undervalued securities, going long, and going short in overvalued securities. And he had just staggering results. By 1966, Jones had become, as a famous professor of finance wrote in the Journal of Finance, the Jones nobody can keep up with, basically outperform all his peers and a reference to the famous expression to keep up with the Jones. Let's have a look at the first of these tools which Jones used, and that's leverage. How does it work? But basically, leverage is a performance booster. The idea is that on top of the assets which you own and you're going to invest, you borrow some additional assets and you also invest these. So altogether, you will be making money on a larger pool of assets, yours plus the ones you borrow, and this is how you boost the performance. So let's have a look here with this example. Basically, you have 100, say it's a $100,000 in your hedge fund, and you make 10% at the end of the year, all right? So you win $10,000, okay? Now, this is without leverage. Okay, now you want to increase performance, so you do this by borrowing an additional 100. So you're not investing 100, but you're investing 200, the 100 you own plus the 100 you borrowed. And you're still making the same 10% in your underlying investment, but now 10% of 200 is 20. And the 20, once you put them in relation to your own capital, once you've refunded the 100 you borrow, is actually 20%. So you see that basically with leverage, you boost your return by a factor of 2. So what was initially 10% has become 20%. So this is how you increase performance through leverage, is by borrowing funds and investing those funds. The problem with leverage is that it works both ways. If it goes up by 10% with leverage, you can double the money, but you can also double the losses. If the underlying assets fall by 10% and you're leveraged with a factor of 2, then you can lose 20% instead of 10. Okay. Now, quiz to you. Is leverage equal to risk? As we see that basically with leverage you're boosting the returns or the losses. Can we equate that with the notion of risk? And here I give you one quiz that you need to answer. Remember this formula we showed that gives you the link between interest rate risks and the bond price, so the formula with the duration? Well, here I give you two examples. I say, what is riskier for you? Is it a bond portfolio with a duration of 10 and no leverage? Or is it a bond portfolio with a duration of 1 and a leverage of 5? So in one case, you're managing a bond portfolio with no leverage, but just a very long duration, 10. And in the second case, you're managing a bond portfolio which is very low risk, a duration of 1, so a very low sensitivity to changes in interest rates, but you're gearing it by 5 times. You're using a leverage of 5 times. By the way, how much are you borrowing to get a leverage of 5? Don't say it's 500. If you're managing 100, it's not 500, it's actually 400. So you have 100, you borrow 400, and that makes a total of 500, which you're investing in this bond portfolio. So this is a gearing or a leverage of 5. So what is riskier for you? All right, so you answered the quiz. Hopefully you got the right answer. So just to do an analogy for you to really understand the difference between leverage and risk, take a look at these two pictures. And I ask you the following question now. Is it riskier to drive on this motorway at 130 kilometers per hour? Or is it riskier to drive in this very icy and snowy road in the mountains at 80 kilometers per hour? Now, some people may notice that on the first picture, there's actually a camera. And given that the speed limit, at least in Switzerland, is 120 kilometers per hour, it can be somewhat risky. But let's leave this issue on the side. And then let's say it's 120 and not 130 kilometers per hour. Okay, so clearly you get a sense of where I want to get to. It's actually riskier to drive at 80 kilometers per hour on this icy road than at 120 on the very dry motorway with no cars in it. So basically, global risk is a function of underlying conditions, which we call road conditions, the underlying market and the volatility of this market, and the leverage. And leverage is the car speed. Okay, so you can use a lot of leverage, and if the underlying asset does not bear a lot of risk, so this very dry motorway, so the global risk will not be very high. Conversely, you can drive very slowly, so not, or reasonably slowly, but say 60 kilometers per hour, but the road is very, very icy, so the risk of the underlying risk is high. So even that 60 kilometer or 80 kilometer per hour may actually mean that the global risk is actually very high. Okay. Hi there. So now we're going to have a look at the second instrument which Jones used to deliver these staggering results. And this is short selling. Well, the beauty of short selling is that basically you're selling something you don't own. Now you can tell me, how is this possible? Normally you can only sell something which you own, right? Well, the idea here is quite simple. You borrow a stock and you sell it. So how does it work? Basically, I'm a hedge fund manager, and I've identified that firm XYZ is actually completely overvalued. The managers of these firms are doing something, have got, in my view, completely wrong strategy. They're not well positioned, and they're going to lose money, so the stock price will be penalized. So what I do is I call an investment bank and I say, I'd like to borrow one share of this firm XYZ. So basically, they'll give it to me and say it's worth 100. Okay, so what I'll do, I'll take the share and I immediately sell it on the stock market for 100. So I get 100 in cash back. Now, the trick here is that I won't be able to go on holiday with this 100 I just put in my pocket or buy some other securities which I think may be undervalued. So why? Because the company, the investment bank, which has lent to me this stock, is going to say, hey, Michel, I lend you this share of firm XYZ. You sell it. Now you get 100 in your pocket, but you're not going to put it elsewhere. You're going to keep this 100 on an account here within my bank, and we're going to have this as a collateral, as a guarantee if something bad happens, and we'll see what that means. So basically, I keep the 100 and I put it on the bank account with the investment bank, which has lent me the stock. If I'm right about the fact that the price is going to fall, basically at one point I may decide, say the price collapses and goes from 100 to 50. At 50, I decide I may exit the deal. And what I do is I call the investment bank and I say, hey, you know what? I'm closing the deal, so give me my 100 back. With that 100, I'm going to purchase the share of XYZ at 50 and give it back to you. Okay, so I purchase at 50, I give back your share, and I keep 50 in my pocket. So this is how you make money betting on a price fall. It's quite original, actually. It's basically you borrow the stock, and at time T, and at time T plus 1 or T plus 2, when the stock price has fallen, you give the share back, but you pay it at a lower price, and you make money on the price difference. Okay, so now you see the point. If actually the stock price of your firm, if I get it wrong, and the stock prices increases, does not decreases, but increases, what is going to happen? Well, something very nasty is going to happen, because I'm going to get a call from the investment bank saying, hey, Michel, you know what? I gave you the stock at 100, but now it's worth 120. And remember, you put this 100 on the bank account, and now you only have 100 to cover for something which is worth 120. So this is not going to make it. So you may have seen this movie called Margin Call. Okay, so I get this call from the bank, say, hey, Michel, you need to sell some of your asset elsewhere and put an additional 20 on the bank account to serve as guarantee against the short position that you have. So question to you, do you think that being wrong when you're long, i.e. when you're buying an undervalued securities, is the same as being wrong when you're short, i.e. when you're selling short, with just example I did now, an overvalued security? Do you think that both risks are the same? So the answer to the quiz is that no, it's not the same. If you're wrong when you're long, i.e. you're buying an undervalued securities and you expect the price to go up, and it does not, it comes down, basically the weight of that individual stock will decrease in your portfolio. If you buy something at 100 and it constitutes maybe 10% of your portfolio and the stock prices drops, say, to 50 or even 20, then the allocation of your portfolio to that individual security will not go from 10 to 5 and 2%. So from a risk management point of view, it clearly is different, because if you're short and the stock, instead of going down, goes up, as we saw with the example of margin call, the bank calls me and asks me to put more money, my position is actually increasing. It's not decreasing, it's increasing when I get it wrong. Maybe that 100 I borrowed is 10% of my portfolio, and the stock prices goes to 120 instead of 100. And so now my position goes from 10 to 12%. If the stock keeps on rising and goes from 100 to 120 and 150, then at one point my position goes from 10 to 12 and 15%. So the weight of my mistake becomes larger when I get it wrong when I'm short. So from a risk management point of view, it's not the same. If you're wrong when you're long, it's one thing. If you're short and you make it wrong decision, then it can be very, very dangerous. Hi there. So in this video, we're going to see how long position can be combined with short position. You know, this short selling we just saw. We see how it can be combined so that we make a long-short equity fund. All right? So the learning outcomes is that you'll be able to understand the main difference that there are between being short, to also get a sense of the various characteristics that there are for hedge funds in terms of returns and risks, and also how these hedge funds managers may outperform the market. And I'm going to illustrate this with a practical example. Okay? If you go into some finance book, they tell you about the best example for diversifying your assets is not put the same eggs in the same basket. And they give you one illustration of doing so is umbrellas and ice creams. Umbrellas and ice creams? What are we talking about here? Well, the idea is quite simple. And actually, I saw that. I live in Geneva, you know, and some years ago, I was taking a train from nearby, Lausanne, to Geneva. And one day, just under the station, I saw a guy selling umbrellas. You know, the weather was miserable, and he was selling quite a few of that. And he was standing next to this machine with making this ice cream, right, next to a big store. So I said, maybe the next day. And I walked to him and I say, hey, maybe next day instead of selling umbrellas, if the weather is sunny, you may be selling ice creams instead. So you'll be working full time, right? And now let's assume the following. I'm an investor and have to make a decision as to whether I want to put my money in a firm that produces ice creams and another one which produces umbrellas. We're in April, so just before the summer, at least in Switzerland, and I have to make some kind of weather forecast and see what the weather is going to be during the summer. So I have to bet whether it's going to be a sunny summer and the firm producing ice creams is going to be very successful and the firm that produces umbrellas is not going to be very successful. Okay? So I make my predictions and let's see at the various possibilities there are in terms of investment. Let's assume that I believe that the summer will be nice, and so I can bet on the firm which produces ice creams. Okay, so this will be my first strategy, and it will be a traditional strategy, i.e. I'm long ice creams. I invest in ice creams because I think the stock prices will go up. So the first strategy is long ice creams. Now, assume that I don't think the weather will be nice during the summer, and I believe that the firm selling umbrellas will be more successful. Okay, so my other strategy will be I can be long umbrellas. So this plus UM stands for long umbrellas. Okay. Now, I may be not really knowledgeable in terms of weather forecasts and not really know what the weather is going to be. So I may say, all right, I don't know. So I'll diversify. I'll put half of my assets in the ice cream firm and half of my assets in the umbrella firm, and we'll see what happens. So I diversified without knowing who is going to win. And the fourth strategy, and that's the alternative strategy. All the three ones I just talked to are traditional ones or long only. Basically, you're buying. Okay? The fourth strategy is the only one which is alternative in that here we go back to strategy number one, long ice creams. I say, not only do I think that the firm producing ice creams is going to make a lot of money because the weather will be nice during summer, but on top of that, I believe the company selling umbrellas will do badly, and I want to bet against that firm. So I'm going to be long ice cream, short umbrella. So this plus IC minus UM is this hedge fund strategy of being long a security which I believe will go up and being short a security which I believe will go down. What are the results? We can see that I was right in betting that the summer would be nice, and you see that the company doing ice creams had very good results, 23%, and the firm which produces umbrella, the share price went down and it lost 26% over summer. So not exactly knowing which to choose, the 50-50 strategy means you made half of the gain of the ice cream, but also half of the losses of the umbrella. So for a total of a minus 1.5%. The winning strategy is this plus IC minus UM, so it's long the ice cream and short the umbrella. And here I'm assuming that you don't make any leverage, so you're betting half of your wealth on the ice cream and you're betting the equivalent of half of your wealth in shorting umbrellas. So you make half the gain of the 23% on ice cream. And you're making also half the gain of shorting the umbrella stock for a total of 11.5, so half 23, plus 13, half of the gain by betting against the umbrellas of 13, so for a total of 24.5. Now, you saw in these basic concepts on the performance and return that we can define risk as the dispersion of the returns, right? So we call this volatility. And here I've calculated the volatility. Let's see how it looks. You see that for the ice creams it's 10.8, for the umbrella it's 12.1, for the 50-50 it's 3.9, and for the long ice cream short umbrella strategy it's 10.6. It's interesting that, and this is the main idea of being long and short, is that sometimes you gain on your long position, sometimes you gain on your short position, sometimes on both, sometimes on neither. But on balance, you're going to be able to reduce the volatility because basically you're diversifying your investments. And here we see that this 10.6 is actually the lowest of the long ice cream and long umbrella strategies. And we see that the ratio, which we call Sharpe ratio, 1% in brackets means it's the risk-free return. So basically what we're doing here is that we're comparing the total return, comparing it to a risk-free asset. So this additional return, we're dividing it by risk. So this is a measure which we call risk-adjusted return. It's a key metric for measuring whether we are paid to deliver this extra return, and basically if we're paid to assume all this risk. So the Sharpe ratio gives you the best measure of risk-adjusted return, and we see that it's highest for the long-short strategy, the long ice cream, short umbrellas.
I'm Chris Wright, a cross-asset strategist in the Chief Investment Office of UBS Wealth Management. In this video, I want to answer 3 questions. What are private market investments? How do they differ from public markets? And what are the benefits and considerations for investing in private markets? So what are private market investments? Let's take a simple example. You give $10,000 to a friend to open a clothes store, and in return, they give you a 10% equity stake in the company. This would entitle you to a share of the profits and also any proceeds if the company was to be sold. This would be called a private equity investment because it's a private transaction between you and your friend, and in return you receive equity in the company. Now, professional private equity investors would tend to take this relationship a step further and take an active role in running the company, maybe sitting on the board of directors to increase the likelihood that their investment increases in value. And this is the most common type of private market investment. Other types would include private loans. So using our same example, if you were to loan the money to your friend to open the clothes store, you would receive a specified rate of return, regardless of whether the company actually made a profit or not. And another example could be physical assets. This could be a property, a factory, some land, a machine perhaps. And the strategy here would be to either renovate or improve the asset to later sell it on at a profit, or to rent it out and receive an income. So how are these investments different from public market investments? The key difference is that public companies are traded on exchanges like the London and New York Stock Exchange. And in order for a company to be traded on one of these public exchanges, they must fulfill certain criteria. The most important of these being the need to publicly disclose financial accounts and regularly report their earnings. Another difference is the size and the stage of the companies. Now, private companies can of course be any size, but they do tend to be smaller companies that can't access financial markets. Taking our clothes shop example, your friend could not walk onto the floor of the London Stock Exchange, give some hand signals and sell their company to some traders. Instead, if they needed to raise some investment, they would need to go out and pursue that privately. And so what are the benefits and the considerations for investing in private markets? One of the main advantages of investing in private markets is the potential for higher rates of return, which results from investing in companies that tend to be at an earlier stage of their development and where their success is highly uncertain. It is for this reason that exceptionally successful companies that go on to be valued at over $1 billion are called unicorns. They're very, very rare. However, therein lies the biggest risk of investing in private markets, that this uncertainty makes finding these winners far, far harder. And it's for this reason that we strongly recommend that private market investors don't commit all their capital to just a single investment, but actually diversify by investing in a wide range of opportunities. Another consideration that private market investors must make is the lack of liquidity for their investments. If, for example, you were to invest $10,000 in an S&P 500 company, you could sell this back to the public market at a fraction of a second. However, if you wanted to sell your $10,000 stake in your friend's clothes store, it could take you weeks or even months to find another buyer. Now, despite these risks, at UBS, we strongly believe that private market investments should have a place in portfolios for the simple reason that they can offer a very different source of return to that found in public markets. So when considering a portfolio that already has some public equity and bond investments, an allocation to private markets can increase the return of the portfolio while at the same time lowering the overall level of risk. I think you'll agree this is a very nice proposition. Thank you.
Hi everyone. So in this last module of this first course, you will find out about financial markets and the link to the real economy. This is actually my field. I teach macrofinance. I've studied economics and then I moved to financial markets. But my passion is to read a lot of the global economy and bring that into investments. So I've always been active in this framework of analyzing the macroeconomic pictures and deriving implications for the investment policy. So this is really the crux of the matter in terms of what I do in my day-to-day life. Well, obviously when you say you teach macrofinance, people say, the link between the economy and financial market. Is there such a link? Well, I hope there is one, yes. No, there is one, indeed. But I must add, it's not the only link. Financial markets are not driven just by the global economy. So the global economic picture is not the only thing which moves financial markets. Financial markets can be moved by technical factors and by emotions of the individual investors that buy and sell securities. We will see in the next course how emotion interacts with rational factors when we talk about investment decision. I must say that when I studied economics at the University of Lausanne quite some time ago, at that time it was just about rational expectations. So we were taught that financial markets were perfectly efficient, that the current prices discounted all future information, and so the best forecast you could make of any individual security was the last observation. You could not do better than that. So there was not many opportunities for an economist to come and make predictions. He just could take the newspaper and say, the last observation is my best forecast. So individuals were perfectly rational. They were taking the best decisions they could think of with the set of information they had at their disposal. Over the last 20 years, there's been a very interesting evolution in teaching finance. And this is what we've called behavioral finance. So it's the integration of emotion, as we will see in the next course. It's actually much more fun when you talk about human psychology and not just think that all humans are just perfectly rational. They also make mistakes because they rely on emotions. And sometimes they have what we call herd behavior. They just buy because everyone is buying, or they just sell because everyone is selling. But all in all, and we will find out in this module and in the next course, it's a very interesting combination to have a look at rational factors but also human or emotional factors. Hi there. So in this video, we're going to have a look at central bank policies and concentrate on conventional policies. In a separate video, we will have a look at unconventional ones. The outcome with this video, you will first find out about what central banks are targeting. Is it stronger economic growth, full employment, low inflation, currency stability, financial market stability? We will see that the various central banks may have different, albeit converging mandates. We would also see that central banks may have conflicting goals. And the problem is that if you have only one tool to master, to fulfill two conflicting goals, then you have a problem. And finally, last but not least, we will see that monetary policy entails a fundamental asymmetry. It is far easier for a central bank to cool down an overheating economy, which translates into too strong credit demand, than it is to try to stimulate the economy, as the world economy is actually in the current situation where most of the economies experience weak economic growth, and central banks are aggressively easing monetary policy in an attempt to boost economic growth. And we will see that these expansionary monetary policies do not necessarily translate into higher economic growth. Okay. But now let's first look at what the main objectives are of the various central banks. Indeed, we always talk about a dual mandate for the US Central Bank or the Federal Reserve. I actually see three, as you can see from this slide. Basically, they talk first of ensuring maximum employment, then stable prices, and there's also a third objective which is less known, is to have moderate long-term interest rates. Here the emphasis is on the first two, maximum employment first and low inflation second. But there's a possible exception of another dual mandate, and that's the Swiss National Bank. Although it expresses this dual mandate, this dual objective in a way that it actually looks as just one objective. For indeed, the Swiss National Bank says that it wants to ensure price stability and in so doing, take due account of economic development. So the Swiss National Bank says if we target low inflation, to keep inflation at bay, to keep inflation as low as possible, then we create an economic environment which is such that companies make a lot of investment, create a lot of jobs, and so low inflation ensures high economic growth. That's, in my view, not something which is certainly happening all the times. I'm not sure that ensuring just low inflation brings high economic growth. But when we look at the ECB, for instance, the European Central Bank, they also stay in the same camp. Targeting inflation is the most important thing, and this ensuring price stability in the Eurozone will make sure that economic growth is here to stay. The Bank of Japan and the Bank of England, they focus on maintaining monetary and financial stability. The Bank of Canada and Reserve Bank of Australia, they focus on the value of the currency. And the People's Bank of China is a combination of the Bank of Japan and the Bank of Canada. For the aim of monetary policy in China is to maintain the stability of the value of the currency and thereby promote economic growth. Now, if we want to really be precise, we may argue, we've seen this in another video, that the yuan or the renminbi is actually undervalued, whether we measure it according to the Big Mac parity or by other measures, including relative PPP. So clearly maintaining a stable value of the yuan at an undervalued level will ensure economic growth. But let us assume that maybe in 10 years' time the renminbi is overvalued. Keeping it stable at this overvalued level clearly will not ensure economic growth. But that's a separate subject, and we can talk about it when we get there, which is not for tomorrow. Okay, so now we've seen that the central banks may have different mandates, although at least in their minds, they are converging. For most of them do believe that when you ensure low inflation, you make sure that the economic growth is there. And indeed, when we look at the traditional boom and bust cycle, which we see here in the circle, starting way above, we see here that economic growth is stimulated by a previous fall in interest rates, which is actually the tool that central banks use in terms of conventional policy. The economic growth is stimulated thus. This stimulus of economic growth translates into higher demand for employment and demand for raw materials. And eventually, this translates into skill shortages and supply problems, which translate into higher wages and inflationary pressure. So we get strong economic growth that produces higher inflation. Inflation picks up. It's the so-called cost push inflation. And then the central bank steps in again and raises interest rates. And this rising interest rates actually slows down demand and the economy. And then we end in the bust. In the bust cycle, economic growth slows. The central bank steps in again, interest rates falls, and we have stimulating again. And this we have the boom-bust cycle. So conventional policies of central bank focus on this main instrument. It used to be money supply in the old days, but now it's mostly interest rates. And as we will see in a separate video, this is the conventional policy. But the problem is, for most central banks, once you reach zero with the interest rate, then that's it. It's the end of conventional policies, and it's the beginning of unconventional ones. But that is a separate video. Now, when we look at these various objectives that central banks have, we have a problem which has been illustrated by this man. His name is Jan Tinbergen, and he was actually the first economist to win the Nobel Prize. This was in 1969. And he made a famous contribution, which we can illustrate with the allegory of central banks not being able to kill two birds with one stone. They need two stones for the two birds. Meaning, if you have two objectives, you need two tools. Okay? Just to illustrate, if, for instance, you have both inflation and unemployment, which is typically now the situation that Brazil is experiencing, then you cannot have monetary policies targeting both. You have to choose. Either you raise interest rates to chalk up, to bring inflation down, or you lower interest rates to stimulate growth. But you see that there you're stuck, and you have to decide because there are two conflicting goals. So basically, what Mr. Tinbergen said, he said, we need as many tools as there are objectives. Another example, which is very actual, is here in Switzerland. The Swiss National Bank has two conflicting goals. It has a very strong currency. As we've seen when we talked about PPP, the Swiss franc is the most overvalued currency in the world. So it's way too strong, and this is posing a serious problem and a threat of deflation in Switzerland because of this overvalued currency. So the Swiss National Bank would like to lower interest rates in an attempt to lower the value of the Swiss franc, especially vis-à-vis the euro, for the Eurozone is the main trading partner of Switzerland. But it cannot lower these interest rates because, on the other hand, there's too much credit in Switzerland, too much domestic credit, especially in the real estate, in the housing market. So the Swiss National Bank views that there is some kind of housing bubble in Switzerland, And so it cannot lower interest rates to lower the value of the Swiss franc because it would exacerbate credit demand and inflate this housing bubble further. So here we have Mr. Tinbergen principle, which is very well illustrated. We have two conflicting goals, and just with one tool, you cannot address them. So the way to solve this problem is to have two tools, an additional tool, which is called macroprudential measure. And here in this instance, we address separately, we try to keep the Swiss franc as low as possible with interest rates, but we address the problem of possibly excessive credit demand in the banking sector, especially for mortgages, by imposing higher capital requirements in the banking sector. So in this video, we will keep on talking about conventional policies of central banks. And we'll see that these entail a fundamental asymmetry. This will be the main outcome of this video. Basically, a central bank may have to choose between promoting economic growth or keeping inflation at bay. So in this chart, we see how one central bank may be focusing on inflation. And here I take the example of the US, and you see this red line, and it's showing the consumer price index inflation over history. And the blue line is the key tool for doing conventional monetary policy, and that's the interest rate. This is the so-called federal funds rate. Now, we see that in the 70s, we had this oil shock, which produced very high inflation. And the Federal Reserve, the central bank, was trying to cool this inflation down, to bringing it down by raising interest rates very high. And we see that eventually in the beginning of the 80s, inflation came down very sharply and interest rates could ease as well. So here clearly the emphasis at that time was to target lower inflation. But sometimes it may have another goal, and this other goal is to promote growth. Indeed, after the crisis of 2007 to 2009, the main objective of all the central banks has not been to target inflation, because inflation was nowhere to be seen, but, except, as we have said now in some countries like Brazil, but indeed, the priority was to promote growth. So here we see these interest rates which are at rock bottom, at zero. They cannot go below that. In theory, some central banks have actually managed to put interest rates in negative territory, but this is very, very unusual. So we have these two goals which may be conflicting. And actually, with central banks, we talk about, and you remember this video where I show all these animals and this menagerie in finance. And here, with central banks, we talk about doves and hawks, les faucons et les colombes. Doves are people within the central bank that put the priority on maximum employment and want to use monetary policies, whether conventional tools or unconventional ones, but the priority is to promote growth. On the other hand, you have the hawks, and those are the people that say, hey, the main threat for an economy is high inflation. So here they want to raise interest rates the minute they foresee inflation, even if it's way, 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 way down in the future, but they'd rather be cautious and raise interest rates preemptively in an attempt to choke off future inflation. So here we have the two main differences in the central bankers, those who want to target employment and growth, and those who want to curtail inflation. So the doves and the hawks. Okay, When we talk about this latter objective, i.e. to stimulate growth, one very interesting example is to have a look at Japan. And Japan has been going for many years into the so-called ZIRP policy. This is zero interest rate policy. And you see here the interest rates is at rock bottom and has been there, this red line, for many years in an attempt to stimulate growth. But, and this is the main problem with central bank policies, is that central bank policies, monetary policy, entails a fundamental asymmetry. Very simply said, it is far easier for a central bank to cool an overheating economy where there's too much growth and too much credit demand than it is to stimulate the economy when we've had a crisis like the 2007-2009 crisis. And indeed, we have this fundamental asymmetry because when central banks fear inflation, what they just need to do is raise interest rates to whatever level is needed to cool down demand. If you put interest rates in the US now at 10-15% like in the 70s, then people will stop buying houses and stop borrowing money to buy cars or whatever it takes to have the US dream, right? But here it's just sufficient for the central bank to raise interest rates at a sufficiently high level and demand will come down and inflation will be lowered. But the other objective of trying to stimulate growth does not work necessarily. Indeed, what the central bank has been trying to do in the US, in the Eurozone, in Japan, everywhere, is bring interest rates down. And in so doing, basically what they're doing is they are increasing the gains which banks make between borrowing money at the central bank virtually at zero and lending this money for credit purposes to the real economy, to basically consumers and also the corporate sector. Okay? The problem is, if banks don't want to lend, then nobody is forcing them, right? So even if the margin, even if the gain they make is huge, thanks to this very generous central bank policy with this conventional tool of interest rates, and if the margin on interest rates is very high, but they don't want to lend because maybe they have already too many loans on their balance sheet. And this is the case of Japan. Japan has been having non-performing loans in the balance sheet following the bursting of the bubble in the late 80s. And so even though the central bank put interest rates at zero, the banks would not lend. And this is why the Japanese economy has been so weak for all these decades and has been actually into a deflation territory. So it is far easier for a central bank to stop growth than it is to promote growth. And we can illustrate this with this nice allegory. And you see some pictures here. In French, we have this expression. And I remember when I was at university, my professor of macroeconomics was a person called Jean-Pierre Dantine. And he became later vice chairman of the Swiss National Bank. And he was actually my PhD director for my thesis. And he used to tell me already then, Michel, don't forget, a central bank can bring the donkey to the fountain, but it cannot force it to drink. That's actually the French expression. You know, on peut amener l'âne à la fontaine, mais on ne peut pas le forcer à boire. The English say this otherwise, but it's the same meaning. The English say you can lead a horse to the river, but you cannot force it to drink. Okay, you see here this. Oh, by the way, this is a quiz for you. Going back to the previous picture, who do you think is right? Is it the lady that is trying to pull the donkey to the fountain, or is it the lady that is pushing the donkey to the fountain? This is something for you to reflect. But going back here to this, famous expression of leading a horse to the river and forcing it to drink, well, the Americans, as you can see from this picture, have found a way. And indeed, the US banks have been much more, and we see this on this chart, we see that the US horses, in fact, are more thirsty than the European ones, because we see that both central banks have been conducting a very expansionary monetary policies since the crisis, the Great Recession, as we called it. But banks have been into the lending game much more so than the European ones. And this is why economic growth in the US has been recovering much faster and is currently much higher post-economic crisis, post-Great Recession, than in the Eurozone. We can talk about the reasons of why this is so, but basically we can say that in the US, what was done immediately after the crisis was a program which cleaned the balance sheet of the banks. This was the so-called TARP, Troubled Asset Removal Program. And basically, this enabled banks to be very quickly back in the lending game than in Europe. So in Europe, we typically had the situation where the horse would not drink the water, which was all this liquidity which was provided by the central bank. And this is why the economic growth has been very dull in the Eurozone. So, conclusions. Central banks may have different, we saw in these two videos that they may have different but converging goals. Some central banks believe that if you target low inflation, this will ensure higher growth. I'm not sure about that, but this is how many so-called monetarist central banks think. Ideally, this is principled by this first Nobel Prize, Jan Tinbergen, who said you should have as many tools as you have objectives. So you cannot kill two birds with one stone, you need two stones here. Interest rates, we saw this is the main tool for central banks when we talk about conventional policies. And last but not least, we saw here that there's a fundamental asymmetry in monetary policy. It's far easier to cool down an overheating economy than it is to try to revive an economy which has been into a severe recession.
Hi, I'm Mark Hayfley, Chief Investment Officer of UBS Wealth Management. Today we're going to talk about unconventional monetary policy. Central banks exist to promote economic stability. In the old days, their main tool was interest rates. Interest rates could be raised when people were getting too excited and taking on too much debt, causing the economy to overheat. In contrast, rates could be cut when people were struggling to repay debt and animal spirits were running low. Life has become more complicated and challenging for central bankers since the 2008 financial crisis. Rates have been brought down all the way to zero, and in some cases below that. Yet in many cases, economies were not springing back to life. As a result, policymakers have resorted to what has become called unconventional monetary policy, or quantitative easing. This is when a central bank buys other assets, usually bonds, in an effort to further reduce the borrowing cost for businesses and consumers. This has been compared to ramping up the monetary printing presses. The sums of money that have been printed are vast. In its effort to rescue the U.S. economy, the Federal Reserve bought around $3.5 trillion of assets. Has it worked? Well, the level of success is debatable. It does seem that this policy has helped to prevent a new Great Depression of the kind that ravaged the world in the 1930s. And there's little doubt that unconventional monetary policy has helped ease the pain of those who borrowed too much during the boom years. It's also been good for most investors, pushing up the value of shares, bonds, and property as the newly created money chased a limited supply of assets. But we're still in uncharted territory. Questions remain. How will central banks unwind some of these policies? Central bankers could be poorly placed to combat the next recession unless they're able to return to a more normal interest rate situation first. Now, many commentators have also wondered whether the central bank has overstepped the mark by unwittingly increasing income inequality. As I said, investors have done very well, but so far the wages of many normal people have not increased quite as fast. Well, whatever happens, central banks have become far more important for markets than they were in the past. Investors today need to understand the central bank playbook just as well as they do the economic textbook.
Hi everyone. In this video we're going to have a look at how the macroeconomic picture impacts the equity market. We will first see that there's not necessarily a causal link between economic growth and strong equity return. Indeed, we will see that in many emerging markets, typically they experience high economic growth, but that does not necessarily mean that you have also high equity returns. We will also see that economic growth is actually a key factor when you have to decide whether you want to invest in equities or bonds. But we will also see that inflation needs to be taken into the picture to correctly assess whether you need to be in equities or bonds or in other asset classes. Let us start with this interesting table, which tells you that you have to go to the southeast. Why? Because it's there that you find the highest economic growth numbers. In this table, what we see is the share of world GDP for a number of countries of reference. You see the first column is Europe, then we have the Soviet Union, USA, Japan, and China and India. You see the last column is this so famous acronym which is called BRIC, which stands for Brazil, Russia, India, and China. A very interesting point here is that you see this chart, this table starts at year 0, so more than 2,000 years ago. And you see that either China or India were actually already then the #1 economy in the world. So what we can say is that China has been the #1 economy in the world for 19 out of the last 20 centuries. This is already a major thing to know, and it's actually only in the last century that it was not the #1 economy in the world. Actually, the share of GDP, of world GDP of China, dropped quite substantially from 1913. It was 9%. And it's been actually falling to even 4.5% in 1950, and now it's gradually recovering. So the first message I want to convey here with this table is that it's only a matter of years between China recovers the leading role of the world economy, which it has had in history. I added here 2 lines in this table. And that's the expected share of world GDP that each country will have in 2020 and in 2050, based on the assumption, on some growth assumptions that we can make for each country. And we see that if we assume that China would grow at 6%, it's currently officially at least 7%, but say it would grow a bit lower than that at 6%, then we see that indeed by 2050, it will probably be before then as well, roughly 20%, just under 20% of world GDP, whereas the US will stand at 13%. So China will be the largest economy in the world. So fast-growing economies, does that mean that we have also high equity returns? Well, we will see that in a minute. But first, we need to realize one thing, and this has been alluded to when we talked about currency. Remember the Big Mac and the PPP measures? Well, we have to be aware that many instances, for instance, the IMF, when they compute the world economic growth, they use not the actual exchange rate, the currency rates, but the PPP ones. And indeed, this has a major impact on the weights of the emerging markets. If you remember, when we had a look at the Big Mac parity, but other measures go in the same direction, give the same conclusion, is that the yuan is undervalued vis-à-vis the dollar. So when we use the PPP rate of the yuan or the renminbi, then the weight of China actually increases, and quite substantially so. Indeed, you see here in this chart, I put this in dollar. The blue line is the actual weight, the size of the Chinese economy measured in dollars, but at current exchange rate. The red line is the same value of the Chinese economy, but at PPP exchange rate of the renminbi. And given that the renminbi is undervalued vis-à-vis the dollar, when you take the PPP, you adjust for this undervaluation, hence the weight increases. And you see the green line, the green dotted line here, shows that at the end, 2014, the ratio of the blue line versus the red line is still 1.5, or better said, the red line over the blue line is still a ratio of 1.5, which means that China, when measured in PPP terms, is 50% higher than it is in when you use actual exchange rates. So we need to be aware of this, because many estimates of the world economy use these PPP measures, and hence attribute a larger weight than they currently have to these strong, fast-growing economies of the emerging markets. And hence, the world economic growth tends to be overestimated when we use PPP. Okay, this is something to be aware of. Now, we clearly know whether we use currencies with PPP adjustment or not, that to find economic growth, we need to go to the Southeast, and particularly emerging markets, India, China, and the likes. Okay. Does that mean that we will find there too high equity returns? Well, the answer is no. And this we see with this following chart, which puts together the economic growth of China versus the US and the stock market returns. Let's have a look first at this red line going up and measure on the right-hand scale. We see it starts at 100 in 1994, and it ends at almost 400 in 2014. That's when we have the last data for China GDP, okay? So we have that China GDP has been growing 4 times faster than US GDP. So economic growth has been 4 times higher over this cumulated period of more than 20 years in China than in the US. Does that mean we had more performance on the equity market in China than in the US? The answer is no, it's quite the opposite. As you can see here, the blue line has the MSCI, which is an equity market index in China, divided by the S&P 500, this index which takes the 500 largest company in the US on the stock market. And you see it starts at 100 and it ends at 10 last year. So basically here we have 10 times more return in the US equity market than we do in China. So it's not enough to look at growth, because sometimes you can have growth, but if this growth is financed through excessive credit and companies put too much debt on their balance sheet, for instance, then you can actually have strong underperformance of the equity market. So higher growth does not necessarily mean, and here we have a perfect illustration of this, high equity returns. Economic growth is a key factor to look at when we want to decide whether we want to put our money in equities or in bonds. And this is depicted in the following chart here. This following chart shows in red the world GDP growth. And in blue, it's the performance gap between equities and bonds in percentage term a year compared to the previous year. So for instance, here, if I take this point here at the peak of 2010, the blue line here, you see that it peaks at 40-some%. So this means that maybe, it's just an hypothetical example, the equity market performed year over year by 50% and the bond market by 10%. So the difference is 40%, and that's what's depicted here. So you see that there's a pretty good correlation between the two lines, the two curves. And indeed, there's this idea that when the world economic growth is actually growing, when there's more growth in the world economy, then you should be exposed to equities. And when you actually have lower growth, you should be better off exposed in bonds, as we will see in another video. In French, it even rhymes. You can say les actions pour la reprise, les obligations pour la crise. Okay, so equities for recoveries and bonds for crises. Why? Because when you have strong economic growth, you have companies making more profits, and equity markets do like profits from the corporate sector. And vice versa, when we have slowdown, we have lower interest rates. And as we will see in another video, when you have lower interest rates, you have higher bond returns. So you can see that actually this works pretty well. First, when we exclude the red line here, just have a look at the blue line. And you see that when it hits this upper green dotted line of 30%, then we have an outperformance of equities versus bond by 30%, which actually points to some kind of peak. You know, it's kind of getting a bit ahead of itself. Conversely, when the blue line hits the lower green dotted line of minus 30%, there too, it's a sign that maybe we have excessive underperformance of equities versus bonds. And you see that then if we bring the cycle of GDP onto this, we see that it's a key factor to factor in. It's a key metric. When we add the world GDP growth, we see that it correlates pretty well with this performance gap. And basically here, for instance, I can give you one example. March 2009, we were really depressed. You see here, the equity market was down more than 50% versus the bond market. Everyone was so depressed. Everyone was fearing the end of the world. Deflation was looming. It was back to the Great Depression and everything. Many portfolio managers and investors I know have had just pulled the plug and say no more equities. We just stay out of the risky assets and so forth. And here, when you get the estimation, a timely estimation that the world economy is actually recovering and actually very fast, and you see it has this kind of V-shaped recovery, when you get pretty early evidence of this, then you see that the equity market kind of turns and goes from an underperformance of more than 50% versus the bond market to an outperformance of more than 40% in just 12 months. So here, it is key to know about macroeconomic fundamentals, to reposition yourself away from bonds into equities. So now we know that economic growth is key when we have to decide whether to go in equities or in bonds. But there's another dimension which needs to be added here, and that's inflation. And this is done here with this following chart. You see here two compasses. The one on the left is from a famous browser, and the one on the right, is one which I personally very much like. And you see the difference here is that the red arrow points to the northeast for the compass on the left, but to the northwest for the compass on the right. And why is this so? So let's imagine the following. You look at the compass on the right, and you assume that on the vertical axis we measure growth, and on the horizontal axis we measure inflation. Okay. So now let's assume that we're going in the quadrant to the top on the right. In there, we will have a lot of inflation and we will have a lot of growth. So this is an overheating economy. Economic growth is too strong and eventually it produces inflation. To the point where this higher inflation actually slows down the economy. And so we go to the quadrant which is on the right still, but on the bottom, where we have a lot of inflation but no growth, or very little growth, or possibly even negative growth. And that's called stagflation, a combination of stagnation and inflation. This is the example of Brazil currently. They have lots of inflation and they have no growth or high unemployment. The worst of all is the quadrant on the left and the bottom. This is the deflation, where you have no growth and no inflation, or negative inflation. Luckily, there are not many examples of this deflation. The last that we are aware of is the Great Depression in the US and elsewhere. So we may view this deflation quadrant actually with two subcategories. One is where the economy is cooling, and the other one where the economy is too cold. Now, the perfect quadrant, and this is why the red arrow is pointing in that direction, is the quadrant where to the left on the top, because that's where you have little inflation and strong growth. And indeed, this scenario of perfection with a lot of growth and no inflation is the ideal one for equity market. And it's actually called, it bears a name, it's called the Goldilocks scenario. Now, I'm sure you've heard of Goldilocks, Boucle d'Or. Goldilocks is that little blonde girl, and she gets lost in the woods, and she finds this house all lit. She walks in, and she finds these 3 cups on the table. In the English version, I think it's actually porridge. In the French version, it's chocolate, hot chocolate. So she goes for a big bowl, the largest one, and that's for Daddy Bear. And she tastes it, and she says, "Ooh, way too hot." And then she goes for the one of the mummy bear, because it's the house of the 3 bears. I forgot to mention that. And so she tastes it, and it goes, it's way too cold. And then she goes for the one of the baby bear, and she takes the cup, drinks it, and it's just perfect. It's not too hot, not too cold, just perfect. And this is this ideal scenario for equity market, where the economy is not too hot, so that this economic growth produces inflation, which leads central banks to tighten monetary policy and increase interest rates, which equity market totally dislike. So it's not too hot, it's not too cold, where the economy is not growing enough for companies to generate profits. It's just perfect. You get enough growth, but not too much growth that brings inflation. So it's just the perfect scenario. And this is actually, as we will see in a minute, the scenario where equity markets perform best. So if we summarize what we've seen here, and we start with the quadrant of rising growth and rising inflation, meaning that the economy is warming, eventually this warming ends up in overheating and too hot, and this is with rising inflation and falling growth, which we've seen can also be called stagflation. The cooling and too cold, that's the worst of all scenarios. This is the deflation scenario, and the rising growth and falling inflation is perfection. We can fine-tune these 4 quadrants into 5 regime. Again, starting with the quadrant on the top right. We start with a rising growth regime. We have inflation picking up, and it slows down growth to the point where it gets too hot, and we have rising inflation choking off growth. And then the cooling comes when growth falls further and brings inflation along. And the just right, again, is positive growth and low inflation. And indeed here we see how the equity markets have been performing in these 5 different regimes. And we see that the warming regime is the most frequent one, occurring 46% of the times, and generating a real performance of the equity market of 7.5% per annum. And you see here that the highest return is actually the one for perfection, as I just said, the Goldilocks scenario, generating more than 14% on a yearly basis. This is in real terms, this is after inflation. The cooling is still giving you some decent returns, but the too hot and too cold scenarios are very bad, especially obviously the too cold one, which is the outright deflation, where equity market tumbles by more than 20% per annum. In conclusion, we know that emerging markets typically face stronger growth, economic growth, but this stronger economic growth does not necessarily mean that you will find also high equity market returns. Indeed, economic growth is a key factor to look at when you have to decide whether to be in equities or in bonds. But the picture is only complete when you bring inflation into the scene. And when we look at the growth inflation mix, we find out that the best mix is obviously the one of strong growth, low inflation mix, which we called Goldilocks, as we've seen. And this is where equity markets perform best. Hi everyone. Today we're going to have a look at how the macroeconomic picture impacts the bond market. With this video, you will know what the concept of the yield curve is. Then you will find out what drives short-term interest rates and long-term interest rates, which are part and parcel of the yield curve. And you will find under which condition, which growth and inflation mix is best for bonds when they perform best. And last but not least, you will know when to have bonds as a safe haven investment in case equity markets get in trouble. But first, let's have a look at the so-called yield curve. The yield curve is plots basically all the yields. You remember those yield to maturity we saw when we talked about bond markets? Well, here you have on this chart all the different interest rates. Generally, it starts with 3 months and it goes up to 30 years of the different maturity. So it's a bond with same credit quality but different maturity. And this is what normally, and this is when we say the yield curve is normal, it's upward sloping. Why is it upward sloping? Well, basically, if I lend you $1,000 and you tell me, Michelle, I'm going to refund this $1,000 in 3 months, I may ask you for a given interest rate of, say, 2%. But if you tell me that this $1,000 you give me back in, say, 10 years' time, I may certainly ask you for a higher interest rate. Because over 10 years, you may have some difficulties in paying back the $1,000 I gave you. Hence, I require a higher interest rates, which reflects a higher risk premium. That's one reason. The other reason, and that's a very important one, is that, and it's linked to the previous one, is that interest rates at the long end, as we say, of the yield curves, i.e. long-term interest rates, are higher because they incorporate some expectation of inflation, some premium for expected inflation. Anyhow, this is what the yield curve normally looks like. It's upward sloping, meaning long-term interest rates are higher than short-term interest rates. But it can also be inverted, this yield curve, i.e. short-term interest rates are higher than long-term interest rates. This is rather unusual, and we will see in a minute under what circumstances this very peculiar shape of the yield curve materializes. First, let's go more in the details of what drives the different interest rates. If we start with short-term interest rates, Basically, they're driven by central banks. It's a key tool, as we saw when we talk about conventional policies of central banks. It's the key tool they use to adjust monetary policy. When they want monetary policy to be more expansionary, they lower interest rates. When they want a tighter monetary policy, they raise interest rates. So short-term interest rates are in the hands of central banks. When these central banks expect higher inflation, they increase rates. When they fear that there's going to be a recession linked to a too low inflation rate, they lower the interest rates. Long-term interest rates, on the other hand, are determined by the markets, the bond markets, demand and supply conditions, but also the influence of what short-term interest rates are doing. Basically, the idea is that when there's a tighter monetary policy, short-term interest rates increase, long-term interest rates increase as well, and conversely. This asterisk points to the fact that there's actually an exception of when bond markets determine long-term interest rates, and that's when central banks conduct, as they have been over the last 4 years, they conduct unconventional monetary policies. Here, central banks take control of the whole spectrum of the yield curve, not just short-term interest rates as they do traditionally, but also long-term interest rates. How does that happen? Basically, at this juncture, when short-term interest rates are zero, normally they cannot go below zero. In some instances they can, but normally they can't. The idea is that the central bank influences money supply by purchasing bonds. So basically, when they want to inject liquidity, as they have over the last couple of years, they purchase bonds from the banks. And so basically, the central banks here also have an impact on long-term interest rates, i.e. those interest rates which are driven by normally the bond market. Now, the yield curve, and that's a very interesting point, can be used actually as a predictor of economic activity. Why is that? Well, basically, as we've seen, a yield curve normally is upward sloping. And basically, this slope of the yield curve being positive is a reflection of that central banks conduct an easy policy. They lower interest rates. So when the difference between long-term and short-term interest rates is high, meaning when the yield curve is steep, it's a sign that central bank policy is very easy. On the other hand, when we have this inversion of the yield curve, when short-term interest rates are higher than long-term interest rates, when, say, 3-month rates are, say, 7% and long-term interest rates are 5%, which is, as you would agree, rather odd, then we have here a tight monetary policy. As you can see from this chart, what I've shown here is the slope of the yield curve. Here I've taken 10-year bond yields, and I've deducted the federal funds rates, which is the key short-term interest rates which the US central bank uses to conduct its monetary policy in a conventional way. Okay, so when this difference is positive, the slope of the yield curve is upward sloping. It's normal. Conversely, when you see the red line dipping under the zero line, it means that the yield curve is inverted. What have we seen? That this is a sign that monetary policy is. So this red line being negative is, and you've answered now the question, is a sign that monetary policy is restrictive. And what do we see on this chart? Each time the yield curve has become inverted, the red line has dipped below the zero line, you see that soon after, the green bars, they go down, meaning that there is a recession in the US. Sometimes we do have an inverted yield curve and no recession materializes immediately after that. There is an example, for instance, in 1997. But more often than not, this inverted yield curve is a sign that the US economy will go into recession. So in conclusion, the slope of the yield curve is a very good indicator of economic activity in general. Especially when central banks conduct conventional monetary policies. A bit less so when they do, as they have been over the last couple of years, conduct unconventional policies. Okay, we've seen how the macroeconomic picture impacts the yield curve, the short-term interest rates, the long-term interest rates. But now let's have a look at how bonds perform depending on the growth picture. We've seen this chart already. You remember it depicts in blue the difference between equities and bonds on a year-to-year basis in percentage term. This is a world index of equities less a world index for bonds, the performance. So it measures, this blue line, the performance gap between these two asset classes. And in red, it's the world GDP growth. Now, basically the message here is simple. When the world economy slows, meaning when the red line decreases, you see that the blue line decreases as well. That means that equities underperform bonds to the point where even that underperformance becomes negative. Or if you prefer, bonds outperform equities. For instance, you see here from the peak just before the crisis of 2008, 2009, equities were outperforming bonds by roughly 30%. And then we get this peak of world growth from close 5% to -1 in between 2007 and 2009. And this outperformance of equities goes from +30 to -50. So at -50, we have a point where bonds outperform equities by 50% on a year-on-year basis. So the place to be when the economy slows is definitely bonds. We also saw that with this compass, which I reproduce here. And you remember that this compass points to, the red arrow points to the northwest and not the northeast as we do traditionally, for a very good reason. If we think that on the vertical axis we depict GDP growth, so we have strong GDP growth on the top, low GDP growth on the bottom, and on the horizontal axis we indicate inflation, so low inflation on the left, high inflation or strong inflation on the right. Then the place to be for equities, and this is why the arrow points there, is this so-called Goldilocks. You remember the little blonde girl, the balls and everything. Too hot, not too cold. Just perfect temperature. So good GDP growth, low inflation, that's the best, that's the sweet spot for equities. On the other hand, if we move to the right quadrant, here we have strong growth, but that also generates high inflation. So that produces higher interest rates, and we'll see what that means for bonds. The lower quadrant on the right, we've seen that it points to stagflation, i.e. high inflation, low growth. We saw that it's currently the experience which is endured by Brazil. And the worst of all, at least for equities, is a low GDP growth and a low inflation. That's what we call deflation on the bottom left-hand quadrant. So here, this Goldilocks quadrant is the best spot for buying equities. The right on the top is one which is not good for bonds. Why is that? Because higher inflation leads to higher interest rates. Central banks tighten monetary policy, and we'll see in the next video that these higher interest rates are bad for bonds. And the bottom quadrant on the right is the stagflation one. Here, that's not good for equities. Why? Because we don't have any growth and we have inflation. So we have the worst of all combination for equities, possibly higher interest rates to fight inflation and no growth that enable companies to generate earnings. The best actually, and this may be a bit odd, the best environment for bonds is the bottom one on the left. That's the deflation. But basically, the whole idea here is that slow growth and low inflation bring central banks to reduce interest rates, and this reduction in interest rates is positive for bonds. Hence, it is in this environment of easy monetary policies, because central banks fear that there's going to be a recession and there's no inflation around the corner, so they bring interest rate down, and that's a positive environment for bonds. Last but not least, we're going to have a look now at how bonds behave in relation to equities. What do we mean by that? Sometimes bonds and equities move together. Sometimes they move in opposite direction. So to check that, I've done here this chart. What does it show? It shows the cross product equity times bonds in the US. This is the red bars. Why do I multiply equities and bonds returns? Well, for one simple reason. If the equity market is going in the same direction as the bond market, either in a positive way or in a negative way, if we multiply the two, the cross product is going to be positive, because a positive figure multiplied by a positive figure brings a positive figure, but also a negative figure multiplied by a negative figure is a positive figure. So if the bars here the red bars point upwards, it means that bonds and equities move together. The correlation is positive. Conversely, when the bars are going down, it means the correlation is negative. When one goes up, the other goes down. Okay? Right. So what do we see here? That basically these bars, they tend to go sharply down when the blue line goes sharply down. And that's interesting. Why is that? Because the blue line depicts the performance of the equity market. Here we are looking at the S&P 500. You remember that index of the 500 largest company in the US on the stock market. And you see on the right-hand scale, when we have the equity market tumbling like it has been over the 2009, for instance, when it fell by a staggering 40%, you see the bars going sharply down, meaning bonds go up. And this makes sense. When you see that the stock market is collapsing, what do? You put your money in the so-called safe haven. You buy bonds because you want security. Okay? So inverse relation between equities and bonds. Okay? So generally the explanation is valid here that, and this is the main one, when equities market tumble, the investors generally find it better to put their money into bonds. So in conclusion, we see here that the best way to capture the macroeconomic impact of the bond market is to look at the yield curve, because you have the whole spectrum of interest rates, very, very short-term interest rates, very, very long-term interest rates, and everything in between. Normally, this yield curve is upward sloping, and that's a sign that monetary policy is easy. But it can also be inverted, and this is a sign that monetary policies are tight. Under normal circumstances, i.e. when central banks conduct conventional policies, this yield curve is a very good indicator of what future economic activity will be. So it's a leading indicator of economic activity. But when central banks conduct, as they have over the last few years, conducted unconventional policies, so they take control of the whole yield curve, and they also influence long-term interest rates, then this indicator is not so good. Why is that? Because when central banks are conducting easy monetary policies, they inject money and they purchase bonds. By purchasing bonds, they lower interest rates. So the difference between long-term and short-term interest rates reduces. And this means normally that central bank policies are tight, but here in this case, it's not. Here actually central bank policy is easy. So here this indicator is not so good. It's only good when central banks are conducting conventional policies. Hi there. In this set of two videos, we will see how the interest rates impact both the equity market in the first video and how they influence the bond market in the next video. So by the end of these two videos, you will know how to use the formula of the net present value, which you have seen already in other videos, to capture how interest rates impact equity markets. And you also be able to see how to use the concept of duration that we've also seen. You remember the ruler, the glass with the water, and what happens when you confuse duration and maturity. We will see here how we make use of the duration concept to adjust your bond portfolio depending on movements on interest rates. But first, let's start with equities. This formula, which you've seen in other videos, is a very widely used formula of the net present value. What do we have here? Basically, we are discounting future cash flows of a firm or an aggregation of firm, i.e. an index. This can be the S&P 500. We are discounting these future expected cash flows which the firms will generate to a present value today. We've seen that this is the opposite of compounding interest rates. It's discounting them back to a value today. And this discounting factor is this R in this formula. It's the interest rates. So very intuitively, we see here that if interest rates go up, then the stock market goes down. And you see this because the R is at the denominator. Basically, when the interest rates go up, the future value of this cash flow decreases today. Okay. So now let's have a look at this with this chart. We see here the relationship between the S&P 500 and the federal funds target. And we see that the two lines actually correlate, but remember, you know that sometimes I use inverse scales. You see here on the right-hand scale, the right-hand scale is for the blue line and it's inverted, meaning when this blue line rises, it's actually a fall in interest rates. For instance, we see that in 2001, interest rates, the federal funds rates was at 6.5%. And then by 2004, it was down 1%. The line increases, but it's actually a fall in interest rates. We see that this actually does not coincide with an increase in the equity market. It's actually a fall. So here, the explanation is not so simple. Sometimes equities do perform well when interest rates fall, but not always. For instance, here, they haven't. Interest rates fell, but equity market fell as well. The reason is quite simple. The central bank in the US saw this crash. It was the dot-com bubble, which burst. That produced a severe downturn of the equity market, and the Federal Reserve tried to accommodate this with lower interest rates, but the equity market kept on falling. But in general, interest rates do help the equity market, and they will help the equity market if those low interest rates ultimately produce more growth. Because this strong economic growth leads company to generate more earnings, and earnings are very much appreciated by equity markets. So we saw that when central banks reduce interest rates, as they have been over the last couple of years, this may not necessarily translate into stronger economic growth, because if banks do not want to lend money to provide more credit to the real economy, then the low interest rates will not translate into stronger growth. This is typically the environment in which we have been over the last couple of years. We have very aggressively easy monetary policy, very low interest rates, but weak, by and large, weak economic growth. So equities in this environment are a bit in a mixed bag. On one hand, they profit from low interest rates. On the other hand, they fail to benefit from the positive impact of growth on the equity market. Now, we may go actually one step beyond this analysis of what to do when interest rates fall. And this is looking at the performance of financials versus the market. There's this idea that financial stocks, meaning banks and insurance companies, they perform well when interest rates fall. So here on this chart, I've depicted, it's the same, the blue line is the same as the previous one, is the federal funds target, inverted on the right-hand scale. And in red, it's the performance of the S&P financials, financial stocks, divided by the whole index. So when this red line increases, it means that financial stocks outperform the whole market. And conversely, when it falls, the financial stocks underperform. So we see that, for instance, between 2000 and 2004, we see the red line going up and we see the blue line going up, meaning, be careful, that interest rates are actually falling. So here the explanation holds true. But it does not always hold true. For instance, when interest rates it holds true also between 2004 and 2008. When interest rates actually sharply increase, we have this underperformance of financials versus the whole market. But when we have interest rates falling sharply after the crisis, when central banks conducted very aggressive monetary policies, so interest rate ease from 5% to basically zero, or just about there, financial stocks kept underperforming and then stay there very flat. Basically, when interest rates fall sharply, it may not necessarily bring financial stocks to outperform the equity market. Banks may have a problem. For instance, they may have a balance sheet which has too many bad loans. And so even if interest rates fall and the difference between long-term and short-term interest rates rises, then banks normally would be incentivized to provide more credit, hence make more money from providing credit to the real economy. But if they have already too many bad loans on their balance sheet, they will not provide more credit, hence they will be in a bad shape despite these low interest rates, and they will be underperforming the market or just being at the rock bottom as they have been since 2010. We've seen this slide already a couple of times, so I'll be very quick. Here we know that the best quadrant is the one on the top left. That's the one where you want to buy equities because there's strong growth and low inflation. If we think of the low inflation as being the environment where interest rates are low, then actually the message I want to convey here is that low interest rates may not be enough for equities to perform well, as we've just seen with financial stocks. Basically, if this low inflation is coupled with very low inflation, i.e. low interest rates, is actually coupled with low economic growth, then we go from the Goldilocks quadrant to the one just underneath, which is better for bonds. It's the place where you want to buy bonds, not equities, because growth is actually too weak, so companies fail to generate the kind of earnings that equity market like. So in conclusion, quite simply, equity markets tend to perform well when interest rates fall, but not always. Remember this formula of the net present value? We have the future cash flows and we have the discounting factor at the denominator. Well, basically there are two influences here. If economic growth is too weak, the future cash flow will be lower, so that will decrease the value of your equity today. And if interest rate increase at the denominator, it also reduces the value of your equity portfolio today. So equities can actually suffer either if future cash flow, i.e. economic growth, is weak, and or if interest rates increase. So now, with this video, we're going to have a look at how interest rates impact the bond market. we use actually the same formula, or indeed it's very similar to the one we saw for equities, the net present value, as you can see from this chart here, which we have already seen. The net present value is the discounted value today of this future stream of incomes which you generate with your bond, and the principal which you get back at the end. Okay, so here too we have a very simple way of knowing that when interest rate increase, this YTM at the denominator, the famous yield to maturity, when it increases, the value of your bond today falls. Okay, so on the chart we see that when Y0 goes to Y1, it increases. P0, the price of the bond, goes from P0 to P1, i.e. is lower. And this we can see with the following chart here, which depicts the relationship. We saw that with the US, the example of US bond. Here, to change a little bit, I've taken the UK bond market, and in red it's the index of the UK government bond, and in blue it's the 3-month short-term interest rates, which we call LIBOR. LIBOR meaning London Interbank Overnight Rate. And it's depicted on an inverted, again, sorry for that, inverted right-hand scale in blue. Why do I do this inversion? Because, well, by now you know, I want to just illustrate the fact that the two lines are perfectly correlated. When the blue line increases, it's actually a fall in interest rates. You see, for instance, between 90 and 94, the short-term interest rates in the UK went from 15% to less than 6%. That's a staggering fall. And this has been accompanied by an increase in the bond index from a value of 95 to a value of just under 120. And in general, we have this very good correlation, almost perfect, I would say, between short-term interest rates and the performance of the bond market. We can illustrate this relationship between the yield and the performance of the bond market by this chart here. All these little dots give you one observation, and here we're back with the US, between the starting yield of a government bond in the US, 10-year bonds, and the performance 5 years hence, so over the next 5 years. So what is the message here? Well, the message is that if you buy a bond when the initial yield is high, the probability that this yield will actually fall over the next 5 years, say, is quite high. So it means that the probability that you will generate good returns with a bond, and this is a key thing to know, is high. Conversely, when bond yields are low, as they are today, as we speak, the bond yield in the US is 2.2%. This is extremely low. If you look at this chart, it doesn't even stand on the chart. You see all these observations here? Basically, the first one here over this period starts at something like 3.5%. So 2.2 is not even on the chart. It's off the curve here. So what do we mean by that? It means that there's a very low probability that you will make high returns if you invest with bonds today. Why is that? Because the bond yield is low. So the probability that this bond yield will increase over time is actually quite high. And we saw already, by now you should know, what should you know? That when bond yields rise, bond prices fall. One concluding remark with this chart, on the vertical axis here, I've shown the real interest rates per year over the next 5 years. So real meaning the nominal rate less the inflation rate. So it's actually the true performance which you generate after inflation. So now let's go back to the yield curve and see how it moves depending on what the central bank does. by changing interest rates. Here you see these two lines. The blue line is the yield curve of the US market, US bond market, in December 2013. And the yellow line is that same yield curve, but just after the Federal Reserve tightened interest rates, and this was done very recently in December 2015. And we see that actually the yield curve has flattened. It was quite steep. You see the difference between 30-year bonds and 1-month interest rates was just under 4%, or 400 basis points, as we say. Okay, this was in 2013. And now the difference between 30-year bonds and 1-month interest rates is 3% less 0.25%, so just under roughly 2.75%. So the yield curve has flattened. Why is that? Basically, what we say here is that by raising interest rates, the central bank actually gives one message to the bond market. It says, I bring interest rates because I anticipate that this better economic environment in which we're in will not translate into future inflation. So basically, by doing this increase in interest rates, they lead bond investor to believe that inflation will be lower in the future. So they lower inflation expectation. And this is why long-term interest rates kind of ease a little bit. So normally we have that when the interest rates go up, the yield curve flattens. Interest rates increase more at the short end of the yield curve than at the long end, because by doing so, the central bank eases inflation expectations. When this happens, i.e. the yield curve flattens when short-term interest rates increase, we say that the central bank is ahead of the curve. It's actually successful in keeping inflation expectations at bay. Conversely, when we have that when interest rates increase, long-term interest rates increase even more, we say that the central bank is behind the curve. So now let's see what you can do with the duration when there are changes in the yield curve. Basically, as you remember, the duration is the key concept for bond portfolio because it's the measure of the sensitivity of your bond portfolio to changes in interest rates. The higher the duration, and remember here we put the formula on the screen again, the higher the duration, the greater the sensitivity of your bond portfolio to changes in interest rates. So basically, how you're going to position yourself depends on how the changes in interest rates by the central bank at the short end drives the yield curve. Normally, if we have a flattening of the yield curve, you should increase duration. Why is that? Well, let's look at these two charts here. We see that the yield curve may be flattening in two instances. And let's start by the one on the right. You see that if we start from yield curve 1 and interest rates actually are reduced, they may even reduce a bit further, a bit more at the long end of the yield curve. So that you see that the difference between long-term interest rates and short-term interest rates is actually reduced here. But it can also happen if central bank, and this is normally what happens, tighten monetary policies, increases short-term rates, and the long end of the yield curve actually also increases, but by less. So there too, the yield curve flattens. So what you want to do here is you want to, as we say, go short at the short end of the yield curve and long at the long end of the yield curve. Why is that? Well, take a look at the chart on the right. You see that the arrow here, the movement on the right, on the far end of the yield curve is quite big. So basically, when you are positioned there, when your bond portfolio is very long in duration, then this is where you capture the most this dramatic fall in the yield. So the best way to capture this dramatic fall of the long-term interest rate, you capture it if you increase duration toward maybe the maximum. Basically here, when we have this flattening of the yield curve, we say bullish flattening because interest rates are coming down, and you benefit the most from this fall in interest rates if you position yourself, the duration of your bond portfolio, to the maximum here. So here the message is that you should avoid or go short-term bonds, and you should pile into long-term bonds and increase duration to benefit from this movement. On the other hand, we have that the yield curve may be steepening, and this may happen in two instances. If, as we've just seen, the central bank is how we say, behind the curve, it's increasing interest rates, but the bond market is still believing that there's more inflation to come down the road. So the central bank is behind the curve, it's not tightening monetary policy fast enough, so inflation expectations keep on growing, so long-term interest rates actually increase by more than short-term interest rates do. So this is what we call bearish steepening. Bearish because, bears means that the price of your bonds go down because interest rates go up, and also there's the steepening of the yield curve. The slope actually increases. But it can also be a bullish steepening. That's the chart here on the right. And here we have that the central bank is conducting a very aggressive, easy monetary policy, and the long end of the yield curve decreases, but by less. So we have a steepening of the yield curve. So here what you want to do is you want to decrease duration. Why? Because, and you see this from the best from the chart on your right, that's where interest rates fall the most, because interest rates fall the most at the short end of the yield curve. So if you decrease duration, that's where you will capture the most this dramatic fall in interest rates. So in conclusion, we saw that very mechanically, with this formula of the net present value, bond returns are good when interest rates go lower and conversely. And we saw with these twists of the yield curves that it may be steepening, it may be flattening, depending on what inflation expectations do in relation to the conduct of monetary policies. Basically, you should use the duration to adjust your bond portfolio depending on what you think is going to happen to interest rates and the shape of the yield curve. But generally, the whole very simple idea, to put it very simply, is when you expect the central bank to ease monetary policy, so interest rates to go down, basically you should increase duration because you will tend to benefit with your bonds of these low interest rates. And conversely, when you think that the central bank is going to increase interest rates, you want to, generally speaking, but then it depends on the movement of the yield curve, as we've seen, but generally speaking, you want to reduce the duration because higher interest rates will hurt the returns of your bond portfolio.